Okay. The next chapter we are going to start is buyback of securities, sir. Once we complete financial statements of companies and then cash flow statement chapter, the next topic is what, sir? Buyback of securities. Sir, examination point of view, what is the weightage of this chapter, sir? 8 to 10 marks, sir. 8 to 10 marks you can expect from this buyback of securities chapter, sir. And this is important from examination point of view. Definitely you will get one question. And you know, in MCQs also they are testing this. Two or three MCQs they are asking from buyback of securities. Each MCQ 2 marks. So 3 MCQs means 6 marks straight away you will get. Sometimes what they are doing, they are testing one question, 4 marks question or 7 marks question, or maybe 1 or 2 MCQs. So that's why I said 8 to 10 marks is a possibility from this chapter, buyback of securities. Okay. See, in buyback of securities, what are the things we are going to cover, sir? I will give you the bird's eye view of this chapter. See, part number 1, sir, we need to understand first concept. What is buyback, sir? What is buyback? Buyback means buyback of securities. What is buyback of securities? This is the first thing we need to understand, sir. Second, why companies will go for buyback? What is the objective? Objective, or I can say the advantages of buyback. Object of buyback, advantages of buyback, or sometimes we can call it as effect of buyback, whatever. You need to understand. And then the most important thing is sources for buyback. Sources for buyback. Sir, whenever a company wants to go for buyback, there are certain sections in the Companies Act which are providing restrictions, conditions. We need to follow them. It is not, see, when you are doing any transactions or anything relating to company, you need to consider the provisions of Companies Act. So relating to buyback, there are sections. I think section 67, 68, 69, 70, like that. Some sections are there. So in the Companies Act, they have mentioned the sources for buyback. Whenever a company wants to go for buyback, they have prescribed some sources. What are the sources? Only those sources we have to utilize for buyback. And the next important thing is limits for buyback. Limits for buyback. Sir, whenever a company wants to go for buyback, there are certain limits, sir. These limits are developed as per the provisions of Companies Act. Very, very interesting and very, very important. Limits for buyback. See, the sources for buyback, limits for buyback, understand these are as per Companies Act. As per Companies Act. And then the concept of CRR. Concept of CRR. What is CRR? Capital Redemption Reserve. Why CRR will be created? Why CRR will be created? Whenever I ask student what is CRR, he will give full abbreviation, that's it. I asked CRR, he says Capital Redemption Reserve. I asked Capital Redemption Reserve, he says CRR. He will convert, that's it. If I ask him why, what is CRR, why it will be created, he don't answer. No answer at all. So for the first time you are learning CRR, why it will be created. I am going to explain you the beautiful concept of CRR. Why the act saying you to create CRR? Now once I explain you can explain to so many juniors, so many people. Make them also knowledgeable people. Make them also knowledgeable persons. So the concept of CRR will come here. In buyback of securities, CRR concept will come into the picture. So these are the 5 things you need to learn. Okay. Now once you complete these 5 things, we will go to the second part. What is the second part? What is the second part? Accounting for buyback. Accounting for buyback. That is what our subject is here. You should not forget our subject. Our subject is what? Accounting. Right? What is the accounting treatment for buyback? So we are discussing buyback means we are discussing for accounting. But you need to understand the accounting. In order to understand the accounting part, you need to know all these things. That's the important thing. That's why they say is what? Experience is the best teacher. For example, if something, if it is not in your experience, how many times I told you won't understand. Something which is in your experience, if I told you, you can easily connect with it. For example, I said Tirupati Laddu is very delicious and very sweet. If you already have eaten it, I know, you know already, you can easily connect with it. Suppose if you don't, till now you have not eaten Tirupati Laddu. Now I am explaining, how much about I explained you now, you can't correlate with it unless and until you experienced it completely. So that's why every chapter our main object is what? Accounting treatment. Accounting you can do perfectly only when you know these provisions. That's why these are very, very important. See, our object is to prepare cash flow statement only. But to prepare cash flow statement, I should know what is cash equivalent, what are the cash flow activities. Only if I know all these things, I can prepare. So that's why the background is very, very important. I can't move directly to accounting treatment. But some students direct attack. What happens if they direct attack? They fail. Without having any basic knowledge, without knowing what is buyback, what are all these things, if you try to do the accounting treatment, maybe 1 or 2 problems will be easy. Suppose if at all any twist in the examination, then gone. So this is the bird's eye view of this chapter, sir. This is what we are going to discuss in this chapter. Okay. Okay. Now let us start with the first concept, sir. What is the first concept, sir? What is buyback or meaning of buyback? Correct? Let us start. What is buyback? Can anybody tell me what is buyback of securities? Buyback of securities. Can anybody tell me what is buyback of securities? Suppose a company is there, sir. Company issuing shares. Company issuing shares. Company purchases its own shares. Company purchases its own shares with an intention of cancellation is called buyback. First of all, my question, can a company purchase its own shares for the purpose of investment? Can a company invest in its own company? For example, Reliance Industries Limited. Can Reliance Industries Limited purchase its own company shares? Can Reliance company become investor in its own company? No. How can you become investor in your own company? What makes sense? Suppose, for example, company is an artificial person created by law. Now this company is issuing shares. The shares of the company is purchased by outsiders. They will become the owners of the company. My company shares I will only purchase. That means your money you are contributing to yourself. It doesn't make any sense. So therefore understand, if you see the Companies Act clearly says no company is allowed to purchase its own shares unless there is a consequent reduction of share capital. This is there in the Companies Act. That means a company cannot purchase its own shares for the purpose of investment. Buyback is not an investment option. You purchase your own shares, but your intention is what? Once you purchase those shares, you need to cancel them. No, sir, we will purchase the shares, sir. We will hold it for some period of time as investment. Hey, in your company, how can you invest here? Suppose, for example, in my right pocket, 10,000 is there. I put it in the left pocket. Can I say, hey, I have 20,000 rupees? Come on, yaar. You shifted from right pocket to left pocket. Both are you only. 10,000 rupees is there with you only. So therefore, purchasing your own shares for the purpose of investment is prohibited. Sir, for what purpose can I purchase? You purchase your own shares, not for investment, but for cancellation. This is called buyback. So most of them are misunderstanding buyback as company purchase own shares, company purchase own shares. That is not buyback. Company purchasing its own shares plus cancellation. Two things should happen here. Company first purchase its own shares, after that they should be cancelled. That means because of buyback, what happens? As a result of buyback, your share capital will reduce. Your cash and bank balance will reduce. Because see, suppose a company wants to purchase its own shares. From whom company will purchase? Existing shareholders. They will give free, na? They will charge the money. So that means company, by paying the amount, they need to purchase. So some cost will be incurred by the company for purchase of its own shares. So therefore, because of buyback, what happens? Company purchasing its own shares by paying the amount. So from company, cash and bank balance will reduce. One thing. Second thing is, once purchased shares are purchased, they will be cancelled. Your share capital will come down. Hello. So basically, what is buyback? What is buyback? Buyback is equal to purchase of own shares. Purchase of what, sir? Own shares with an intention of cancellation. Intention of cancel them. Purchase of own shares with an intention of cancellation is called buyback. Can a company purchase its own shares with an intention of holding them as investment? No, it is prohibited. So here you need to understand, buyback is not an investment option. Buyback is not an investment option. Buyback is not an investment option, sir. Please understand. Whenever a company have surplus funds, they want to invest. They cannot think like this. We have surplus funds. Why unnecessarily we will invest in other company shares, securities? We invest in our own company only. Allowed? Not allowed. Okay. Buyback is not an investment option. Why it is not allowed? Why it is not allowed, sir? Have you think why company cannot purchase its own shares? See, for example, simple, sir. Shares represents ownership. I can give my ownership to somebody else. For example, there is a company which is an artificial person, right? Now, in this company, the ownership is enjoyed by the shareholders, investors, right? Whoever purchasing the shares of the company, they are enjoying ownership, right? Now, suppose company itself wants to enjoy the ownership in its own company. Does it make any sense? Because my ownership, I am an artificial person. That's why my shares I will give to somebody else. They will invest in the company. They will enjoy the control over me. So I purchase my own shares. I will invest in my own company. I will control my own company. Doesn't make any sense. That's why Act says buyback is not an investment option. You cannot purchase your own shares for the purpose of investment in the name of buyback. We don't allow you. You purchase your own shares. At the same time, cancel them. And as a result of buyback, what happens? As a result of buyback, what happens? Tell me. As a result of buyback, what happens? Simple. Your share capital increase or decrease? Reduce. And then your cash and bank balance reduce. Cash and bank balance will reduce. Basically, this is buyback, sir. Hello? So can you tell me what is buyback? What is buyback? Purchase of own shares with an intention of cancellation. That means in buyback, two things will happen. What are those? Purchase, cancellation. Purchase, cancellation. Two things. Buyback is not a investment option. Okay. Now, this is the first concept. We understood what is buyback. Sir, second, what is the objective? Why, sir? Why company will purchase its own shares? Come on. Anybody tell me what is the effect? What is the objective? Objective or advantages of buyback? Why company purchases its own shares and cancel them? What is the advantage? Any advantage first of all? Definitely. The first, there are so many advantages, sir. I am going to give you some important advantages. The first advantage is, if you follow the markets carefully, since you are a finance student, you have to have some basic knowledge about what is happening in India. First thing is, why companies will announce buyback is to support the share price, especially in a depressing market conditions. In a depressed market conditions, to support the share price, company can announce buyback. You know, I think way back, maybe 1.5 years back, Infosys has announced buyback. Why it announced buyback? Because overnight the CFO of the company resigned because of some issues. Now the CFO of the company resigned means there will be some panic. It creates a negative impact. Because of that, the share price started decreasing. It is falling down. So when the share price is continuously falling down, shareholders will be at panic, na? For example, today I purchased one share at 1000 rupees, sir. Okay, within a span of 1 week, the 1000 rupee share price came down to 600 rupees. That means 40% of my money gone. It is a very dangerous situation, right? Now in that situation, the shareholders are already in panic stage, right? How shareholders' faith will be restored on the company? How we need to give assurance to the shareholders? In that situation, company can announce buyback and say to the shareholders that, dear shareholders, don't worry, we are here. Our company will purchase your shares. Each share we will purchase at 800 rupees. Like that company announced. Now the moment the company announced 800 rupees, the company is anyway going to purchase the share price will start to stabilize, na? Shareholders' panic will also reduce. Irrespective of the market price, they can sell the shares to the company at 800 rupees. So that is the reason why companies will go for buyback. So the first reason is, so to protect the company from depressing market condition. I mean, to support the share price in the depressing market conditions. So that could be one of the reasons why companies will go for buyback. So first thing is to support share price in depressing market conditions. So in depressing market conditions, sir, I can support the share price. Company can announce buyback. This could be one reason. Another reason is to increase EPS, to increase earning per share. If EPS increases, what happens? Market price may also increase. So companies may announce buyback to increase EPS, thereby market price. Just now I told, in depressing market conditions, company announced buyback means the price will stabilize. Again, price started increasing. Sir, how increase EPS will happen, sir? Very simple, sir. Suppose, for example, when the price is when the profits are constantly same. For example, see, there are 23, 24, 24, 25. Suppose the profits of the company is 100 lakhs, 100 lakhs, sir. 100 lakhs, 100 lakhs. This is the net profit of the company. And the number of equity shares, sir, number of equity shares, suppose 10 lakhs this year. So therefore, what is EPS? EPS is equal to net profit divided by number of equity shares. 100 lakhs divided by 10 lakhs, 10 rupees is the earning per share. Correct? Suppose next year what happened? Company announced buyback. Out of these 10 lakhs, sir, 5 lakh shares were bought back and cancelled. So therefore, Next year the number of shares is only 5 lakhs. Profit suppose same. So 100 lakhs divided by 5, the EPS is how much? 20 rupees. See this. When the profits are constantly same because of buyback, what happens? Earning per share will increase. What is earning per share? One share, how much profit it has earned. Last year, one share has earned 10 rupees. This year, one share earned 20 rupees. So, EPS increase in. Obviously, when EPS is increased, there is a positive vibration. So, obviously, market price may also increase unless otherwise provided, subject to other conditions. So, why companies will announce buyback? Because to increase EPS. Earning per share, if they increase, automatically market price may also increase. This could be one of the reason. This could be one of the reason why companies can go for buyback. Another reason, sir, to protect the controlling interest of promoters. To protect the controlling interest of promoters. Or discourage hostile bid to take over the company. To protect the controlling interest of promoters, discourage hostile bid to take over the company. Sir, what is this, sir? See, I think one movie, there is one company. In that company, suppose more than 50% shares are held by one family. Remaining 40%, 49% held by outsiders. Now, villain is there. Villain wants to acquire this company. How can he acquire this company? In that family, any one person is there. He is also having some shares. He will tempt him to give more money so that he will transfer his shares to him. So that his share, he will purchase that remaining 49 plus the family member share also he will take. Automatically he will get more than 50% and he will control the company, right? So in order to discourage that, see, discourage hostile bid. Hostile means enemy. Our enemies wants to take over our company, right? Now who is responsible to protect the company? Promoters. Who wants to control the company? Promoters. To protect the controlling interest of promoters or to increase the promoters holding, this buyback will help. This buyback will help. Sir, how this will help, sir? Suppose for example, sir, there is a company A Limited, sir. In this company, number of equity shares, for example, 10 lakhs, sir. In this company, number of equity shares, 10 lakhs, sir. See, in company, there are two groups. You know this. One is promoters group. This is called majority group. One is minority group. They are called small shareholders group. Suppose, sir, in the company, this promoters group is having 60% shares. They are having how much, sir? 60% shares. This minority group is having 40% shares. Hello? 60% shares means how much, sir? 6 lakhs. 40% means 4 lakhs. Say this. In the company. Now promoters want to increase their shares, sir. Promoters want to increase their shares. What company can do is, company announced buyback. Company announced what, sir? Buyback of 3 lakh shares. 3 lakh shares. Company announced buyback of how many shares? 3 lakhs. From whom? Minority group. Minority group. Now once company bought back and cancelled these 3 lakhs, the number of shares will be how many? Number of equity shares after buyback? Originally how many shares? 10 lakhs. In that 3 lakhs bought back and cancelled means 7 lakhs. So therefore now check the promoters group percentage. In these 7 lakhs how many shares they had? 6 lakhs. Their shares remain stacked. That means 85.7. That means 86%. And then minority group. Minority group, if you check, sir, in this 7 lakhs, they are having only 1 lakh. Because previously, before buyback, they had how many? 4. In that, 3 lakhs was bought back and cancelled. Correct? That means they are having roughly 14%. Now see, before buyback, what is their percentage of control? 40. Now 14. Before buyback, promoters percentage 60. Now 86. So in this way, by using buyback, what they can do? They can protect the interest of company. They can protect the controlling interest in the company, or they can increase their holding. Promoters can increase their holding. So, and also they can discourage the hostile bid to take over the company. For example, from this minority group, sir, outsiders trying to acquire the shares to enter into the company. What company can do? Promoters themselves, they can offer to the minority group that please don't sell these shares to outsiders. Instead, you can sell to the company. We are going to offer the price. That's why companies, whenever they announce buyback, sir, they will announce above market price. Suppose the market price is 25 rupees, company will purchase at 40 rupees. That's why buyback price is always more than market price. Because in order to induce the existing shareholders, encourage the existing shareholders, they can sell the shares to the company. So these are some of the reasons why a company can go for buyback. So tell me, if anybody asks you why buyback, what is your answer? No. In examination, only buyback accounting they will test. No need to learn all these things. That's what you tell. You tell me, what is the purpose of buyback? To support the market price of the share, especially in the depressing conditions. Second, to increase the EPS, thereby market price. And the last one, to protect the controlling interest of promoters, or discourage the hostile bid to take over the companies. These are some of the reasons. Okay. Next. So, in our material, sir, we have completed these two things, sir. Buyback, meaning of buyback I completed, sir. Objectives also I completed. And one more reason, sir, one more reason for buyback is pay surplus cash to the shareholders when it is not needed for business. Suppose your company is having so much surplus cash which is not required for business, then what to do? Just announce buyback. Announce buyback, pay the cash to shareholders. So that could also be one of the reason. Now the most important topics I am entering into. What is the third concept? Can you tell me? Sources of buyback. So we completed what is buyback, what is the advantages of buyback. Now let us start the most important thing, that is sources for buyback. Okay, sources for buybacks are important. Sources for buyback. Sir, these sources, next, what are the limits for buyback? You come across all these things in law paper also, sir. You have company law, sir. In that company law, there is a chapter called share capital. In that share capital chapter, all sections relating to capital, share capital will be covered. Again, they will discuss you buyback, bonus issue, okay, and redemption of preference shares. All these things, whatever which will come across in accounts, corporate accounting topics, it will be come across in share capital chapter also. So you can recollect with it. I think right now you came to share capital chapter today only. Okay. So sources for buyback, I think we will discuss it first. But here you need to understand, sir, in accounts we will discuss purely from accounting point of view. What is relevant in accounting point of view, we will discuss it. Law point of view, every procedural aspect is also very important. But accounting point of view, main crux, very important. Accounting point of view we'll learn. Okay. Now tell me, in the Companies Act, sir, they said whenever a company wants to go for buyback, they can depend upon which sources they can use for buyback. So the Companies Act says buyback can be made from free reserves, first thing. Second, securities premium. Third, proceeds from issue of shares or other securities. Important. So whenever a company wants to go for buyback, sir, three sources are available. So buyback can be made from, what are the sources company can use, sir? Free reserves. First source is free reserves. Company can use free reserves, sir. Company can use free reserves. What is free reserves? The reserves which can be used for any purpose without any restriction, those are called free reserves. Free reserves also called as distributable profits, divisible profits are called free reserves, which can be used for payment of dividend are called free reserves. Examples: revenue reserve, capital reserve, P&L account balance, insurance fund, investment fluctuation reserve, dividend equalization reserve. Like that, any reserve which is freely available for distribution of dividend. But there are some reserves which are not freely available, which cannot be considered as free reserves. And also in the Companies Act they have given free reserves definition. In that free reserve definition they are saying that any unrealized notional gains, any unrealized gains, any gains created by revaluation of assets, or any reserves created by change in the value of assets and liabilities, these are not free reserves. Okay, so you can use free reserves for buyback of securities. Free reserves also known as what? Divisible profits or distributable profits. Divisible or distributable profits, that means the profits which is available for payment of dividend. Divisible profits, distributable profits, the profits which is available for payment of dividend. Okay, buyback can made from any one of these sources. Sir, these are all only one: free reserves, divisible profits, distributable profit. Please understand. Second source a company can use is securities premium. Securities premium they can use for buyback. Sir, generally, sir, securities premium, you know, it has its own restrictions. It cannot be used for all the purposes. But for redemption of preference shares, securities premium can be utilized. And this is the only chapter where you see whenever there is a free reserves, there is a securities premium also. This is the only chapter securities premium is treated at par with free reserves. Understand, important. So company can use free reserves or securities premium. Next, the most important thing is proceeds from issue of any shares or other securities. Other securities. Proceeds from issue of any shares or other securities. You can use proceeds from issue of any shares or securities. What is the logic behind it? Why they are giving this option also? Suppose simple, sir, if you have existing profits, you can use. If your company is having existing profits like free reserve, securities premium, you can use it. Suppose if you don't have this or inadequate, no problem, you can make a fresh issue. Whatever the amount came from fresh issue of any shares or other securities, use it for buyback. Suppose I want to construct an house, sir. If I have savings, I will use it. If I don't have savings, I will borrow. Same happens with company. If company is having already profits, they will use it for buyback. If they don't have profits, they will make now fresh issue. Whatever the amount came, that amount they will use for buyback. These are called sources for buyback. Now, very, very important point, sir. Here, I'm going to explain. Source means what, sir? Source means the profit, the place where the particular amount has been generated is called source. Now, for every business, the source is what? Business activity, profits. That's why first they have given profits. If these are not available, what are the options you had? you can take borrowings from outside India, or you can issue shares. But they are saying only issue of shares is allowed. Taking bank loan and all those not allowed. So therefore, either you use free reserves or securities premium, or you depend upon fresh issue of any shares. Sir, can I take bank loan and make it buyback? You depend upon this proceeds of any fresh issue of any shares or other specified securities. So these are the sources I can use, sir. 3 sources I can depend upon for buyback of securities. Now, important point here, sir. They said when you are buying back equity shares, we can issue preference shares, not equity shares. That means the proceeds collected from the same kind or same type of shares which you are buying back cannot be utilized for buyback. For example, if I am buying back equity shares, I can issue preference shares. Whatever the amount came, that I can use for equity shares buyback. But I can't issue same kind of shares. For example, issue shares, equity shares are issued. Whatever the amount collected, that amount I am using for payment of buyback of equity shares. That is prohibited. It doesn't make any sense, right? On one hand, you want to cancel equity shares. On the other hand, you are issuing equity shares. Not fair. That's why Companies Act says, no, nothing doing. Proceeds from earlier issue of the same type of shares cannot be utilized for redemption of the same type of shares. So therefore, here you need to understand, sir, if the company is buying back equity shares. So in this, here you need to understand this point. If buyback is equity shares, if buyback is equity shares, if buyback is equity shares, what company can do? We can issue preference shares. We can issue preference shares. Okay? But the most important point is issue of same kind of shares. Issue of same kind of shares not allowed. Issue of same kind of shares not allowed. Please understand. If company wants to buy back equity shares, we can issue preference shares. Issue of same kind of shares not allowed. Suppose if company wants to buy back equity shares, can they issue equity shares? Can they issue equity shares and the proceeds collected from equity shares, can they use for buyback of equity shares? No. Buyback is, if buyback is of equity shares, we cannot issue equity shares. We can issue preference shares. So proceeds from the earlier issue of the same kind of shares cannot be utilized for buyback. So tell me, what are the sources for buyback? 3 sources. What are those? Free reserves, securities premium, proceeds from issue of any shares or other securities. See here, they said any shares or other securities, right? Other securities means ESOP, employee stock options, and any other securities as notified. But till now they have not notified anything. If anything is notified, that will be considered here. See here, important, sir. You see this free. What are the sources we can use for buyback? First one, free reserve. Second, securities premium. Third, proceeds of an issue of any shares or other specified securities. No buyback of shares or securities can be made from the proceeds of an earlier issue of the same type of shares or securities. For example, equity shares cannot be bought back using proceeds of equity shares. Specified securities include ESOP, employee stock options, and other securities as notified by central government. Now look at this important definition, free reserves definition. Important. What is free reserves as per the Companies Act? Definition, see this. Free reserves are reserves available for distribution as dividend as per the latest audited balance sheet. As per the latest audited balance sheet, excluding, everybody please listen, excluding. So free reserves exclude, what they exclude, sir? Unrealized gains. See this, anything not realized, unrealized gain. Foreign exchange gain, for example, unrealized gain. Unrealized gain. Or notional gains. What is notional gain, sir? Notional. we imagined, assumed, not actual, imaginary gain. Asset revaluation, sir, when you do the revaluation, we will get revaluation reserve. That one, they are all excluded. Even if show as reserves, even if they are appearing as reserves and surplus, they are not reserves and surplus. Unrealized gain, for example, capital reserve. You know, one standard called AS 10, PP. When PP is derecognized from the books, we will compare the carrying amount. Whatever the carrying amount is there, that carrying amount we will compare with the sale disposal proceeds. And I mean NRV, net realizable value. If NRV is more than the carrying amount, we call it as what? Gain. So, but that gain is only what? Unrealized gain. We are not selling it. Notional gain, unrealized gain. So any capital reserves generally which they are not realized in cash, unrealized gains, don't consider it as a part of free reserves. And also you see, any changes in the carrying amount of assets and liabilities recognized in equity, including profit and loss account surplus from fair value measurement. Sir, any assets and liabilities, change in the carrying value of the assets and liabilities recognized in equity, including profit and loss surpluses from fair value measurement. Sometimes, you know, we will measure the assets and liabilities at their fair value. Fair value, kind of fair value measurements will do. In that process, the assets value may increase or decrease, liabilities may increase or decrease. Because of that, the difference will transfer to reserves, right? Those reserves also will not be included in free reserves. So free reserves means what? The reserves which are available for distribution of dividend, but exclude these things. Any reserve, unrealized, notional, asset revaluation reserve should not be included. Any reserve created by change in the asset and liabilities value because of the fair value measurement. We need to measure the assets and liabilities at their fair value, because in that process any change in the asset value, liability value came, that is transferred to reserves. That is also not a free reserves. Remaining and all free reserves only, which is available for distribution of dividend. Like for example, I told now, P&L account balance, general reserve, revenue reserve, insurance fund, even workman compensation fund also. Workman compensation fund is there. Suppose if the workman compensation fund generally created for what purpose? Employees purpose, right? Workers. Now after meeting the obligations, if any balance is left now, that can also be what? Free reserve, which can be used for distribution of dividend. Insurance fund like that one reserve is there, that can be. So anything, you need to see whether that reserve is available for distribution of dividend or not. For example, some reserves we create, for example, dividend distribution reserve, not dividend distribution reserve, debenture redemption reserve, DRR. DRR is not a reserve which is available for distribution of dividend. Therefore, we cannot utilize it. Similar, in chapter number 1, we have seen, sir, so many reserves. Capital reserve. Capital reserve, is it a free reserve? No, because generally capital reserves are unrealized, notional gains. Therefore, they cannot be. If they are realized in cash, that means if they are freely available for distribution of dividend, then they can be considered as free reserves. But in CA materials and all, nowhere they have considered capital reserve as free reserves, because their intention is that these capital reserves basically are unrealized gains. They are not freely available for distribution of dividend. That's why they have not considered. And also employee stock option outstanding account, that is also one reserve. Can it be a free reserve? No, because which is not available for distribution of dividend, which is adjusted to the employee benefit expenses. So like this. Okay, so this is free reserve, sir. So ultimately, what is the conclusion, sir? Whenever a company wants to buy back, what are the sources company can use? 3 reserves are available. What are those? Free reserves, securities premium, proceeds from issue of shares or other securities. This proceeds from issue of shares and securities, any restriction? Yes. What is the restriction? If I am buying back equity, can I issue equity shares? No. Same type of shares cannot be issued. If I am buying back equity, means I can issue preference shares. Hello? These are sources of buyback. So we completed 3. And what is the next topic, sir? Limits for buyback. The most important topic is limits for buyback. Okay, sir. In buyback, next concept is limits for buyback, sir. So far we have covered what is the meaning of buyback, why companies will go for buyback, and then we have seen sources for buyback. The next concept is what, sir? Limits for buyback. See, in the Companies Act, if you see, there are number of provisions relating to buyback, sir. Out of those provisions, sir, there are 3 provisions which are very much relevant for accounting purpose. Those 3 provisions we call them as limits for buyback. And in buyback of securities chapter, sir, 2 types of questions can be asked. One type of question is, they will give you balance sheet of a company, sir, and they will say this company is going for buyback, and they will ask you whether buyback is within the limits or not. They will ask you to check whether the buyback is within the limits or not as per the Companies Act. Second type of questions, they will give you buyback, companies going for buyback. They will ask you to pass the journal entries for buyback and also prepare the balance sheet of a company after the buyback is completed. Now, limits for buyback we will see, sir. I told you, no, sir, maximum permissible number of shares to be bought back. Maximum permissible number of shares to be bought back as per Companies Act 2013. Maximum permissible number of shares to be bought back as per Companies Act 2013 is least of the following 3 tests. Maximum permissible number of shares to be bought back as per Companies Act is equal to least of the following 3 tests, sir. So you need to see these 3 tests, you need to apply these 3 tests, and what is the maximum number of shares to be bought back is least of the 3 tests, least. That is the maximum permissible number of shares to be bought back. Okay. What are these 3 tests, sir? 3 tests, or we can call it as 3 conditions also. First test number 1, sir, resource test. Test number 2, shares outstanding test. Test number 3, debt equity ratio test. Debt equity ratio test. Now find out the number of shares to be bought back by each test. See whichever is least, that is the maximum number of shares to be bought back. Based on that, you decide whether the company buyback is within the limits or not. Okay. Now let us discuss each test, sir. First test number 1, resource test. Resource test. Resource test, sir. Sir, what is resource test says? Resource test is talking about the amount. The Companies Act says the maximum amount that can be used for buyback cannot exceed 25% of paid up share capital plus free reserves. Whenever a company wants to go for buyback, na sir, what is the maximum amount they can use for buyback? There is a restriction. The Act says the maximum amount that can be used for buyback cannot exceed 25% of paid up share capital plus free reserves. The maximum amount the maximum amount that can be used for buyback cannot exceed how much, sir? Cannot exceed 25% of paid up share capital plus free reserves. 25% of paid up share capital plus free reserves. Paid up share capital means equity and preference, both. Equity and preference. Equity share capital, preference share capital, both will be considered. And free reserves. Here free reserves means free reserves including securities premium. You need to understand that. So the maximum amount that can be used for buyback cannot exceed 25% of the paid up share capital plus free reserves. For example, 25% of your paid up share capital is 100 lakhs, your free reserves is 50 lakhs. So total 150 lakhs, correct? 150 into 25%, 37.5 lakhs. See, this is the maximum amount I can use for buyback, 37.5 lakhs. That means 37 lakh 50,000. Suppose each share is bought back at 20 rupees. Buyback price 20 rupees, sir. So 37 lakh 50,000 divided by 20. How much, sir? 1 lakh 87,500 equity shares company can be bought back by following resource test. The maximum number of shares that can be bought back is how many? 187,500. How you got 187,500? What is the maximum amount available divided by buyback price? This is first test, resource test. Test number 2, sir. Test number 2, which is shares outstanding test. Shares outstanding test. Shares outstanding test. Shares outstanding test. See, this test says, shares outstanding test says, if you are buying back equity shares, it cannot exceed 25% of the paid up equity share capital of that financial year. Shares outstanding test says the maximum number of equity shares that can be bought back cannot exceed 25% of the paid up equity share capital of that financial year. Wordings are very, very important. This test says the maximum number of equity shares that can be bought back cannot exceed 25% of equity paid up share capital. 25% of paid up equity share capital of that financial year. That means this condition is relating to what? Equity shares. So that means if your company is buying back equity shares, the maximum number of equity shares that can be bought back, it cannot exceed 25% of the paid up equity share capital of that financial year. Hello? Suppose, for example, your equity share capital, your paid up equity share capital is, suppose 1 lakh equity shares of rupees 10 each. Okay? That means total paid up equity share capital is 10 lakhs. Hello? Now how many shares company can bought back? Maximum 25%. That is 25,000 equity shares of rupees 10 each. How much it is? 2,50,000. These are the maximum number of shares a company can bought back. See, you can find this in two ways. Directly number of shares into 25% you apply, or paid up equity share capital 10 lakhs is there now. On this 10 lakhs apply 25% divided by face value you do. 10 lakhs is the total paid up equity share capital into 25% divided by face value 10. Sir, here the face value 10. So therefore how many shares, sir? 25,000. Both are same only, sir. Either on number of shares you apply 25% or total paid up equity share capital into 25% divided by face value. So this is the maximum number of shares that can be bought back. Equity shares. Hello. This is test number 2. Are you understanding? Tell me what are the 3 tests. First test, resource test, which talks about amount. What is the maximum amount that can be used for buyback? 25% of paid up share capital plus free reserves. Shares outstanding test. Maximum number of equity shares to be bought back cannot exceed 25% of the paid up equity share capital of that financial year. And the last test, sir, debt equity ratio test. Debt equity ratio test. Debt equity ratio test. Debt equity ratio test. See, this test says, sir, debt equity ratio test, debt and equity ideally should be maintained in 2:1 ratio. Debt to 2 rupees means equity should be 1. This ratio cannot be disturbed because of buyback. That means after buyback, if I check now, the company's debt to equity should be in 2:1 ratio. Suppose if debt is 1 rupee, equity should be 50 paise. If debt is 10 lakhs, equity should be 5 lakhs. So by maintaining this ratio, how many shares you can buy back? That is test 3. You need to maintain 2:1 ratio. So therefore they say after buyback, debt equity ratio cannot exceed 2:1. Cannot exceed 2:1, sir. Cannot exceed 2:1. That means this ratio you need to maintain. By maintaining this ratio, how many shares you can buy back? See here, debt means what? Secured plus unsecured. Both kind of debts you need to take. Secured, unsecured. Equity means what? Equity means not just equity share capital. Equity means paid up share capital. Paid up share capital plus free reserves, including securities premium. Including securities premium. Paid up share capital plus free reserves, including securities premium. So make sure that after buyback the debt equity ratio cannot exceed 2:1, sir. This ratio you try to maintain it. So therefore you need to understand, sir, these are the 3 tests you apply, sir. For example, as per test number 1, the number of shares to be bought back, suppose 50,000 came. Test number 2, the number of shares to be bought back, 60,000 came. Test number 3, the maximum number of shares to be bought back, 30,000 came. So tell me, what is the maximum permissible number of equity shares to be bought back? 30,000. Least 50, 60, 30. Which is least? 30. So 30,000 is the maximum number of shares to be bought back. Suppose company wants to buy back 25,000 shares. Is it within the limits? Yes. Suppose company wants to buy back 35,000 shares. Is it within the limits? No, it's not within the limits. So these are the type of the questions they will ask. They will ask you whether the buyback is within the limits or not. In that case, you need to apply these 3 tests. Under each test, find out the maximum number of shares to be bought back and compare all 3. Whichever is least, that is the maximum number of shares to be bought back. Compare with the number of shares which is bought back by the company, and if it is within the limits, buyback is allowed. Otherwise, buyback is not allowed. Now if buyback is allowed, what is the accounting treatment we need to do? We need to understand. You understand these three conditions? These are called limits of buyback. Resource test, shares outstanding test, debt equity ratio test. Resource test talks about amount, which says the maximum amount that can be used for buyback cannot exceed 25% of the paid up capital plus free reserves. Shares outstanding test talks about the number of equity shares to be bought back should not exceed 25% of the total paid up equity share capital of that financial year. Debt equity ratio test says after buyback, make sure that your debt and equity should be maintained in 2:1 ratio. And sir, if you check the Companies Act, sir, limits of buyback I have given here. Resource test, shares outstanding test, debt equity ratio test. There are other legal provisions also. Maximum number of shares to be bought back list. Other legal provisions also which we come across in Companies Act. There are so many other legal provisions. Like for example, articles permission should be there. And special resolution is required. For whenever a company wants to go for buyback, special resolution is required. Whenever a company wants to do buyback is 10% or less of paid up equity, capital and free reserves, then board of directors approval is sufficient. These are all relevant in law paper, not in accounts paper. Hello. And you will come across all these provisions in company law. Next, one more important point, only fully paid up shares or can be bought back. Fully paid up shares only bought back. And shares and securities must be listed on recognized stock exchange, must comply with SEBI regulations. Suppose if you are a listed company, you need to follow the SEBI guidelines for buyback. And also buyback should be completed within 12 months from date of passing the resolution or board resolution. And buyback, whenever a company wants to bought back shares, from which source the company can buy back? From proportionately from the existing shareholders, or from open market, or from securities issued to employees under stock options or sweat equity. So whenever a company wants to buy back its own shares, from where it will buy back? From the existing shareholders, or from open market, or from employees to whom shares are issued under employee stock options. From them we will purchase. And whenever a company is going for buyback, they need to give one declaration of solvency to ROC, register, and to SEBI. And securities must be extinguished, physically destroyed within 7 days of completion. See this. Once the shares are bought back, within 7 days, the shares must be completely cancelled. And next 6 months, no further issue of the shares. Suppose you bought back completed na, once buyback is over, same type of shares cannot be issued for the next 6 months. Of course, there are some exceptions like bonus, fulfilling existing obligations, that is allowed. This is called cooling off period, cooling off period. That means next 6 months you cannot issue same type of shares. And you need to file one return with ROC, SEBI. And fine of 1 lakh to 3 lakhs for non-compliance will be paid. Not required, sir. Sir, you remember these three limits. That's more than sufficient. For accounting point of view, these three. Remaining conditions, articles approval should be there. Articles authorization should be there, special resolution, board resolution, SEBI guidelines, declaration of solvency. These are all relevant for law. Okay, but of course we have seen them in company law. All these provisions you will come across again, but the accounting point of view you need to focus on these things. One more point, the most important point you need to focus is CRR. See, remember the order which we are discussing. So what is buyback? Done now. Next object is done now. Sources done now. Next limits for buyback you understood. Now the last one, CRR concept. Let us understand the CRR concept. Very important concept. Whenever you are going for buyback, you need to take into consideration the concept of CRR, capital redemption reserve. Please learn this concept, everybody. Capital redemption reserve. Okay. First of all, why CRR will be created? Why CRR will be created? If that question came into mind, na sir, the answer is there are two purposes for creation of CRR. There are two reasons for creation of CRR. How many reasons? Two. The first one is capital intact. Capital intact. This is the first reason, capital intactness. Second is protect the interest of creditors. To protect the interest of creditors. to protect the interest of creditors. These are the two reasons for which the company will create CRR, to protect the interest of creditors and capital intactness. Okay. Now, why law is saying you need to create CRR? Sir, first of all, in the Companies Act, there is one provision, sir. That provision is, whenever a company is buying back its securities by using free reserves or securities premium, then to the extent of the nominal value of shares so bought back must be transferred from free reserves to CRR. See, we have discussed one concept called sources of buyback. What are the sources of buyback? Can you tell me? Three sources are there now. What is the first source? Free reserves. Second one, securities premium. Now, Act says whenever buyback is happened from the existing profits to the extent of the nominal value of shares so bought back, to the extent of nominal value of shares so bought back must be transferred from free reserves to CRR. You need to do. This is what is there in the Companies Act. I will show you. Companies Act provision. See this. Companies Act provision says, section 69, when a company buy back shares using free reserves or securities premium. Important. When a company buy back its shares by using free reserves or securities premium, a sum equal to nominal value of shares so purchased shall be transferred to the capital redemption reserve account, which is disclosed in the balance sheet. Hello? Sir, when CRR will be created? When CRR will be created? When company done buyback by using free reserves or securities premium. Suppose when a company went for fresh issue, no need to create CRR. Hello? That means they are saying very clear that whenever you have done buyback by using the existing profits, free reserves or securities premium, then to the extent of the nominal value of shares so bought back must be transferred from free reserves to CRR. Now what is this? Why, sir? Why? What is the logic, sir? Whenever you are using the free reserves or securities premium, you are saying to the extent of the nominal value of shares so bought back must be transferred from free reserves to CRR. Why? First reason is capital intactness, sir. Sir, tell me, suppose redemption of suppose buyback happened, sir. What happened? Buyback. Tell me what is the consequence of buyback? Simple. Share capital will come down. So that means there is a scale down of capital. Hello? Scale down of capital. Your capital is reduced because of buyback. Everybody? Now when this capital is scaled down, sir, is it a positive thing or negative thing? Negative. Suppose for example, think about an outsider. Suppose a company is doing business with 100 lakhs capital. Now out of these 100 lakhs, 20 lakhs capital was bought back and cancelled. Now the revised capital is 80 lakhs. What outsiders will think? The scale down of capital happened. 100 has become 80. That means this company is doing business with less capital. So there is a negative thing may create. So in order to maintain the capital intact, the Act says, okay, what is the nominal value of debentures? What is the nominal value of shares you bought back and cancelled? 20 lakhs, for example. To that extent, you create from free reserves to CRR. That means, see this. Whenever there is a scale down of capital, sir, the capital was reduced. Now, how can I fill the gap which is created? So that gap, whatever created, scale down of capital happened, now I need to again fill it up. How can I fill share capital, sir? There are two ways. One way is fresh issue. When I go for a fresh issue, share capital will increase. Fill it up. Second way, when I don't want to go for a fresh issue, what I can do? I can issue bonus shares. Either I have to issue shares for money, share capital will come. Or there is another way to increase the share capital. What is that? Bonus. Now from which source bonus will be given? That's why they say you create one reserve called CRR. This CRR you utilize it for fully paid bonus shares. That means from first the existing free reserves transfer to CRR, then CRR is utilized for issue of bonus shares. So whatever the capital reduced, it will create. The capital reduced now will replace. That's why capital intact. That's why capital intact. So whatever be the nominal value of shares, for example, my free reserves are there 100. In this 100, I need to transfer to CRR. For example, the nominal value of shares bought back is 20. So from free reserves to I transfer to CRR. Now CRR again will become what? Equity share capital. That means because of buyback, share capital reduced. For example, share capital 20 reduced, nominal value. Now whatever the share capital reduced, to that extent I transferred from free reserves to CRR. Now the CRR I am using for issue of fully paid bonus shares. That means capital created. So whatever the capital reduced, now it is replaced. Hello. This is the logic behind CRR. Why Companies Act is saying to the companies that you create CRR? They are saying whenever you are using your existing profits, free reserves or securities premium, your capital will reduce, scale down of capital. In order to maintain your capital intact, do one thing. What extent capital reduced, to that extent your free reserves or securities premium transfer to a separate reserve called CRR. Again use the CRR to give fully paid bonus shares. So that whatever the capital reduced, it was replaced. So because of the scale down of capital, whatever the negative impression created, that will be eliminated. That will be eliminated. This is the first reason, sir. Capital intact. You understand capital intact? Because of buyback, what happens? Tell me step by step. Because of buyback, what happens? Capital will come down. Scale down of capital. Now I want to replace it. What are the ways to replace a capital? Either I can make a fresh issue or I can issue bonus shares. How can I issue bonus shares? I need to create one source for issue of bonus shares. For that purpose, I created what? CRR. CRR is created from free reserves. Why I create CRR? Because of the Companies Act, which says you used your existing source, right? To the extent of the nominal value of shares you bought back by using this free reserves, you transfer to CRR. Now CRR again will become share capital, so that your capital will be replaced. So scale down of capital effect will be eliminated. This you do only when you depend on free reserves or securities premium. That means you are not going for fresh issue. When you go for fresh issue, what happens? Automatically share capital is created. No need to create CRR again. When you go to fresh issue, bank to share capital again will be created, na sir? Sir, when company makes a fresh issue of shares, bank to share capital is automatically created, na sir? Then again, why? What is the need to create CRR, sir? No need. That's why CRR is required to be created only when you depend upon your existing sources. You are not going for fresh issue. When you are going for fresh issue, automatically two things. Your funds will be arranged, at the same time your share capital will be created. Sir, can I do like this? For example, here 20 lakhs worth of shares we are buying and cancelling, nominal value. We are going for a fresh issue of 10 lakhs. Remaining 10 lakhs, you create CRR. Only to the extent the gap is filled by fresh issue, leave it. Remaining balance you create CRR. So logic is, what is the nominal value of share capital reduced? The same capital again has to be filled up. How you are going to fill? By fresh issue or bonus issue? You decide. Fresh issue you want to create part, another part I want to create by bonus. Okay. To that extent, first you separate the funds from free reserves to CRR, then CRR to fully paid bonus shares. That's why in the Companies Act, sir, you know, they have given this point also. See this. The capital redemption reserve can be used to issue only what? Fully paid bonus shares. This point is also there in the Companies Act. That means the intention of the Companies Act is very clear. Create CRR, use that CRR only for fully paid bonus shares. That means CRR is sitting in the balance sheet idle. It is waiting for its partner. Who are the partner? Who is the partner of CRR? Bonus issue. CRR does not have any other purpose. It will simply sit ideally in the balance sheet. It cannot be utilized for any purpose. The only purpose CRR created is what? Bonus shares. Hello. Like in Bahubali movie, Anushka is waiting for Prabhas. Like that. In the balance sheet, CRR is waiting for bonus shares. When company announced bonus, CRR will be utilized. Hello. That's why in many problems what they will do now, once after buyback is happened, na, company will announce bonus. Because of buyback, CRR will be created. That CRR they will use for bonus issue. Now, so the intention of the lawmakers is very clear, sir. They want, because of buyback, there is a scale down of capital. Now you fill it up. If you are going for a fresh issue, no problem. Automatically capital will be filled up. If you are not going for fresh issue, you yourself have to fill the gap in the capital. How? By transferring certain funds from free reserves to CRR, CRR to share capital. Got it or not? This is the first reason. Second reason, even more beautiful reason. What is it? Protect the interest of creditors. Now, why I need to protect the interest of creditors? Can anybody tell me? Creditor means what? The party to whom the company has to make the payment. Now, when company bought back the shares, he is not happy. Why he is not happy? Creditor is not happy. Because he is worried whether my amount will be paid or not. Whether company will have sufficient funds to pay my amount or not. Because he is creditor, right? He wants the company should have enough funds to make him the payment. But now company using funds for what? Buyback. That means company using funds for shareholders. He is not happy. Creditor is not happy. Now I need to protect the interest of creditor also. As a lawmakers, they want to protect the interest of creditor. For example, you are creditor, sir. I am company. These are my shareholders. Now I am going for buyback. That means I am purchasing the shares. I am paying the amount. When I pay the amount means existing reserves I am using now. Cash reserves I am using. Maybe I will sell the investments. I will, whatever the funds I will got, I will use them to purchase the shares. So as a creditor, are you happy? No. Why? You may not happy or unhappy, but you somewhere you concerned. Company is using funds for buyback. What about if company went into liquidation? Maybe whether company will have sufficient funds for me to pay the amount or not. That's what they bothered, right? To protect the creditors, they said create CRR. Why creation of CRR will protect the interest of creditors? Yes. Why? How, sir? How it will protect the interest of creditors? Simple. Sir, in creation of CRR, what we are doing, sir? Some free reserves we are transferring to CRR. That means free reserves is basically available to whom? Shareholders, equity shareholders. Now out of those free reserves, some of them I am restricting, right? And I am giving in the form of bonus. That means to the extent of the profits I am using for bonus, I may not require to pay any dividend amount. That means cash reserves of the company will be saved for future. For example, my free reserves 10 lakhs. In that 5 lakhs I am transferring to CRR. That means the available free reserves are only 5 lakhs. Na? So in future, this 5 lakhs, whatever I am transferring to CRR, I may not require to pay dividend to the existing shareholders. When in future, when the dividend is not paid for the restricted funds, creditors are happy. So creditors' interest is protected. Hello. When the existing funds of the shareholders was restricted for payment for dividend in future, because I am transferring to CRR. Transferring to CRR means there are no more free reserves. There are no more free reserves. Of course, they will be given in the form of bonus. Bonus does not involve cash outflow. Sir, bonus does not involve cash outflow. That means company point of view, cash is not going out for bonus issue. So creditors' interest is also protected by creating CRR. Because creditors' point of view, what they think is, okay, company is bought back its shares, funds are using, okay. But whatever the funds we are using, whatever the capital we are redeeming, to that extent we are reducing from free reserves. That means we are reducing the distributable profits of the shareholders. To that extent, company may not require to pay any amount, there is no outflow of cash in the form of dividend to the shareholders in future. That's why creditors' interest is now protected. How many of you understood the logics? Please raise your hand. You understood? Now onwards, can you help your juniors? Sir, I will help only myself. I can't help my junior. So tell me, why CRR is created? Two reasons. What are the two reasons? Capital intact, protect the interest of creditors. These two things I can achieve only by doing one thing. What is that? Create CRR from free reserves. Free reserves to CRR. What amount? Nominal value of shares bought back. Nominal value of shares so bought back must be transferred from free reserves to CRR. So therefore, I will create CRR and I will use it for equity shares. I mean bonus shares. And you need to understand, guys, this CRR is utilized only for issue of fully paid bonus shares. Fully paid bonus shares. So creditors' interest will be protected, sir. At the same time, capital will be intact because of the CRR. So I am restricting the free reserves of the shareholders by transferring to CRR. This CRR I am converting them as a share capital. So therefore, in future, the outflow in the form of the profits available to the shareholders will automatically reduces. So creditors' interest is protected. And capital was also intact. So the same thing that what I have given, sir. And sir, sometimes, sir, important, sir, suppose a company is going for buyback, sir. Company is going for buyback. The buyback price, I told you, it is more than face value. So that we call it as what? Premium on buyback. That premium on buyback we can adjust with free reserves or securities premium. So premium on buyback, what we can do is, we can adjust against free reserves or securities premium. But remember, guys, revaluation reserves cannot be used for buyback. Revaluation reserves cannot be used for buyback. Okay. Now, let us see the accounting treatment, sir. I think we have completed the first part, sir. So you understand the first part, buyback theory. Let us quickly recapitulate the 5 points. What is buyback? Purchase of own shares with an intention of cancellation is called buyback. What is the object of buyback? To protect to support the share price, especially in depressing market condition. To increase EPS, thereby market price. To protect the controlling interest of promoters. To discourage the hostile bid to take over the company. What are the sources of buyback? Free reserves, securities premium, proceeds from issue of shares or securities. But when you are buying back equity shares, you cannot issue equity shares. You can issue preference shares. What are the limits for buyback? 3. Maximum number of shares to be bought back is least of the 3. What is the first test? Resource test, which talks about amount. What is the maximum amount can be used for buyback? 25% of the paid up capital plus free reserves. Second test, shares outstanding test. This test talks about maximum number of equity shares to be bought back, which cannot exceed 25% of the total paid up equity share capital of that financial year. What is the third test? Debt equity ratio test. Your debt and equity cannot exceed 2:1. Debt equity should be maintained in 2:1 ratio. After buyback, it cannot exceed 2:1. CRR. At the time of buyback, we need to create CRR. When we need to create CRR? When company is depending upon the free reserves or securities premium. To the extent of the nominal value of shares so bought back must be transferred from free reserves to CRR. When we depend upon the fresh issue, to that extent no need to create CRR, because the object of CRR is capital intact, protect the interest of creditors. For that purpose, what companies will do? From free reserves, the amount is transferred to CRR. Once they transfer to CRR, that CRR amount will be utilized only for fully paid bonus shares, so that the capital will be intact and at the same time creditors' interest will be protected. And this is the first part of the buyback. Second part we will see, sir. What is the second part, sir? Accounting for buyback. So let's complete the accounting for buyback also. Okay, sir. The second part is accounting entries. Okay, suppose a company is going for buyback, sir. What are the entries we are going to write? First, for buyback of shares. Tell me, whenever a company bought back shares, what is the entry they will write? See, there are different ways it can be presented. First, I will tell you one way and I will tell you alternative also. Whenever a company bought back shares, the entry is equity share buyback account debit. Equity share buyback account debit to bank account. This is the entry I will write. I will open an account called equity share buyback account and I will transfer the funds. So equity share buyback account debit to bank account. First buyback entry. Equity share buyback to bank. Now once buyback is happened, next step is what? First buyback, then issue. What issue here? Buyback and then cancellation. You are not using your brains. In buyback, what happens? We purchase our own shares and then cancel. For cancellation. For cancellation of bought back shares. When company cancelled the shares bought back, what is the entry for cancellation of shares bought back? Tell me, when shares are cancelled, what happened? Your equity share capital will be reduced. So it will be debited. Correct? Equity share capital account debit. And you will pay premium sometimes. So premium on buyback account debit to equity shares buyback account. You opened one account, right? Equity share buyback account. That account will be cancelled. So therefore, equity share capital account debit, premium on buyback account debit to equity share buyback account. So tell me, what is the net entry, sir? Net entry is equity share capital account debit, premium on buyback to bank. That's it. That means because of buyback, our capital will reduce, equity share capital account. If you pay any extra amount, premium to bank account. Sir, equity share capital is debited with what amount? This is always debited with face value of shares bought back. Shares bought back. Face value of shares bought back we need to take, sir. Face value of shares bought back. How many shares you bought back into face value? Equity share capital is debited only with the face value. And any premium you paid, na sir, that will be transferred here. Premium on buyback. Number of shares bought back into premium per share. Hello? See, this is the premium amount. Premium amount is debited to this account. Everybody? So first shares buyback happened. After buyback, cancellation. Next entry, sir. For adjustment of premium. For adjustment of premium on buyback. For adjustment of premium on buyback. This premium I told na sir, whatever the premium we are paying na sir, that premium we will adjust. Adjust against securities premium. Securities premium we will adjust, sir, or else free reserves we will use. If securities premium not available or securities premium is not there, free reserves we can use. Some students will have a doubt, sir, security premium already there, sir, can I use free reserves? Yes. Securities premium only should be utilized, nowhere it is there in the Companies Act. But ideally the situation is that you use first securities premium. Why? Because securities premium will have only limited purposes. Free reserves can be used for any purpose. So any person who is having head above the shoulders, he will use first securities premium only. Because he knows that securities premium will be used only for limited purposes. So securities premium account debit, free reserves account debit to premium on buyback. Premium on buyback account. Okay. Next pa. Any other entry? Any other entry in buyback? Most important entry that you should not forget. For transfer to CRR. Hello? For transfer to CRR, what is the entry? Free reserves or securities premium account debit to CRR account. Correct? Free reserves or securities premium to CRR. When will you write this entry? When company is not going for fresh issue, or when company is going for part of the amount only fresh issue. That means remaining amount existing sources. Correct? So what is the nominal value of shares to be bought back? In that nominal value, how much is gap filled by fresh issue? Remaining is creation of CRR. You need to create CRR. So free reserves or securities premium to CRR. This is created to the extent of what? Face value or nominal value of shares bought back. Correct? Shares bought back. To the extent of the nominal value or face value of the shares bought back. These are the entries, sir. So tell me, sir. First entry, buyback. When buyback happened, what is the entry? Equity share buyback to bank. Next, bought back shares cancelled. Equity share capital account debit, premium on buyback to equity share buyback. Next, adjustment of premium. Securities premium or free reserves account debit to premium. And finally, transfer to CRR. Free reserves or securities premium to CRR. Okay. Now, some books, how they will write the entries. Whenever buyback happen, they will write like this. No need to write, just remember. They will write equity share capital account debit, premium on buyback account debit to equity shareholders account. They don't open equity share buyback account. They will write directly to equity shareholders account. And then they will make the payment equity shareholders to bank. First, whenever buyback happened, they will write equity share capital account debit, premium on buyback to equity shareholders to bank account. And this premium adjustment to transfer to CRR common. Everybody will write in the same manner. See, this I have given in the material itself. See this. Whenever a company went for buyback, see this. Amount due on buyback, see this. Equity share capital account debit, premium account debit to equity shareholders. And when the payment is made, equity shareholders to bank. So this is the due entry, this is the payment entry. Hello? And this premium adjustment entry is this. Securities premium, P&L account, general reserve. Free reserves or securities premium. Transfer of divisible profit to CRR to the extent of the nominal value of shares so bought back. Free reserves account debit to CRR account. Okay. So these are the 4 entries. You can write in this manner also. Whenever amount due on buyback, equity share capital account debit, premium on buyback to equity shareholders. Whenever you make the payment, equity shareholders to bank. Instead of opening this equity shares buyback account, this account I opened. First I opened, then I cancelled. Net effect is same only, any method you select. Net effect is what? Equity share capital, premium of bank. There, instead of equity share buyback, they are opening equity shareholders account. These 2 entries are common. Adjustment of premium, transfer to CRR, these 2 are very common. Hello? And one more thing, sir. Whenever a company is going for buyback, sir, what happens sometimes is the shares may be partly paid up. I told you, can partly paid up shares be bought back? No, the shares must be fully paid. So therefore, first existing any partly paid up shares are there, they will be called up. Whenever call is made, what is the entry? Equity share final call account debit to equity share capital. When the amount is received, bank to share final call. So this equity share final call to equity share capital, bank to equity share final call. And sometimes company may issue fresh issue for buyback. Whenever a new shares are issued, bank to preference share capital or securities premium. Because generally when a company is going for equity shares buyback, they can issue what? Preference shares. So that's why bank account debit to preference share capital account debit to securities premium. And sale of investment. Sometimes company, what they will do is they will sell their existing investments to arrange the funds for buyback. Now in that situation, bank account debit to investments they will write. Any profit or loss will be transferred to P&L account. So therefore see, major 4 entries, sir. Buyback entry, cancellation entry, adjustment entry, transfer to CRR entry. Apart from these 4, some other entries could be company made a fresh issue, partly paid up shares call was made, sale of investments. These entries, if required, we will pass. But these are the major entries. Buyback entry, due entry, nothing but when you make a buyback, and then cancellation of the shares bought back, and then adjustment of premium and transfer to CR. Hello. So this is the entire theory of buyback, sir. Section 70, like one section is there, sir. This is purely company side section, sir, which says companies cannot buy back their own shares or specified securities through subsidiaries, investment companies, if it has any outstanding defaults in payment of deposits, interest, debentures, all these things. And even after clearing dues also, buyback is allowed only after 3 years, and also SEBI regulations are there. Not relevant for accounting point of view. You will learn them in the accounting point of view. The accounting point of view, all the points I have discussed, sir. So this is the theory relating to buyback of securities. Okay, sir. Relating to buyback of securities, scenario based question, sir. Question number 8. Important type of question, sir, in buyback. Basically, this question is about whether buyback is within the permissible limits or not. Suppose in this question you see, they are asking calculate the maximum permissible number of equity shares that can be bought back. In two situations they given, sir. I told you already, sir, when I am discussing theory, what is the maximum number of shares to be bought back? Least of the 3 tests. What are the 3 tests? Resource test, shares outstanding test, debt equity ratio test. So under each test we need to find out the number of shares to be bought back. Least will be the maximum permissible. So in the question clearly they are asking, sir, say this, maximum permissible, calculate maximum permissible number of equity shares that can be bought back in both situations, and also required to pass necessary journal entries. See this, there is a company SMM Limited, sir. That company capital structure given as on 31st March 2011, rupees in crores. Capital structure given rupees in crores. Look at two situations they given, sir. First, equity share capital 1200 crores. Reserves and surplus. Reserves, general reserve 1080, securities premium 400, P&L 200, infrastructure development reserve, which is a statutory reserve, 320. You know, statutory reserve is not a free reserves. Okay, loan funds. Look at loan funds. How much? 3200 for situation number 1. For situation number 2, 6000. I think that is the only difference between situation 1 and 2. Situation 1, the loan funds are 3200. Situation 2, the loan funds are 6000. Now the company has offered buyback price of 30 per equity share. Now company want to buy back existing equity shares at 30 per share. You are required to calculate maximum permissible number of equity shares that can be bought back in both situations, and also required to pass necessary journal entries. Hello. Rupees is given in crores. How you are going to approach this solution to this question, sir? First of all, what is the thing they are asking? What is the requirement of the question? Maximum permissible number of equity shares to be bought back. For that, what we need to do? Least of the 3 tests. So under each test we need to find out what is the number of shares to be bought back. Whichever is least is the maximum permissible number of equity shares. Here how many situations are there? 2. What are those? When loan funds are 3200, when the loan funds are 6000. Okay. Now let us solve this question. Carefully observe and solve along with me. Those who are watching recorded classes also, please solve along with me. So this is SBQ, scenario based question 8. Determination of maximum number of equity shares to be bought back. Determination of maximum number of equity shares to be bought back. There are two situations here. First situation, when loan fund is 3,200 crores, when loan fund is 6,000 crores. Correct? Two situations. When the loan fund is 3,200, when loan fund is 600. How many tests are there? 3 tests. First, resource test. Second, shares outstanding test. Third, debt equity ratio test. Debt equity ratio test. Or resource test working note 1, outstanding test working note 2, debt equity ratio test working note 3. And finally, what we are going to get, sir? Maximum number of shares to be bought back. Maximum number of shares to be bought back is what, sir? Least of the above. Correct? Least of the above is the maximum number of shares to be bought back. Now, first working note 1. What is working note 1, sir? Resource test. Can you tell me what this test says? This test basically talks about what? Maximum amount available for buyback. What is the maximum amount we can use for buyback? 25% of paid up share capital plus free reserves. 25% of paid up share capital plus free reserves. So, maximum amount that can be used for buyback is equal to 25% of paid up share capital plus free reserves. Here free reserves including securities premium. Now you tell me, look at the question and tell me 25% of paid up share capital. Paid up share capital means equity plus preference. So here only equity is there. How much? 1200 crores. Preference share capital 1200 crores plus free reserves. Can you tell me free reserves? General reserve 1080, securities premium 400, P&L 200. Infrastructure development reserve is not a free reserve. So 1680, right? 1680. So 1200 plus 1680 into 25%. 720 crores. Agreed? This is the maximum amount we can use for buyback. 720 crores, rupees 720 crores. Therefore, maximum number of shares to be bought back maximum number of shares to be bought back. With this 720 crores divided by each share we are buying at what price? 30 rupees. So 720 crores divided by 30 per share. Can you tell me? 720 divided by 30. 24 crores shares company can buy back. 24 crore shares, each share at 30 rupees. So it is equal to 720 crores. So therefore, as per resource test, the maximum number of shares to be bought back is 24 crores. Sir, the correct way to solve the question is not just copy. See the question and facts. Only when you confirm how you got this paid up share capital free reserves, then you copy. That's the correct way to learn, sir. Looking at the question and solve, not just copy. So now you got 24 crores. Therefore, here you update. As per resource test, what is the maximum number of shares to be bought back? As per resource test, 24 crores. Correct? 24 crores. 24. Here also 24. There won't be any changes as far as resource test is concerned. 25% of the paid up capital plus free reserves. So 24 crores, 24 crores. Next, come to working note 2. Sir, you understand test 1 na? Test 2. What is test 2? Shares outstanding test. Shares outstanding test says 25% of maximum number of shares to be bought back cannot exceed 25% of paid up equity share capital of that financial year. I told you there are two ways. Simple way is simple. Simple way is, say this, maximum number of equity shares to be bought back. Maximum number of equity shares to be bought back is 25% of total number of equity shares. Total number of equity shares how many? Total number of equity shares 120 crores. 1200 crores is the total capital divided by face value. 120 crores. Correct? Sir, it is very unfortunate some student doesn't know the number of shares also. Share capital divided by face value. 1200 crores divided by 10. 120 crores. 25% of 125 crores. 120 crores, sorry. How much, sir? 30 crores shares. 30 crore shares. Sir, this shares outstanding test can be ascertained in another way. I told you that way also. What is that? What is the total equity, paid up equity share capital? 1200 crores into 25% divided by face value. Then also you will get what? 30 crores. You can check it. Hello? But the simple way is this. Number of equity shares into 25%. Or else total paid up share capital 1200 crores into 25% divided by 10. It will be 30. Either this or this. Any one. Don't do both. So maximum number of equity shares to be bought back as per shares outstanding test 30 crores. Correct? So update here. 30 crores, 30 crores. 30 crores, 30 crores. Now the last test, which is the most important test, is what? Debt equity ratio test. This is where the students are lacking all the knowledge. This is the main test. First two tests you understood? Now come to the last test, sir. This is working note 3. Debt equity ratio test. Debt equity ratio test. See, this test says after buyback debt equity cannot exceed 2:1. If debt is 2 rupees, equity should be 1 rupee. Correct? Now here two situations will arise, sir. Situation number 1, when loan fund is how much, sir? 3,200 crores. Situation number 2, sir, 6,000 crore, correct? And loan fund is 6,000 crores. Okay, 6,000 crores. Now observe carefully what I am doing. Everybody please carefully observe. If you learn one time now, then that is sufficient. You can easily apply it in other problems. First time, learn properly. First take debt. What we need to take? Debt. Because here the test is debt equity ratio test. And what is the debt here? Here debt means what? Loan funds. That means 3,200. Correct? Second situation, 6,000. This is the debt. Clearly given in the question. Rupees in crores, sir. Now you see, if debt is 3,200, what is the minimum equity to be maintained after buyback? 2:1 ratio. So minimum equity to be maintained after buyback. Can you tell me, sir? What is the minimum equity to be maintained after buyback? If 3,200 is the debt, equity will be half. 2:1 ratio. Exactly half. That means A by 2, correct? A is debt, sir. In that half you need to take. Hello? How much it is? 3,200 divided by 2. 1,600. This one? 3,000. So this is the equity I need to maintain. Then what happens? Tell me. My ratio will be 2:1. If my debt is this one, equity should be this one, then only 2:1 ratio will be maintained. Hello? But see this. What is my present equity? Present equity of the company is what? What is equity means? I told you in theory. What is equity means? Equity means what? Equity means what I told in the theory. That's why I said read. Equity means paid up share capital plus free reserves including securities premium. You don't read anything. While solving the questions, everything again has to be repeated. Then what is the use of discussion? This much discussion, tell me. Say this. Here equity means what? Paid up share capital plus free reserves including securities premium. See, bar again and again we can't repeat here. Please understand. When I said equity, you have to tell me. What is equity? Paid up share capital plus free reserves including securities premium. Tell me, look at the question and tell me equity how much. Calculate equity and tell me. If you have the brains, no need to calculate again. Because already we have done it. Where we have done it? Resource test. In resource test already we have paid up share capital plus free reserves including securities premium we have calculated. Hello? 1200 plus 1680. Correct? How much? 2,880. Present equity 2,880. Correct? Open the calculator. Go there. Take paid up share capital. Take free reserves including securities premium. You will get 2,880. Here also 2,880. Equity means paid up share capital plus free reserves including securities premium. That means 1200 plus general reserve 1080 plus securities premium 400 plus P&L 200. You add all these things. Infrastructure development reserve don't take. That is not a free reserves. My present equity is this. Now you tell me. Everybody think here. Come on, listen. Sir, first think about situation 1, sir. What is your present equity, sir? 2,880. After buyback, how much you need to maintain? 1,600. Okay. 2,880 minus 1,600. How much? 1,280. 1,280 I can reduce equity. But my question is whether this 1,280 can be used for buyback as per debt equity ratio test. First you need to understand debt equity ratio test says debt means equity, debt and equity 2:1 ratio I need to maintain. My debt is 3,200. Therefore, after buyback, I need to maintain equity of 1,600. My present equity 2,880. That means how much equity I can reduce? 1,280. But the problem is concept of CRR is coming into the picture. In concept of CRR, from which sources CRR amount is transferred to CRR? Free reserves. Free reserves is part of equity. Free reserves is part of equity. So therefore, from the present equity, first I need to transfer the amount to CRR. Only balance amount I will compare with 1,600, and the balance reduction possible I can use for buyback. So therefore, here 2,880 minus 1,600. Sir, 1,280 I can reduce. So therefore, maximum 1,280 I will use for buyback. No. First of all, from the present equity, you need to transfer the amount to CRR. Why CRR? Because the Companies Act clearly says whenever there is a buyback, if the company is doing buyback by using the existing free reserves or securities premium, then to the extent of the nominal value of shares so bought back must be transferred from free reserves to CRR. Therefore, from the existing equity, present equity, first I need to transfer the amount to CRR. Whatever the balance is there, that I will compare with the equity to be maintained after buyback. That reduction is only eligible for buyback. But now you tell me, this is my present equity. I know from this equity I need to reduce CRR. That means after reducing CRR, I will get what? Future equity. After buyback, this will be my equity. Hello? So from 2,880, I need to reduce amount transferred to CRR. But how much is the amount I need to transfer to CRR? Nominal value of shares to be bought back. What is the nominal value of shares I am buying back? We don't know. That's what we are finding now. Here the number of shares to be bought back is least of the three. Only when you know the number of shares to be bought back multiplied with face value, you will get the nominal value of shares to be bought back. If you know the nominal value of shares to be bought back, that will be deducted from the present equity, then you will get future equity. That future equity you will compare with the minimum equity to be maintained after buyback. Whatever the gap is there, to that extent buyback is allowed. Hello? So therefore, now the question is how to find out CRR amount. How to find out CRR amount. From this 2,880, I need to reduce the CRR. Then I will get future equity. Once I know the future equity, next thing is what? Maximum. Next you write down, I will tell you. Maximum amount permitted for buyback. You will get maximum amount permitted for buyback. Then maximum number of shares to be bought back. Maximum number of shares to be bought back. Okay. Sir, here my present equity is 2,880. From that present equity, I need to transfer the amount to CRR. But I don't know how much is the CRR amount. CRR amount is nothing but the nominal value of shares to be bought back. See, you need to follow the solution as per ICAI study material. So this working note I am giving as per ICAI study material. If you follow this, then only marks will be allotted. There are some other shortcut ways also, but if you do those shortcuts, marks will not be allotted. Only this is the way. Now I am going to explain you what is the amount of CRR, what is the maximum amount permitted for buyback. Okay. See here, we will follow simultaneous equation method. What is that? Simultaneous equation method. I will frame two equations here. Logically, how I am framing, you observe. So here in working note 4, let us assume amount to be transferred to CRR be X. Let us assume, sir, amount to be transferred to CRR be X, sir. Let us assume like X. And second one, maximum permissible amount for buyback. Amount for buyback be Y. Let us assume like this. Let us assume amount to be transferred to CRR be X, sir. Maximum permissible amount for buyback be Y. Correct? Now first equation number 1. I am framing two equations, right? Equation number 1. What is equation number 1? Equation number 1 is equal to maximum permissible amount for buyback. Maximum amount permissible for buyback. Now, what is maximum amount permissible for buyback? Y is equal to, see this, everybody please concentrate. Maximum amount permissible for buyback. Tell me, as per debt equity ratio test, what is the maximum amount permitted for buyback? First I need to consider present equity. From this present equity I need to reduce CRR. Then I will get the future equity. Hello? From that, what is the minimum equity need to be maintained? I will reduce. The balance is nothing but the maximum amount permitted for buyback. So therefore here you need to understand, sir, maximum permissible amount for buyback, how you are going to get is, first to take present equity. Before buyback, what is the equity of the company you take? From this present equity, transfer to CRR minus it. And from this minimum, what is the minimum equity? To be maintained. Minimum equity to be maintained after buyback you take. Minimum equity to be maintained after buyback you take. Minimum equity to be maintained after buyback. Can you tell me here? So first you understand what is the maximum amount permissible for buyback as per debt equity ratio test. Tell me, first we need to take present equity. From that, first we need to transfer CRR. Then what is the minimum equity to be maintained after buyback? Tell me in this question, what is the present equity? 2,880 given. 2,880. So 2,880 minus amount to be transferred to CRR X minus what is the minimum equity to be maintained after buyback? I told you, see this, minimum equity is 1,600. Hello? 1,600. 1,600. So therefore Y is equal to 2,880 minus 1,600. How much, sir? 1,280 minus X. Agreed? 1,280 minus X. This is first equation, sir. Sir, common sense, sir. Common sense. No subject required. Common sense. Simple. See this. What Act says, your debt equity should be maintained in 2:1 ratio. Your debt is 3,200. Your equity should be half, 1,600. But your present equity how much? 2,880. But the difference between the present equity and minimum equity to be maintained 1,280. This 1,280 is not eligible for buyback because we know we need to transfer the amount to CRR. Therefore, from the present equity, first I need to transfer the amount to CRR. That's why now I am framing the equations, and equation number 1 I am saying is, what is the maximum permissible amount for buyback? Simple. What is your present equity? 2880. From this, first I transfer the amount to CRR minus X. I don't know. That's why X. Minus, I know what is the minimum equity to be maintained after buyback? 1600. So therefore, the difference between the present equity and future minimum equity to be maintained is 1280. From this 1280, I need to transfer the amount to CRR first. Therefore, maximum amount permissible for buyback is equal to 1280 minus X. What is the equation? Tell me. Maximum permissible amount for buyback is equal to present equity minus transfer to CRR minus minimum equity after buyback. In this case, the difference between present equity and minimum equity is how much? 1280. But is this 1280 eligible for buyback? No. From this, I need to transfer the amount first to CRR. This is equation number 1. Now frame equation number 2. Equation number 2 is relating to what, sir? Equation 1 is based on what? Maximum amount permitted for buyback. So therefore, equation number 2 is based on CRR. Amount to be transferred to CRR. Amount to be transferred to CRR. What is the amount to be transferred to CRR? Simple. Amount to be transferred to CRR is the nominal value of shares so bought back. Here, how many shares you are buying back depends upon the maximum amount permitted for buyback. So the equation is, see this, maximum amount permissible for buyback. Permissible for buyback divided by buyback price. What is the maximum amount permissible for buyback? Y divided by buyback price. Then you will get number of shares to be bought back into face value per share. Face value per share. Simple equation, sir. Sir, common sense. What is the maximum amount to be transferred to CRR? Nominal value of shares so bought back. How many shares you will buy back? That depends upon the maximum amount permitted for buyback. So maximum amount permitted for buyback divided by buyback price. You will get number of shares to be bought back into face value. Then you will get the nominal value of shares so bought back. So therefore, what is the maximum amount to be transferred to CRR? X is equal to, what is the maximum amount permitted for buyback? Y divided by buyback price? 30 rupees in the question. Say this, 30 divided by face value? 10. So therefore, if you solve, 3x is equal to y. This is equation number 2, correct? Say this, 3x is equal to y. So 2 equations we framed. You understand second equation? What is second equation? Amount to be transferred to CRR. What is the amount to be transferred to CRR? Maximum permissible amount for buyback divided by buyback price. Then you will get number of shares to be bought back into face value. Then you will get the nominal value of shares so bought back. So y divided by 30 into 10. Now I have 2 equations with me. Can I solve these 2 equations? So solving equation 1 and 2. Solve it. First equation. In first equation, if I substitute second equation, first equation, y is equal to 120 minus x. Correct? Y is equal to 120 minus x. So y is equal to second equation says 3x. Hello? So 3x is equal to 120 minus x. Correct? Sir, y is equal to 120 minus x, sir. They said y is equal to 3x, na? Now therefore, 4x is equal to 1012. So x is equal to 1280 divided by 4. 320. Say this, 320. What is x? Amount to be transferred to CRR. CRR amount 320. Correct? Amount to be transferred to CRR is 320 crores. How to find out y? Y is equal to 1280 minus 320 x. 1280 minus 320. How much, sir? 960. Sir, if I know the x, I can find out y, na, sir. This equation, sir. X I know 320. 1280 minus x. 960 crores. So therefore, you know, amount to be transferred to CRR is 320 crores. Maximum amount permissible for buyback is 960 crores. So amount to be transferred to CRR is how much, sir? Yes, amount to be transferred to CRR be 320 crores, sir. And maximum amount for buyback is 960 crores. Hey, mathematically, you know how to solve these equations here. Very simple. So solved these equations, I got x and y. Now you see here. Everybody concentrate. I came to know x 320. Now see, from my present equity, if I reduce 320, which is amount to be transferred to CRR, 2880 minus 320, how much? 2560. See this, 2560. That means 2560 is my future equity, but what is the equity I need to maintain? 1600. So therefore the difference is 2560 minus 1600, 960. That is the maximum amount permitted for buyback. Correct? 960. Maximum amount permitted for buyback 960. How you got maximum amount permitted for buyback, sir? Simple. D minus B. D means what? What is the future equity after transfer to CRR? See, this I got through working note 4, sir. Please understand, working note 4. So I done working note. Through that working note, I came to know. Working note 4, sir. Through working note 4, I came to know. Now tell me, what is the maximum amount permitted for buyback as per debt equity ratio test? 960 crores. If 960 crores is permitted, each share is bought back at 30. So 960 divided by 30? 32 crores. See this. Maximum number of shares to be bought back, 32 crores. 32 crores. That is 960 divided by buyback price. 30. So here most of the students where they are doing mistake now, they are unable to understand this logic. And they are finding different alternatives. Even faculty is also teaching the easiest shortcut way. That is not correct. That will not give marks. Only way you can get marks is follow what is there in the CMA study, ICA study material. So logically you understand this. So tell me once again, my present debt. What is my debt here? 200. That means equity to be maintained exactly half. That means how much equity I need to maintain? After buyback. What is my present equity? 2880. That means this present equity I have. Future I need to maintain 1600. So 1280 is equity I can reduce. But can I use 1280 for buyback? No. Therefore first from this 2880 I need to transfer the amount to CRR. That's why what I done is I have assumed amount to be transferred to CRR by X, maximum permissible amount for buyback is Y, and I frame two equations. That is maximum permissible amount for buyback is what is my present equity, how first I need to transfer the amount to CRR from it, and what is the minimum equity I need to maintain. That is 2880 minus X minus 1600, so 1280 minus X. What is my equation? That is amount to be transferred to CRR. That is what is the maximum permissible for buyback Y divided by buyback price. I will get number of shares to be bought back into face value. I will get equation number 2. Solve these two equations, you will get X and Y. So from the present equity, you reduce CRR, then you will get the future equity. Compare this future equity with the minimum equity you need to maintain. That is 960 is the reduction possible. So that means this is the amount eligible for buyback. If 960 crores I can use, but at a price of 30 rupees, how many shares I can buy back? 32. Hello. Now tell me, when my loan funds are 6,000 crores, everybody see situation number 2. Come on. When loan funds are 6,000, what is the minimum equity I need to maintain? 3,000. I want answers. Come on, concentrate 1 minute. If my debt is 6,000, what should be the minimum equity? 3,000. What is my present equity? 880. That means equity reduction possible. That means future equity not applicable. Maximum amount permitted for buyback not applicable. Maximum number of shares to be bought back Not applicable means nil. Because here the amount is not permitted for buyback. In case when your loan funds are 6,000 crores, na sir, what is the maximum permitted for buyback? Will not arise. Why will not arise? Because your debt equity ratio is already, you should not maintain in 2:1 ratio. So therefore you are not eligible for buyback in second case. See, if your debt is 6,000, equity should be 3,000. Your present equity is only 2,880. Reduction in equity is not possible. So you cannot maintain 2:1. If you go for buyback, what happens? Tell me. In second situation, if you go for buyback, what happens? From your present equity, first amount will be transferred to CRR. Therefore, your debt equity ratio should not be maintained in 2:1 ratio. It will be disturbed. That's why here, since present equity and the minimum equity to be maintained is more than the present equity, reduction in equity is not possible. Therefore, buyback is not permitted here when loan funds are 3,000 crores. So therefore, here you need to write, sir. As per debt equity ratio test, when loan funds are 3,200 crores, what is the maximum number of shares to be bought back? 32. This one? Nil. Now you tell me. Final answers tell me. When loan funds are 3,200, what is the maximum number of shares to be bought back? Least of the above 3. 24 crores. When loan funds are 6,000 crores, least of the above 3. Least of the above 3. Nil. Why doubt? Nil. Therefore, buyback is not allowed. In case when loan funds are 6,000 crores, the maximum number of shares to be bought back is least of the 3. Least of the 3 is nothing but this one. Sir, I want reply from you. You understood working note 3. Debt equity ratio test you understood. This is the important thing. These simultaneous equations. Yeah. Now they are asking past necessary journal entries. Sir, for which situation necessary entries are possible? Situation 1. When loan funds are 3,200 crores. So write down journal entries when loan funds are rupees 3,200 crores. So when the loan funds are 3,200 crores, what are the entries you are going to write? Tell me what are the entries? Buyback entries, right? Tell me. First, when shares bought back, what is the entry? Equity share buyback account debit to bank account. Correct now? So equity share buyback account debit to bank account. Tell me how many shares we are buying back here? Least 24 crores. Correct now? So 24 crores into each share is bought back as 30. So 24 into 30. 720 crores. Hello? 720 crores. Being 24 crores equity shares were bought back. Next, shares bought back will be first shares bought back. After that, what happens? Cancelled. When you cancel, what is the entry? Equity share capital account debit, premium on buyback account debit to equity share buyback account. Correct? Here 24 crore shares into face value 10 rupees. Hello? 240. And you are buying back at 30 rupees. So what is the premium you are paying? 20. 24 crores into 20. 480. Equity share buyback 720. Always need to understand, sir, equity share capital will be cancelled at face value. Number of shares to be bought back into face value. So shares bought back shares were cancelled. What is entry number 3? Premium will be adjusted against securities premium, right? Securities premium is there. How much? 400. So premium on buyback is how much? 480. So first 400 we will adjust with securities premium, remaining balance we will adjust with free reserves like general reserve. Hello? So therefore securities premium account debit 400, general reserve account debit 80 to premium on buyback. How much, sir? 480. Premium on buyback 480. Securities premium account debit, general reserve account debit to premium on buyback. Some students will get a doubt. Sir, here can I use P&L account also? Yes, P&L is also free reserve. See here, premium on buyback 480, right? This 480 first I adjust with securities premium. Still I want 80. Either I can adjust with general reserve or I can adjust with the P&L account also, because both are free reserves only. Hello? Next, any other entry? CRR. That is the most important entry. Tell me what is the nominal value of shares cancelled, bought back and cancelled? 240. Now to the extent of the 240, I will transfer from free reserves to CRR. What are the free reserves available, sir? General reserve. General reserve 1080 is there. Hello? In 1080, how much we used? 80. Still 1000 is there. How much we need to transfer? 240. So transfer it. General reserve account debit to CRR account. 240, 240. To the extent of the nominal value of shares so bought back must be transferred from free reserves to CRR. Narration I am not writing. Please on your own write, develop the writing of narration. So first shares bought back, equity shares being equity shares bought back at 30 rupees per share. Next shares bought back shares were cancelled. When you cancel, being equity shares bought back were cancelled. Next premium on buyback will be adjusted. Then transfer to CRR to the extent of the nominal value of shares so bought back. So see this. This is the answer, sir. This is how you need to solve the question. If it is relating to permissible number of equity shares to be bought back. Okay? You understand this? Okay? Okay, sir. Next question we are going to solve is scenario based question 10, sir. We solved scenario based question. Just now we solved 8. Now this is 10, sir. See this question. They have given the balance sheet of a company Competent Limited as on 31st March 2011. Look at the balance sheet, everybody, guys. Equity and liability, shareholders fund, share capital, note 1 given. Reserves and surplus, note 2. Non-current liabilities, long-term borrowings, note 3. Current liabilities, other current liabilities given. Asset side you see, non-current assets, property, plant, equipment, note 4. Current assets, other current assets given. You see the notes to account, sir, important. Share capital, authorized, issued and subscribed capital. Equity share capital, fully paid shares of 10 each, 12,50,000. So this company is having equity shares, sir. 12,50,000 rupees total equity share capital, sir, face value 10. So therefore 1,25,000 shares. Correct now? Reserves and surplus, securities premium, P&L, revenue reserve. Long-term borrowings, they have debentures, sir. Debentures as well as unsecured loans. Property, plant, equipment, land and building, plant and machinery, furniture and fittings. So this is the balance sheet of Competent Limited on 31st March 2011 given. Hello? Next. What happened next, you see? The company wants to buy back 25,000 equity shares of 10 each on 1st April 2011 at 20 per share. See this. The company wants to buy back how many shares? 25,000 shares. At what price? 20. Buyback price 20. What is the face value? 10. Face value 10. Buyback price is 20. Next, buyback of shares is duly authorized by articles. Necessary resolution has been passed by the company towards this. Okay. The payment for buyback of shares will be made by the company out of sufficient bank balance available shown as a part of current asset. Now, important part. Please observe. Comment with your calculation whether buyback of shares by the company is within the provisions of Companies Act 2013. See this, they are asking. They are asking whether buyback is within the permissible limits. Suppose, see in this question, this company wants to buy back how many shares? 25. Now they are asking whether this 25,000 is within the limits or not. How can you say whether it is within the limits or not? You need to find out maximum permissible number of shares to be bought back. What is maximum number of permissible shares? Least of the 3 tests. You need to apply test 1, test 2, test 3, find out the shares, least, that is the maximum permitted. Compare with 25. If 25,000 is within the limit, then allowed, otherwise not allowed. Hello? If yes, pass necessary journal entries towards buyback of shares and prepare balance sheet. So first we need to check whether buyback is within the limits or not. Next we need to see journal entries we need to pass for buyback. Third we need to prepare balance sheet. Same way like how we solved SBQ 8. Scenario based question 8 we solved, na sir? Same manner. Come on, this question will solve, important. Now tell me what is the number? SBQ 10. Competent limited question, right? So determination of maximum number of equity shares to be bought back. As per Companies Act 2013. Determination of maximum number of shares to be bought back as per Companies Act 2013. So here situations, different situations not there. Number of shares. 3 tests we need to apply, sir. First test, resource test. Working note 1 we will do. Second test, shares outstanding test we will do. Working note 2. Third, debt equity ratio test. Debt equity ratio test. Working note 3. So under each test, what is the maximum number of shares to be bought back? We need to find out, right? So at the end we will find out maximum number of shares to be bought back. So maximum number of shares to be bought back. So least of above test. Least of above test. So now we need to find out under each test what is the maximum number of shares to be bought back. Correct? Okay. Now come on sir, each test I will do. First test, working note 1, resource test. This test talks about what? Amount. Correct? What is the maximum amount that can be used for buyback? 25%. So maximum amount can be used for buyback. 25% of paid up share capital plus free reserves. Correct? Calculate. Take your calculator and tell me. Paid up share capital plus free reserves. Paid up share capital, how much? 12 lakh 50. Correct? So 12 lakh 50 paid up share capital plus free reserves. What are the free reserves of the companies? Including securities premium we need to take. Correct? 2 lakh 50 we need to take securities premium, and we need to take 1 lakh 25 P&L account. And also we need to take revenue reserve. How much? 15 lakhs. So calculate and tell me total. 12 lakh 50 plus 2 lakh 50 plus 1 lakh 25 plus 15. Total 31 lakh 25,000. Correct? On that to 25%. 7 lakh 81 250. Correct? So this is the maximum amount permitted for buyback. Now by using this amount, how many shares you can buy back? Maximum number of shares to be bought back. By using this amount, maximum how many shares we can buy back, sir? 781 250 divided by, what is the buyback price, sir? 30 rupees or 20 rupees, sir? 20. Buyback price is 20. Divided by 20. I think it is 39,062.5. So can I make 39,063? Hello? Shares cannot be in fractions. So 39,063 shares or 39,662 also we can take, nothing wrong. I taken that 7 lakh 81 250 divided by 20. 3962 or 63 shares. Hello? This is resource test. So as per resource test, the answer is 39,063 shares I have taken. Now shares outstanding test you take. Working note 2, shares outstanding test. Now this shares outstanding test says the maximum number of equity shares to be bought back. Correct? Maximum number of equity shares to be bought back. To be bought back. I told two ways. Simple way is what? 25% of number of equity shares. Correct? So 25% of number of equity shares in the company is 1,25,000. 12 lakh 50 divided by 10. So 1,25,000 equity shares on the to 25%. How much, sir? 31,250 shares. Take 31,250 shares. Or else I told you another way also. What is that? Total share capital 12 lakh 50 into 25% divided by buyback face value 10. So 12 lakh 50,000 into 25% divided by 10. So it is 31,250 shares. Everybody, this one or this one, anyway is correct. So simple way is number of shares into this. So 31,250 you update here. 31,250. So therefore, as per shares outstanding test, 31,250. Now I need to follow the next one. What is that? Working note 3. Debt equity ratio test. This is the main test. Again it came. Already you understood. Now debt equity ratio test. Sir, Companies Act says after buyback your debt equity should not exceed 2:1. Correct? So you need to ensure that your debt equity ratio should be maintained in 2:1 ratio. So particulars amount in rupees. Now first I told you what you need to take. Debt. What is your present debt? You take it. Present debt. Can you tell me what is the present debt of the company? Important, sir. This is the important point. What is the present debt of the company? Debt means liabilities. Correct? Go to long term borrowings are there, na? How much is there? 28 lakh 75. That is debt. That is debt. Any other thing to be added? Other current liabilities also debt. Please add 16 lakh 50. So therefore 16 lakh 50,000 plus 2875. 45 lakhs. 45 25,000. This is a debt, sir. This is debt. Hello. Now you tell me, if your debt is 45 lakhs 25,000, what is your minimum equity? Minimum equity to be maintained after buyback. Minimum equity to be maintained after buyback. After buyback. How much, sir? 22 lakhs 62,500. Exactly half. Then it is maintained in 2:1 ratio. A divided by 2. Correct? Now you tell me, sir, after buyback my debt is 4525, my equity should be 22,62,500. But what is my present equity? I need to see first. What is my present equity? We find out in resource test. Already we got 31,25,000, correct? Hello? Paid up share capital for free reserves. We have added everything in free reserve, I mean resources test. How much we got? Present equity 31,25,000. Please add and check. 3125 current. Correct. 31,25,000 present equity. Now you tell me now. Your present equity is 3125. What is the minimum equity you need to maintain after buyback? 22,62,500. Hello? That means how much reduction? 8,62,500. Correct? How much reduction? 8,62,500. But this 8,62,500 is total amount eligible for buyback? No. First we need to transfer the amount to CRR. So therefore, here I need to find out my future equity. Future equity. How to find out future equity? What is my present equity minus I need to transfer the amount to CRR. Then I will get future equity. Once I know the future equity, what I will do? I will find out the maximum permissible amount for buyback. Correct? How to find out maximum permissible amount for buyback? D minus B, correct? D minus B. D means future equity after CRR. B means minimum equity to be maintained. The difference is nothing but maximum permissible amount for buyback. And based on this I can find out what? Maximum number of shares to be bought back, correct? Maximum number of shares to be bought back. Everybody? Maximum number of shares to be bought back. Now do working note 4. Working note 4, sir. Sir, two equations. Here in this problem I am not going to write in detail. Please check SBQ 8 for detailed writing. Just I will directly write the equations here. Hello? But in examination you completely write down equation 1, equation number 2. Now I told you na, X is assumed as what? Amount to be transferred to CRRB X. Maximum amount permitted for buyback is Y. So first I am framing equation number 1. How to frame equation number 1, sir? Y is equal to, what is my present equity? 31,25,000. From this first I need to transfer the amount to CRR. Minus what is the minimum equity to be maintained after buyback? 22,62,500. Everybody. So therefore 31,25,000 minus 22,62,500. So 8,62,500. Correct? But from this first I need to give to CRR. So therefore the first equation is Y is equal to 8,62,500 minus X. Equation number 2. What is equation number 2, sir? What is the maximum amount to be transferred to CRR? Amount to be transferred to CRR is X. X is equal to, what is the maximum amount permitted for buyback? Y divided by buyback price 20 into face value 10. Correct? So therefore 2X is equal to Y. This is equation number 2. Equation number 2, very easy. Mathematics basics, dead basics. Join in LKG, go back, or if you have kids to your brothers and sisters studying LKG first class, take a tuition from them today. Ask them how this equation came, what to do. CA interlevel, I can't teach it. One student asked me, you will be surprised what he asked, na? Sir, how you got 2x is equal to y? This he asked. So 10, 20, right? 2 I have written, na? He asked, how you got 2? Trust me, those students also there. No, they are there. So 2, this 2 is came this side. 2x is equal to y. This simplification they don't understand here. What to do? Okay, no problem. So 2x is equal to y. In spite of explanation, they are not understanding this. That's a very difficult thing. Being a faculty, these small mathematical functions, I think I expect everyone to know. Now you solve this. Hello? If I solve in equation number 1, I substitute equation number 2, sir. As per equation number 2, y is equal to 2x, right? As per equation number 1, y is equal to 8,62,500 minus x, correct? Now here y is equal to 2x. So if I substitute in place of y 2x, what happens? So 3x is equal to 8,62,500. So therefore what is x? 8,62,500 divided by 3. Correct? 862,500 divided by 3. It will be 2,87,500. This is the maximum amount to be transferred to CRR. Hello? Transferred to CRR. How to find out y? Y is equal to 8,62,500 minus 2,87,500. 5,75,000. Hello? That means, see here, 2,87,500 I will transfer to CRR, sir. So 31,25,000 minus 287,500. So it is 28,37,500. This is my future equity. And what is the maximum permissible amount for buyback is, this is my future equity after CRR, and the equity minimum I need to maintain is this. So the difference between D and B, which is exactly Y, I got. How much? 5,75,000. Hello? Everybody, are you getting? Now tell me, my amount eligible as per debt equity ratio is 5,75,000. So 5,75,000 divided by 20. How many shares? 28,750 shares. So 5,75,000 is the amount eligible, each share at 20 rupees. So 5,75,000 divided by 20. 28,750. So here I need to write 28,750. So what is the maximum number of shares to be bought back? Least 28,750. This is the answer. 28,750 is the number of shares to be bought back. Everybody, 28,750 shares. Now company wants to buy back how many shares? Company wants to buy back 25. So therefore buyback is within the limits. So maximum number of shares to be bought back is 28,750. Company is allowed to go for buyback as number of shares to be bought back is within the limits. So here the conclusion I can write is, company is allowed to go for buyback as number of shares to be bought back is within permissible limits. Permissible limits for buyback. Okay? Okay. Now suppose if the buyback is allowed, we need to write what? Entries. Correct? Journal entries. What are the entries we'll write, sir? We know. First, buyback. Equity share buyback account debit to bank account. Right? To bank. How many shares we are buying, sir? 28,750 into 20 rupees. 28,750 into 20. How much, sir? 5,75,000. This is the buyback entry. Equity share buyback account debit to bank account. Being equity shares bought back. Correct? We are buying back how many shares? 28,750 shares. Correct? We are buying back 28,750. Into each share is bought back at 20 rupees. Hello? 5,75,000. Yeah, correct. Here, sorry, my mistake. Maximum permitted 28,750, but we are buying back how many? 25. Yes, we need to take 25. Correct it. 25 into what is the buyback price? 20. So 25 into 20. How much, sir? 5 lakhs. 5 lakhs. So being equity shares bought back. Next shares bought back will be cancelled, right? So equity share capital account will be debited to the extent of the face value, 25,000 into 10. So 2,50,000. And then premium on buyback. Premium on buyback, 25,000 shares into each share bought back at 20 rupees. So 10 rupees the premium, 2,50,000. To equity share buyback account. Equity share buyback account. How much, sir? 5 lakhs. So first bought back, then bought back shares are cancelled. Next, premium is adjusted against securities premium. Any securities premium available? Yes. How much? 2,50,000 is there. So adjust it. Securities premium account debit to premium on buyback. Securities premium to premium on buyback, sir. How much, sir? 2,50,000, 2,50,000. Adjust. And then CRR, we need to transfer to CRR. What is the nominal value of the shares bought back, sir? 2,50,000. Now this 2,50,000 I need to transfer from free reserves to CRR. What are the free reserves available? Revenue reserve is there. So I use revenue reserve. So revenue reserve account debit to CRR account. How much, sir? 2,50,000, 2,50,000. 2,50,000, 2,50,000. Being nominal value of shares so bought back must be transferred from free reserves to CRR account. So I transferred. Hello. So journal entries also done, sir. Buyback is within the limit, so I have written the entries. Now they are asking balance sheet also, sir. They are asking balance sheet. So balance sheet of Competent Limited, they are asking. Balance sheet of Competent Limited after buyback. So after buyback, what will be the balance sheet of Competent Limited? Particulars, note number, amount rupees. So first part of the balance sheet, equity and liabilities. In that, shareholders funds. In that, share capital, note number 1. Reserves and surplus, note number 2. Next, money received against share warrants, not there. Share application money pending allotment, not there. Next, non-current liabilities. In non-current liabilities, we have long-term borrowings. So non-current liabilities, in that long-term borrowings. For that, note number 3. Next, current liabilities. In current liabilities, we had current liabilities. In current liabilities, we have OCL, other current liabilities. That's it, total. Okay. Sir, because of buyback, what changes happened? That you need to incorporate. Second, asset side, sir. Asset side, you see, first non-current assets. In non-current assets, property, plant, equipment, PP is there. Note number 4. Next, current assets. In current assets, we had what? Other current asset. Total. Okay. Now, if I prepare notes to accounts to this, notes to accounts, first share capital, right? Share capital, you see, in the question, authorized, issued, subscribed capital, equity share capital, 12,50,000 is there. That means total 1,25,000 shares. In this 1,25,000 shares, 25,000 shares bought back and cancelled. So how many shares will be there? 1 lakh. Correct? So here I will write share capital, issued, subscribed and paid up share capital. Hello? I will write 1 lakh equity shares of rupees 10 each, fully paid up. Fully paid up. How much, sir? 10 lakhs. And sir, as per schedule 3, you remember, sir, when shares are bought back, we need to provide the note. Out of the above, these many shares are bought back and cancelled. That note also you will mention, sir. Because here in every problem, buyback is happening, na, sir. Whenever buyback happened, how many shares are bought back and cancelled, you need to provide that. So here, if you want, you can see, you want to add, sir, actually schedule 3, you write here. I forgot it in the last problem, you update it. 25,000 equity shares were bought back and cancelled. Okay. See, we need to provide a note like this. Because schedule 3 clearly saying that how many shares are bought back and cancelled, we need to provide a note. So we provide in a note. So what will be the capital, sir? 10 lakhs. So share capital 10 lakhs, sir. Update this here in the balance sheet. Now come to reserves and surplus, sir. Second note is reserves and surplus. You know, reserves and surplus, we have securities premium. First, how much? 2,50,000. But total 2,50,000 was used. Correct? Used for premium on buyback. Premium on buyback adjusted, sir. Total 2,50,000 we used, right? So therefore the balance is nil. And next, P&L. We created CRR, na, sir. How much CRR we created? 2,50,000. Create CRR. Because of the buyback, CRR is created. Next, look at revenue reserve. Revenue reserve, what is the balance, sir? 15 lakhs. In this 15 lakhs, how much we transferred to CRR? We transferred how much? 2 lakh? So what is the balance left? 12 lakh 50. Hello? Just changes, sir. What changes happened, you see. And P&L account. P&L account, I don't think so we have made any changes. What's the P&L account balance, sir? 1,25,000. 1,25,000. So therefore, securities premium, CRR, revenue reserve adjusted, P&L. Can you tell me the total? 16,25,000, right? 16,25,000 update. 1625. Long term borrowings, note 3, sir. Long term borrowings, note 3. In long term borrowings, I think we have debentures as well as unsecured loans. No changes, correct? 10% debentures, 14% debentures, unsecured loan. 10% debentures, how much? 18,75,000. And this is 10 lakhs. Total 28 lakhs. 28 lakhs 75,000. Hello? 2875. So here you need to take 28 lakhs 75,000. Next, OCL, other current liabilities. Current OCL, other current liability, any breakup is there? No, why I written note 4? Okay, by mistake I think I have written here. Please change it. It is not note 4 is not required. Directly you can write 16 lakhs 50,000. Can you tell me the total? 7150. Now PP note 4, I think as it is. In PP, what items are there? Land and building, plant and machinery, furniture and fittings. Correct? So land and building, plant and machinery, furniture and fittings. 3 things are there. 19 lakh 30, 18 lakhs, 9 lakh 20. 19 lakhs 30,000, 18 lakhs 9 lakh 20. Total 4650. No change, sir. Given as it is. 46 lakhs 50. So right here 4650. Next, current assets, right? In current assets, OCA, other current assets, 30 lakhs. So current assets, in that OCA, other current assets, 35 lakhs. Or no need, sir. Actually, directly we can write. See here. No need. Current assets. How much, sir? 35 lakhs, huh? 30, huh? 30 lakhs. Because of buyback, how much we utilized? 5 lakhs. Yeah. Buyback, we spent 5 lakhs, na, sir? We have written entry also. See, this 5 lakhs we need to reduce from current assets. $30 lakhs current assets, sir. In that 5 lakhs is used for buyback. So take here 25 lakhs. What is the amount, sir? 71 lakh 50,000. That's it. 7150. Okay. This is how we need to do the sum, sir. Very simple. Now see, either you solve SBQ 8 or SBQ 10. Not both are not required. SBQ 8 is sufficient because it is having two situations. Same only repeated, na. Only thing is that in SBQ 10 balance sheet also asked. There balance sheet not asked. Correct? Yeah. Now illustration 5, sir. This question is relating to debt equity ratio test. Only debt equity ratio test this is. See, in some recent examination questions, they are asking only debt equity ratio exclusive question, like 7 marks question, like this. You see this question, sir. Pratham Limited, a non-listed company, they have the following capital structure on 31st March 2011. Equity share capital of rupees 10 each fully paid given, sir. Reserves and surplus, general reserve, securities premium, P&L account, revaluation reserve. Revaluation reserve is not a free reserve. Loan funds given, sir, 42 lakhs. See this, what they are asking, everybody please concentrate. You are required to compute by debt equity ratio test. You are required to compute by which test? Debt equity ratio test. The maximum number of shares that can be bought back in the light of the above information when the offer price for buyback is 30 per share. Come on, tell me. So I'm giving you 1 minute time. You need to find out the number of shares to be bought back, maximum number of shares to be bought back as per debt equity ratio test by framing those two equations. Everybody should try and tell me the answer. Sir, yeah, this is illustration 5. Same manner, sir. We already solved 2 questions, SBQ 8 and 10. After that, you solve illustration 5 just for practice. This question concentrating only on the debt equity ratio test, the number of shares to be bought back as per debt equity ratio test. Here, how you need to approach, sir? We know. First, we need to take debt, correct? Roughly, I will solve, sir, debt. What is the debt given, sir? 42 lakhs, right? 42. And what is the minimum equity I need to maintain? Equity to be maintained after buyback. Exactly half, correct? A by 2. That is 42 lakhs divided by 2. 21 lakhs. What is my present equity? You see, present equity means paid up share capital plus free reserves. My paid up share capital 30 lakhs plus general reserve 32 lakh 50 plus securities premium 6 lakhs plus P&L account 4 lakh 30. Will you take revaluation reserve? No. 72 lakhs 80,000. Correct? Present equity 72 lakh 80,000. But from this present equity, what I need to do? First, I need to transfer the amount to CRR. So I need to find out the future equity. That is present equity minus CRR I need to do. Correct? Now, further 2 equations I will frame. First equation number 1. What is the maximum amount permitted for buyback? That is Y is equal to what is my present equity? 72 lakh 80 minus amount to be transferred to CRR X minus what is the equity to be maintained after buyback? 21 lakhs. So that means 72 lakh 80 minus 21 lakhs. So it will be 51 lakh 80,000, correct? Minus X. So Y is equal to 51 lakh 80 minus X. This is equation number 1. Now equation number 2. What is the amount to be transferred to CRR? X is equal to maximum amount permitted for buyback Y divided by buyback price. What is the buyback price? 30 into face value 10. So 3x is equal to Y. This is equation number 2. Now if I solve equation number 1 and 2. So in equation number 1, if I substitute equation number 2, actually 51 lakh 80 minus X, Y is equal to, this is equation 1. So Y is equal to 3x. So 3x is equal to 51 lakh 80,000 minus X. So X is equal to 51 lakh 80 divided by 4, correct? So 12 lakhs 95,000. This is what, sir? This is the amount to be transferred to CRR. Therefore, after transferring to CRR, what is the amount, maximum amount which is permitted for buyback? That's it, 38 lakhs 85,000. So therefore 12 lakh 95,000 I will reduce from my present equity. Then I will get the future equity to be maintained. That is 72 lakh 80 minus 12 lakhs 95,000. That is 59 lakhs 85,000. So therefore, after transferring to CRR, my future equity is this. But the equity I need to maintain is this. So therefore, what is the maximum amount permitted? 38 lakhs 85,000 is permitted. That is D minus B. Correct? This is the maximum amount permitted for buyback. 38 lakh 80. Now, maximum number of shares to be bought back. Number of shares to be bought back is 38 lakhs 85,000 divided by buyback price 30. Correct? 38 lakhs 85,000 divided by 30. So it will be 1,29,500 shares. That's it, sir. So the answer is 129,500. See this, 129,500 is the answer. Simultaneous equation method you need to apply. See this. This is what you need to do. First take the debt, loan funds. What is the minimum equity to be maintained? What is your present equity? What is the future equity? What is the maximum permitted amount for buyback, which is D minus B? That is the future equity minus equity to be maintained. And what is the maximum number of shares to be bought back? That is amount permitted divided by buyback price. You will get 1,29,000. Look at the working notes. Present equity they find out, and then equations they framed. See this, equation number 1, equation number 2. This is what given in the study material, and I solved accordingly study material. See, this is nothing problem. You solve this after SBQ 8, 10. First solve SBQ 8. Same model 10. Then this is just a practice question. Hello? That's it, sir. This is one question. Okay, sir. Next, illustration 6, sir, in buyback of securities. See this question, sir. This type of question already tested in examination, sir. Peroty Limited, a non-listed company, has the following capital structure as on 31st March 2011. Rupees in crores, sir. Equity share capital, shares of 10 each fully paid, 330 crores. Reserves and surplus, general reserve, securities premium, P&L account, infrastructure development reserve given, sir. Infrastructure development reserve is not a free reserve. Okay. Next, loan funds, 1800 crores, sir. This is the capital structure of Peroty Limited on 31st March 2011. Next, what happened, you see? The shareholders of Peroty Limited, on the recommendation of their board of directors, have approved on 12/9/2011 a proposal to buy back the maximum permissible number of equity shares. They want to buy back maximum permissible number of equity shares, considering the large surplus funds available at the disposal of the company. The prevailing market value of the company share is how much? 25 per share. In order to induce the existing shareholder to offer their shares for buyback, it was decided to offer a price of how much? 20% over the market. That means the market price 25. But company wants to offer 20% over the market price. That means 30 rupees is the buyback price. You are also informed that infrastructure development reserve is created to satisfy income tax requirement. That means they are saying that this reserve is created exclusively for income tax purpose. Hello? Income tax requirements. Therefore, they are saying this is a statutory reserve, which is not a free reserve. Next, what they are asking, check it. You are required to compute the maximum number of shares that can be bought back in the light of the above information, and also under a situation where loan funds of the company are either 1200 crores or 1500 crores. Originally loan funds how much? 1800 crores. Now they are also asking, if the loan funds are 1200 crores and 1500 crores, what is the maximum number of shares to be bought back? Assuming that the entire buyback is completed by 9/12/2011, show the accounting entries in the company's book in each situation. So this question tested in September 2024, sir. Same type of question, September 2024 they have tested for 7 marks. So see this. So what is the main requirement of the question? Maximum number of shares to be bought back. How to find out maximum number of shares to be bought back? List of the 3 tests. What are the 3 tests? Resources, shares outstanding, debt equity. Now here how many situations will come? 3. When the loan funds are 1800, when the loan funds are 1200, when the loan funds are 1500. In all these 3 situations, we need to find out under each test what is the maximum number of shares to be bought back. So see this. Important question this is. Mark it as important. Similar to SBQ 8 and 10. But 3 situations are covered here. So illustration 6. Since we have already solved this type of questions, it will not take much time. So determination of maximum number of equity shares to be bought back, correct? Determination of maximum number of equity shares to be bought back, sir. Particulars: when the loan fund is 1200 crores, 1800 crore, 1500 crores, 1800 crores, correct? Now 3 situations they have given. Okay, 1200, 1500, 800, 1800. First test, resource test. See, some books you will see first shares outstanding test. Whatever, all 3 tests must be performed. Order is not important. Resource test, working note 1. Shares outstanding test, working note 2. Last test, debt equity ratio test. Debt equity ratio test, working note 3. So maximum number of shares to be bought back. Maximum number of shares to be bought back. Maximum number of shares to be bought back is least of above 3, correct? Least of above test. So under each test, what is the maximum number of shares to be bought back? We will see. So when the loan funds is 1200 crores, 1500 crores, 1800 crores. Okay. Now apply each test, sir. Now first, resource test you apply. Resource test talks about what? Maximum amount that can be used for buyback. Correct? 25% of paid up share capital plus free reserves, including securities premium. Correct? This is the maximum amount I can use for buyback. 25% of what is your paid up share capital? 330 crores. Correct? Plus free reserves. What are your free reserves? General reserve 240, securities premium 90, and P&L account 90. Add everything. General reserve, securities premium, P&L. Hello? So 330 plus 240 plus 90 plus 90. Correct? How much, sir? Total 750. 25% of 750. 187.5 rupees in crores, sir, please. 187.5 crores. Sir, all rupees in crores. 187.5 crores. Sir, tell me, sir, by using this 187.5 crores, how many shares we can buy back? Maximum number of shares to be bought back is 187.5 crores divided by each share is bought back at what price? 30 rupees. 187.5 divided by 30. 6.25 crores shares. Correct? 6.25 crores shares. This is the first thing, sir. 6.25 crores shares. Hello? So now you update. As per resource test, the number of shares to be bought back is 6.25 crores. 6.25 crores. 6.25. Irrespective of your loan funds, the number of shares to be bought back as per resource test is 6.25 crores. Now come to test number 2, sir. What is test number 2? Shares outstanding test. This shares outstanding test says the maximum number of equity shares to be bought back. Maximum number of equity shares to be bought back. 25% of total number of equity shares. Correct? 25% of total equity shares, how many? Total equity share capital 330 divided by 10, 33 crores shares. Correct? So 33 into 25, 8.25 crores shares. So this is as per shares outstanding test. Also you can find in another way. What is that I told? 330 into 25 divided by face value 10. Correct? This is also give you the same answer. That is 8.25 crores shares. So as per shares outstanding test, the number of shares to be bought back is 8.25 crores. Correct? So update 8.25 crores. 8.25. 8.25. And the most important test is what, sir? Debt equity ratio test. This is the test we need to focus. So debt equity ratio test. Debt equity ratio test. Here three situations, sir. Situation number 1, loan fund 1200 crores. Situation number 2, loan fund 1500 crores. Situation number 3, loan funds 1800 crores. Correct? Now same follow the procedure. First always take the debt fund, that means loan fund, nothing but loan fund. How much? Take it. So loan fund is 1200, 1500 crores, 1800 crores. And what is the equity, minimum equity to be maintained after buyback? Minimum equity to be maintained after buyback. After buyback, A by 2, correct? So if your debt is 1200, equity should be exactly half of it, 600. This is 750. This is 900. Very simple. Then only ratio will be 2:1. Correct? So debt equity ratio should not exceed 2:1. So if my debt is 2, equity should be exactly 1, half of it. Hello? Next. Now what will be my present equity? Present equity in resource test already we calculated. How much, sir? Present equity means total paid up share capital plus free reserves including securities premium, 750. 750, sir. Present equity 750. See, in resource test we have taken everything, right? These things. These are all you add. 750. So you need to understand, sir. Sir, please concentrate. If my present equity is 750, in case of loan funds is 1200 crores, minimum equity I need to maintain after buyback is 600. So therefore how much reduction? 150. But this 150 is not permitted for buyback. From this 750, first I need to transfer the amount to CRR. Then only the balance I will compare with the minimum equity to be maintained. So therefore here what I am going to do, I will find out my future equity, that is after transferring to CRR what will be my equity. Once I know the future equity, I will find out maximum permissible amount for buyback. How to find out maximum amount permissible for buyback? D minus B. That is the future equity after transferring to CRR minus minimum equity to be maintained after buyback. Once I know the maximum permissible amount for buyback, I can find out maximum number of shares to be bought back as per debt equity ratio test. Maximum number of shares to be bought back, that is maximum permissible amount for buyback divided by buyback price. So you will get maximum number of shares to be bought back. Correct? So now I need to frame what? Equations. So working note 4 I will do. In previous sums I have written detailed. Here I will directly frame the equations, but in examination you write everything properly. Okay? So first I will frame equation number 1. Equation number 1 is what? Maximum amount permitted for buyback. So that is Y in our assumption. Y is equal to, what is my present equity? Present equity is 750. What is the amount to be transferred to CRR? X minus what is the minimum equity I need to maintain? 600. So say this, 750 to 600 means 150. But from that 150 I need to transfer the amount to CRR. So Y is equal to 150 minus X. Now I will frame equation number 2 based on amount to be transferred to CRR. What is the amount I need to transfer to CRR? X is equal to, what is the amount to be transferred to CRR is nominal value of shares so bought back. How many shares I will bought back? That depends upon the maximum amount permitted for buyback, that is Y. Y divided by buyback price. What is the buyback price? 30. Then I will get number of shares to be bought back into face value per share, 10 rupees. So therefore if I simplify this, it will be 3x is equal to Y. So this is equation number 2. Now I will solve these two equations. If I solve them, if equation number 2 is used in equation number 1, basically equation is Y is equal to 150 minus X. Here Y is equal to 3x. So if I want X, 4x is equal to 150. Therefore X is equal to 150 divided by 4, 37.5 crores. So that means 37.5 crores will go to CRR. Therefore, my Y will be 150 minus 37.5, that is 112.5 crores. This is the maximum amount permitted for buyback. So amount to be transferred to CRR is 37.5, sir. So from the present equity, my present equity is 750. From this 750, 37.5 will go to CRR. So 750 minus 37.5. So therefore 712.5 is my future equity. And I have to maintain 600 minimum. Therefore in equity how much reduction is possible? 112.5. Only this much I have to utilize. Because I need to maintain the ratio in 2:1 ratio. Correct? If the amount eligible is 112.5 crores at 30 rupees per share, 112.5 divided by 30, it will be 3.75 crores shares company can buy back. When the loan funds are 1200 crores. So when the loan funds are 1200 crores, 3.75 crores. 3.75 crores. See this. So when the loan funds are 1200, whichever is least means 3.75. So this is the maximum number of shares to be bought back when the loan funds are 1200 crores. Now come to loan funds are 1500 crores, sir. Hello? Sir, you understand this? When the loan funds are 1500 crores, see the interesting point. When my debt is 1500, the equity to be maintained 750. My present equity 750. My present equity is already 750. Therefore, reduction in equity possible? Not possible. Already my present equity is 750, sir. After buyback, I need to maintain 750. Suppose in this case, if I went for buyback, my present equity will further reduce by CRR. Therefore, debt equity ratio 2:1 will not be maintained. If my debt is 1500, equity should be 750. But my present equity only 750. If I went for buyback, this 750 further reduces by the amount of CRR. Therefore, here permissible reduction in equity is not possible. Everybody, permissible reduction is not possible. So, future equity, the question will not arise. Maximum permissible amount for buyback, not applicable. What is the maximum number of shares to be bought back? Nil. So, when the loan funds are 1500 crores, everybody please concentrate. When the loan funds are 1500 crores, my equity should be 750 to maintain 2:1 ratio. My present equity is 750. Therefore, there is no permissible amount for reduction in equity. Correct? Therefore, not applicable. Therefore, maximum number of shares to be bought back is nil. As per debt equity ratio test. So, as per debt equity ratio test, it is nil. So, that means maximum number of shares to be bought back when the loan funds are 1500 crores is also nil. Now come to last situation, 1800 crores. Simple. Sir, when my debt is 1800, what is the equity I need to maintain? 900. But my present equity 750. If I went for buyback, this 750 further come down. Then it will reduce. That means 2:1 ratio I can't maintain. So therefore I am not allowed for buyback. So here not applicable. Not applicable. As per debt equity ratio, nil. So therefore, as per debt, see, as per resource test, outstanding test, it may be allowed. But as per debt equity ratio test, it is not allowed. As per debt equity ratio test, it is not allowed. Hello? Nil, you take here. So here also will nil. That's it. Very simple. You understand this? Tell me, if the company go for buyback, what happens in case of 1800 crores? Debt equity ratio will not be maintained. Debt equity ratio test will be upset. But the Companies Act says debt equity ratio should be maintained in 2:1 ratio. So therefore, in this question, sir, we can maintain, buyback is permissible only when the loan funds is 1200 crores. Correct? Now they are asking journal entries. Journal entries when loan funds were 1200 crores, correct? When the loan funds are 1200 crores, tell me what are the entries you are going to write, sir? First, buyback entry. What is the entry for buyback? Equity share buyback to bank, correct? Equity share buyback to bank account. I think how many shares we are buying back, sir? 3.75 as per when loan funds are 1200 crores. 3.75 into 30. 3.75 into 30. How much, sir? 112.5 crores. 112.5 crores. Rupees in crores, sir. Okay. Rupees in crores. I'm writing here. So equity share buyback to bank, sir. Second, sir, when shares bought back will be cancelled. When you cancel, your share capital will come down. You are buying back 3.75 equity shares, each share 10 rupees. So 37.5 crores will be debited to share capital, only face value. How much excess you are paying, that will be transferred to premium for buyback, correct? Premium for buyback account debit. 3.75 into 20 rupees, correct? 75. 2 equity share buyback account will be cancelled. That is 112.5. Hello? So therefore the net effect is what, sir? Equity share capital, premium for buyback to bank. Now next, sir, premium will be adjusted to securities premium. What is the securities premium balance? 90. I want to adjust 75. So I can aramse adjust security premium to premium for buyback. Security premium account debit to premium for buyback account. How much, sir? 75. 75. Next, transfer to CRR. Correct? What is the nominal value of shares you are buying back, sir? 37.5. To that extent, you transfer to CRR from free reserves. So what are the free reserves available in the company? General reserve is there, na? So from general reserve, transfer the amount to CRR. How much? Nominal value of shares bought back, 37.5. 37.5. Okay? That's it. They have asked balance sheet? No. They have asked just tell me the maximum number of shares to be bought back. The maximum number of shares to be bought back, and also write the entries. Here entries is possible only when the loan funds are 1200 crores. So this is question, sir. Illustration number 6. So illustration number 6. See the question answer, sir. Once here only 3.75. You see 3.75. It is allowed. I mean 3.75 when the loan funds is 1200 crores. When the loan funds is 1800, 1500, nil. And journal entries, buyback entry, cancellation entry, adjusted to premium, and then transferred to CRR working note. See, please don't follow shortcuts, sir. Some places you see shortcuts. Equation number 1, they don't solve like this. But trust me, this is as per ICA study material. You follow this one. And this is very logical. This simultaneous equation method by applying the provisions of the law. This is correct. If you are following any shortcuts, sir, there is no guarantee that you are going to be allotted marks. And that too, there is more chances that you are doing mistakes. So one structured way I am telling, as per the CA study material, you follow this only. Okay? And if you do perfectly, sir, it will get very complete quickly. Only by practice. See how much time it has taken. First problem around 40-45 minutes it is taken. Now it is taken only 20 minutes. So with practice, in examination they will ask exactly like this. 7 marks question they will ask. So you spend 10 to 15 minutes. You have to complete all of these things. Okay, wow. So these are one type of questions in buyback, sir. This is illustration number 6. So scenario based question number 8, 10, illustration 5, 6. These are all relating to finding the maximum number of shares to be bought back. Next, sir, illustration number 4 in buyback chapter, sir. Very important question. Please see this question. The speciality of this question is, in this question, sir, if you observe carefully, redemption of preference shares concept is there. Buyback is there. Investment in own debentures and cancellation concept is there. ESOPs, employee stock option concept is there. 4 concepts are mixed in one question. That's why in examination, I think already tested previously, and more chances that it may be tested again. Okay. You may get a doubt, sir. We have redemption of preference shares is not there in our syllabus. ESOPs is not there in our syllabus. Investment in own debentures, redemption of debentures not there in our syllabus. Why they will test? Sir, foundation you have redemption of preference shares. Foundation you have investment in, debentures topic. ESOPs, it was previously there in the old syllabus. It is not there in the new syllabus. But if at all they asked in examination, you can't question. It is out of syllabus. 1 or 2 points can be out of syllabus also. And a basic knowledge they are expecting from you. Sir, how can they expect, sir? If some topics are not there in the syllabus, how can they test it in examination? There is a chance that they may test. When they tested, what the only thing you have to solve it. You cannot say this is out of syllabus, allot marks. Those kind of things will not work here. And that too, this question is actually there in the old syllabus. In old syllabus CA Inter, you have all these topics like redemption of preference shares, buyback, debentures redemption, ESOP, all these topics are there. That's why this mixed question is there. But somehow in the new syllabus also this question he has continued. He has not removed it. That means what is his intention? He kept it in the new study material. When some question is kept in the new study material, he can ask in examination. We cannot say it is out of syllabus. Okay? So that's why. So let us read the question first carefully, sir. See this. Illustration 4. There is a company Extra Limited which furnishes you the following balance sheet as on 31st March 2011. Rupees in lakhs. Equity and liability, shareholders fund, share capital, note number 1, 120. Reserves and surplus, note number 2, 118. Non-current liabilities, we have long-term borrowings, note number 3. Current liabilities, trade payables. Asset side, you see non-current assets, property, plant, equipment, non-current investments. Current assets, cash and cash equivalents. Okay. Now notes to accounts, if you see, sir, share capital authorized, issued, subscribed. Equity shares of 10 each fully paid is there. 9% redeemable preference shares of 100 each fully paid is also there. Okay. Reserves and surplus, capital reserve, revenue reserve, securities premium is there. Long term borrowings, 10% debentures is there. So this is the balance sheet of Extra Limited on 31st March 2011. Now next, what they are asking, sir. The company redeemed preference shares at a premium of 10% on 1st April 2011. Sir, this company wants to redeem the preference shares. Redemption of preference shares means paying the amount back to preference shareholders. And that too, their redemption is at a premium of 10%. This is the first thing. So, redemption, due entry, payment entry, transfer to CRR entry. See, buyback, redemption of preference shares. In both these cases, we need to create CRR. I told you in both these cases, what is the common point? Capital is reduced. In buyback also, shares purchased and cancelled, bought back. In redemption of preference shares also, capital is reduced. So there is a gap created by the redemption buyback. We need to fill that gap. How you are going to fill the gap in share capital? Either by fresh issue or by your own profits. Here fresh issue not given. That means from own profits. That means we need to transfer the amount from own profit, free reserves to CRR to the extent of the nominal value of shares so bought back or nominal value of preference shares redeemed. Important actually. Next, the company also bought back 3 lakh equity shares of 10 each at 30 per share. The payment for the above was made out of huge bank balances. So actually we are learning buyback chapter. Relating to buyback also there is one point, second point. So first redemption of preference shares, then buyback. Relating to buyback, what entries we will write? Shares bought back entry, cancellation entry, premium adjustment entry, transfer to CRR entry. 4 entries will come. Next, third point, included in the investment were investment in own debentures costing 2 lakhs, face value 2.2 lakhs, face value 2.2 lakhs. face value 2.2 lakhs. These debentures were cancelled on 1st April 2011. Sir, this company have some investments, sir. Non-current investments. How much is there? 120. Now they're talking about these investments. The investments of this company was investment in own debentures. Company invested in its own debentures. Can a company invest in its own debentures? Company can invest in its own debentures. Either after purchasing its or investing in its own debentures, they can cancel those debentures, or they can hold them as investments. Sir, buyback means what? Purchase of own shares with an intention of cancellation. Here they are not talking about shares, they are talking about debentures. So company purchased own debentures which is held in investment in own debentures. What is the cost, sir? 2 lakhs. Cost of debentures purchased is 2 lakhs. What is the face value? 2.2 lakhs. Hello. That means when the company purchased debentures and cancelled them, what is the value of debentures liability reduced? What is the value of debentures liability reduced? 2.2 face value. But what is the cost we spend? 2. So 0.2 lakhs is what? Profit on cancellation of own debentures. Not loss, profit only. Because see, you are cancelling a liability worth of 2.2 by spending 2 lakhs. So 0.2 lakhs is what? Profit on cancellation of debentures. This profit on cancellation of debentures is my capital profit. Okay. So relating to this investment in own debentures and cancellation, one entry will come, sir. One entry will come. Cancellation entry. Next, fourth point you see. Fourth point they are talking about what? ESOP. The company had 1 lakh equity stock options outstanding on the above mentioned date to the employees at 20 when the market price was 30. This was included under current liabilities. This was included under current liabilities. On 1/4/2011, the employees exercised their options for how many shares? 50,000 shares. Sir, company wants to give shares to its employees, sir. How many options they want to give? 1 lakh. Stock options, equity stock options. ESOPs, they call it as employee stock options. At what price company wants to offer? 20. But what is the market price? 30. So what is the loss? 10. This was included under current liabilities. This loss was, this included under current liabilities. On 1/4/2011, how many employees exercised their options? 50,000. So we need to write the exercise entry. We offered 1 lakh, but finally satisfied and employees exercise their options only for 50,000 shares. See, in ESOPs what happens is, company will announce the plan. Company will tell to the employees that, dear employee, if you satisfy these conditions, you will get this many options. Shares, nothing but. If you want, you can purchase after satisfaction of these conditions. Employee satisfied the conditions. He may exercise the option or he may not exercise the option. So here in this case, you see, company had given 1 lakh options, but ultimately exercised by how many employees? How many shares? 50,000 shares. So we need to write the entry for 50,000 shares in the books of this company. Okay. Past journal entries to record the above, and also balance sheet as on 1/4/2011. So they are asking journal entries as well as balance sheet, sir. So here how many concepts, sir? 4 concepts. What are those? Redemption of preference shares concept, buyback concept, investment in own debentures concept, last concept, ESOP concept. Now relating to all of them, I need to pass journal entries. And also I need to prepare balance sheet after this. Okay. So if I start writing the entries, how I am going to write the entries? Important sum this is. Can you tell me what is the number of the question? Illustration 4. Illustration 4, sir. So in the books of extra limited journal entries. Okay. So all these decisions are happening on 1st April 2011. So on 1st April 2011, sir, first they are deciding redemption of preference shares. Correct now? They are redeeming preference shares at a premium of 10%. So what are the entry we will write? First due entry you will write. So 9% redeemable preference share capital account will be debit. Hello? 9% redeemable preference share capital. How much, sir? 20. And we are redeeming at 10% premium. So premium on redemption of preference shares. 10% means 0.2. Sir, everything is given in crores, huh? Lakhs. Rupees in lakhs. Okay. So 20 into 10%. 2, right? 2. So 9% redeemable preference share capital, premium or redemption of preference share capital account debit to preference shareholders account. 22. Being amount due to preference shareholders on redemption. Next, sir, payment preference shareholders to bank. Preference shareholders to bank account. How much, sir? 22. 22. Preference shareholders to bank. And the most important entry is whenever preference share capital is redeemed, the gap created in the capital is filled by CRR, by creating CRR, if at all company not depending upon fresh issue. So therefore here what is the nominal value of preference share capital reduced? 20. So to the extent of this 20 we need to create CRR. From where? Free reserves. What are the free reserves company had? Revenue reserve is there, na? Capital reserve we cannot utilize. Capital reserve is not a free reserve generally. So revenue reserve 50. So I am transferring from revenue reserve account debit to CRR account. How much? 20. Being the nominal value of preference share capital redeemed. Being nominal value of preference share capital redeemed is transferred from free reserves to CRR. So these are the first 3 entries, sir. Yeah. Premium is there, na? Premium or redemption of preference shares. This premium, buyback premium, I will adjust at the end. Both the premiums I will adjust. So these are the 3 entries: due entry, payment entry, CRR entry. Next, sir, buyback. Now if you see, company bought back 3 lakh equity shares. 3 lakh equity shares buyback. So what is the entry for buyback? Equity share buyback account debit to bank account, right? To bank. 3 lakh shares, sir, each share at 30 rupees. 90, correct now? 90. And then cancellation. Shares bought back were cancelled, so equity share capital will be debited. 3 lakhs into 10, 30 lakhs. Premium on buyback. 3 lakhs into 20, right? Each share is bought back at 30 rupees. So 20 rupees is what, sir? Premium. 60. To equity share buyback account. How much? 90. So therefore equity share capital account debit, premium on buyback account debit to equity share buyback account. So shares bought back shares are cancelled. Premium of this I will adjust later, sir. Next I need to transfer the amount to CRR. How much I need to transfer? 30. Nominal value 30. From where? We have revenue reserve 50, right? But in this 50, how much we transferred here? 20. How much still balance is there? 30. It is sufficient, right? So revenue reserve to CRR you will write. Revenue reserve account debit to CRR account. 30. Okay. 30. So that means second phase is also done, sir. So first phase, redemption of preference shares. Second one, buyback. For your understanding I am writing this. First one, redemption of preference shares. Done. Next one, buyback. Done. The common point in both the cases is CRR. Hello. Next, sir, investment in own debentures. Investment in own debentures. Already investment in own debentures is there. Included in investments, investment in own debentures, cost 2 lakhs, face value 2.2. These debentures are cancelled. So on 1st April 2011, what happened? Cancellation of investment in own debentures. So 1/4/2011. Sir, tell me, sir, when you cancel investment in own debentures, what entry you will write? Already you invested in your own debentures, that was appearing in the investments. Investment side. Investment is basically your asset. So you cancel it, means credit. Which account will be debited? Debentures account. Because you investment in own debentures means your debenture liability is reduced. So therefore the entry is 10% debentures. Correct? So 10% debentures account debit to investment in own debentures. Investment in own debentures account. Sir, tell me, investment in own debentures, how much is there? Include in investments, investment in own debentures, how much is there? 2 lakhs. Given in the question, 2 lakhs. But you purchased your own debentures with 2 lakhs cost, but you are cancelling what is the face value of the debentures? 2.2. So therefore liability reduced to 2.2 lakhs. So therefore what is the balance? 0.2 lakhs. What is this 0.2 lakhs? Profit on cancellation of debentures. Profit on cancellation of own debentures. So profit on cancellation of own debentures, sir. Okay. So we invested in own debentures. Already investment in own debentures is there. Now I cancelled it. See, company purchased its own debentures, invested in its own debentures and cancelled. So debentures liability will be reduced. Always remember, liability is reduced at face value. And investment in own debentures is appearing at cost. The difference between the liability cancelled and the cost is nothing but profit or loss. Here the liability cancelled is 2.2, but you spend 2 lakhs. That means by spending 2 lakhs, you can able to cancel liability of 2.2 lakhs, means there is a gain of 0.2. That is what profit on cancellation of own debentures. Hello. This is one entry, sir. This is the entry we will write for third one. Now the last one is what? ESOP. ESOP entry. Important, sir, ESOP entry on 1/4/2011. See, already how many options company give to employees? 1 lakh. In that, how many options employees are exercising on 1/4/2011? 50,000. See this. On 1/4/2011, employees exercise 50,000 options. So company point of view, you think when employees exercise the option, company will receive the money. That is like employees purchasing the shares of the company. So therefore, company point of view, the entry is bank account debit. 50,000 options they are buying, excising at what is the excise price we have given them? 20. See this. To the employees at 20 when the market is 30. So therefore, 50,000 into 20. 10 lakhs company will receive. Correct? 10. Now the most important thing, sir, see this. When company issuing options to employees, sir, the difference between the market price and excise price, they will amortize it over the vesting period previously to an account called employee stock option outstanding account. I told you in financial statements of company chapter, you remember, reserves and surplus includes ESOP outstanding account. That ESOP outstanding account, I have written also. It is came from ESOP chapter, employee stock option. So that ESOP outstanding is a reserve. Now it will be cancelled. That means employee stock option outstanding account debit. 50,000 options, sir, into the difference between the market price and excise price. What is the market price? 30. What is the excise price? 20. What is the difference? 10. So 50,000 into 10. 5 lakhs. That means 5. Outstanding account. Employee stock option outstanding account is cancelled by 5 lakhs. 2. Equity share capital account. 50,000 into 10. 5. And the balance will be transferred to securities premium account. 10. This is the entry for excise of shares. Being 50,000 options were exercised by the employees. Now here the important point you need to understand is whenever employees exercise the options, what is the entry for company point of view? First, the company will receive the money. Bank account debit 50,000 options into 10. 20. 10 lakhs. Now this entry, outstanding account I cancelled. Sir, why you cancel this employee stock option outstanding account? What is this outstanding account? See, there is a guidance note which is given by ICI in respect of accounting of ESOP. That guidance note says because of the issue of the shares, options to the employees, whatever the loss the company is going to get, that loss will be amortized over a period of time, over the vesting period. So therefore, what is when the loss what the company is going to get, because company is offering shares below the market price, right? Whatever the loss company is going to get, that loss they will credit to an account called employee stock option outstanding account. Now when employees finally exercise their options, sir, this outstanding account will be cancelled. That's why I cancelled outstanding account. 50,000 into 10. See, here you identified 10. Why I multiplied with 10? What is this 10? The difference is market price minus exercise price. What is market price here? 30. What is the exercise price? 20. So the 10 rupees is what, sir? Loss. That loss already we transferred to ESOP outstanding account. Now when employees exercise their option, to the extent of options exercised, you need to cancel that outstanding account. Outstanding account is appearing in the balance sheet under reserves and surplus. When employees exercise their options, this outstanding account will be debited to the extent of the number of shares exercised. That's why see 50,000 into 10. 10 means market price minus exercise price. Hello. This is the important entry. So tell me, when employees exercise their option, what is the entry company will write? Bank account debit. Next, bank account debit. Employee stock option outstanding account debit. 2 equity share capital. 2 general reserve. 2 securities premium. Equity share capital is always credited with face value. Number of options we need to allot to the employees means number of shares. Why I have written outstanding account debit, you understood? Because this loss company is going to get, before writing this excise entry, previously that loss was created to an account called outstanding account, employee stock option outstanding account. This outstanding account is appearing in reserves and surplus. When employees exercise their option, to the extent of the options exercise, whatever the loss is there, that will be reversed in the outstanding account. Hello. That's it. And finally, I told you one more entry I will write. What is that? Premium. Here see, premium on redemption of preference shares, how much? Premium on redemption of preference shares 2. And what is the premium on buyback? 60. Total 62. Adjust with what? Either securities premium or free reserve. What is the securities premium is there? 60 is there, securities premium. Hello? But here now, because of the ESOP, how much added? 10. So total 70 is there. Everybody. So therefore, what is the entry we will write? Securities premium account debit to premium on redemption of preference shares account to premium on redemption of, premium on buyback account. Premium on redemption of preference shares 2, premium on buyback 60, total 62. That's it, sir. This is the entry. Last entry I have written. Being premium is adjusted with the securities premium. Everybody. Sir, this is how you need to pass the entry, sir. Learn, sir, learn. So the important point is when company is going for redemption of preference shares, they need to create CRR. This is the important entry, especially when they are not depending upon fresh issue, similar to buyback. Now you check the entries, sir, all the entries. In fact, I have passed in detail. So the same entries you see there in the solution also. First, preference shares due entry, payment entry, transfer to CRR. Actually in the solution given, sir, they transfer to CRR at a time. See this. Revenue reserve to CRR. How much they transferred? 50. How much we transferred? 50 only, na? See this, 20 for redemption of preference shares, 30 for buyback. Total 50. They only transferred 50. But they have written a combined entry, but I have written single entry. I mean redemption of preference shares separately, buyback separately. Next to equity shares buyback, bought back shares were cancelled. And see, investment in own debentures. Debentures was cancelled, investment in own debentures. The difference is profit on cancellation of own debentures. Next, employees exercise their option. Bank employee stock option outstanding account, which is part of current liabilities. Equity share capital, securities premium. Sir, here one more point, sir. Interesting point, because in the question they have asked balance sheet. They have asked balance sheet also. And you know, in ESOP, sir, you see here in the brackets they have given one point. What is that point? Is this one. See this. This was included under current liabilities. That means generally outstanding account, employee stock option outstanding account, where it will appear? Reserves and surplus. But these people are included in current liabilities. Now outstanding account, how much we cancelled? How much we cancelled? 5 lakhs. So therefore in this question, since they have included in current liabilities, in the affected, next you are going to prepare the balance sheet, right? From the current liabilities you need to reduce 5, because this outstanding account they have included in current liabilities. Generally it should be included in reserves and surplus, but these fellows does not include in reserves and surplus. This is also one of the common doubt most of the students will ask me. Hello? Because the problem is they don't read the question, na? They don't read the question. It is there in the question. See this. This was included under current liability. Therefore, this outstanding account is there in current liability. So therefore, because current liability shows a credit balance, now outstanding account you have debited it. So current liabilities has decreased by 5, which we need to consider in the adjusted balance sheet. Now you are going to prepare the balance sheet, right? In that balance sheet you need to consider it. Yeah. And finally, you know, these premiums they have adjusted, sir. See this. Securities premium to premium on redemption of preference shares. 2. What is premium on buyback? See, premium on buyback also they adjusted directly to securities premium. See this. They have adjusted directly. See, the premium on buyback, they directly debit to securities premium. So if you observe, securities premium debited 60, here debited 2, total 62. That is what I have written. 62 securities premium. But here they have written something different, but overall the entries is same. I have written in a more systematic manner. Subject wise I read. First redemption of preference shares, then buyback. Then this is investment in own debentures. Investment in own debentures. When you invest in your own debentures and cancel them, your liability will be debited, your asset will be credited. The difference is profit or loss. And this was ESOP exercise, employee stock options. Now this is premium adjustment. Premium adjustment. Now sir, important sir, they are asking a balance sheet also, right? Let's prepare balance sheet, sir. Balance sheet. Second point, they are asking balance sheet. Let us prepare balance sheet of the company after happening of all these things. So extra limited balance sheet. So balance sheet of extra limited as on when sir? 1st April 2011. Particulars, note, number, amount rupees. Sir, here you need to consider the effect of these items. I think 4 concepts was affected, na sir. The effect you need to consider. You have to be very careful. The effect you need to consider, sir. Okay. Now first, equity and liabilities. Sir, in examination don't write shortcuts. We are using in classroom shortcuts to save time. Equity and liabilities, in that shareholders funds, correct? In shareholders funds, share capital, note 1. Next, reserves and surplus, note number 2. Money received against share warrant, not there. Share application money pending allotment, not there. Next, non-current liabilities is there. Non-current liabilities. Debentures is there, na? Hello? So non-current liabilities in that long-term borrowings. But in this long-term borrowings, sir, investment in own debentures. Debentures was cancelled. Actually, debentures 4 is there. In that, I think 2.2 worth of debentures cancelled. So 1.8 will be the debentures I need to consider. Hello? Working note, note number 3. Next, deferred tax liabilities not there. Other current liabilities not there. Long-term provisions not there. Next, current liabilities. In current liabilities, sir, first short-term borrowings is there? No. Next, trade payables is there? Trade payables. There. Trade payables. Here they have given trade payables. How much? 70. Everybody. But in this trade payables, that outstanding account is also included, right? That was deducted, that was debited. So therefore, I will prepare note number 4. Trade payables. Next, other current liabilities is there? No. Short-term provisions? No. So therefore, total. Now come to second part, sir. What is the second part? Assets part. In assets, non-current assets. In non-current assets, we have what? PP. There are. Yes. PP is there. Any change in PP? I don't think so. No change, right? No change. So as it is, can I take? Because of the redemption of preference shares, buyback, ESOP exercise, investment in own debentures, our PP not affected. So directly I can take 50. And then non-current investments, sir. Sir, investments, investment in own debentures is there. That was. So therefore, non-current investment. Actually, investment total how much? 120. In this, investment in own debentures 2 is cancelled, na? So therefore, the balance is 118. Next, current assets, cash and cash equivalents. Next one is current assets, cash and cash equivalents. For this, we will prepare note number 5 and then total. So 5 notes to accounts I will prepare, sir. Now first notes to accounts I will start. Notes to accounts. First one is what, sir? Share capital. Now you see here in this question, share capital, preference share capital was redeemed. So therefore it will not be there. Equity shares total 100 lakhs divided by 10. That means 10 lakh shares. In the 10 lakh shares, 3 lakh shares were bought back and cancelled. Hello. That means 7 lakhs will be there. Plus 50,000 shares employees exercised. So 7.5 lakh equity shares will be there. Important. Once again I am telling, sir. Before affecting all these things, you see the total equity share capital is 100. Face value 10 rupee. So that means 100 divided by 10, 10 lakhs. In that 10 lakhs, how many shares we bought back and cancelled? 3 lakhs. So it will be 7 lakhs. Plus how many options employees exercised? 50,000 shares. So 7 lakhs plus 50,000. 7 lakh 50,000. So 7.5 lakh shares will be there after adjustment of all these things. Correct? So therefore issued, subscribe and paid up share capital 7,50,000 equity shares of rupees 10 each, fully paid up. How much, sir? 7,50,000 into 10, 75 lakhs. So can I take 75? Because rupees in lakhs. Hello? 75. And also, sir, here you need to see shares are issued for, shares are bought back, and also shares are issued under ESOP. We need to provide a note. So out of the above, 3 lakhs equity shares were bought back and cancelled. And 50,000 equity shares are issued under ESOP. Correct? This note we need to provide, because schedule 3 says whenever shares are issued for consideration other than cash, buyback, so ESOPs, all these details we need to mention. So therefore my revised capital after these adjustment is 75. Correct? So I will take here 75. Next, reserves and surplus. Now in reserves and surplus, sir, before all these things, what will be the position? Capital reserve 8 is there. Capital reserve 8. Capital reserve 8. Profit on cancellation of own debentures. That profit on cancellation of own debentures we can transfer to capital reserve. Hello? That profit on cancellation of own debentures we can adjust to debenture, this one, what is that? Capital reserve. See this, profit on cancellation of debentures. Add profit on cancellation of own debentures. How much, sir? 0.2 lakhs, 0.2. We already written the entry. If you want, you can check it. 8.2. Everybody? Okay. Next, sir. Reserves and surplus done. Next. CRR is there, na? CRR. How much total we created? 50 we created. Correct? And then next, revenue reserve. RR. Revenue reserve is actually 50. In this 50, how much we transferred to CRR? 50. Total transfer to 50 to CRR. So it will be nil. Hello? Next is securities premium. How much, sir? 60. How much we adjusted? Actually, add securities premium by ESOP, correct? ESOP, how much premium? 10. Less premium on buyback and premium on redemption of preference shares, correct? Premium on redemption of preference shares. Total 62. So what is the balance? 8. That's it now. So these are the reserves: capital reserve, CRR, revenue reserve, securities premium. Total 66.2 crores. 66.2. So take here 66.2. Next, long-term borrowings, note 3. LTBs, long-term borrowings. Actually, in long-term borrowings, we have debentures, right? 10% debentures. 4. In this 4, investment in own debentures cancelled. We cancelled, right? Cancelled. Cancelled, we need to take face value. 2.2 worth of debentures we cancelled. So it will be 1.8. 1.8 LTB, long-term borrowings. Next to trade payables. Note 4, trade payables. What is the balance they given? 70. Less employee stock option outstanding account. So employee stock option outstanding account was reversed. How much? 5. Because see, in the question clearly said that this was included in current liabilities. So if I adjust this employee stock option outstanding account, that means to the extent of employees exercise, to the extent of employee stock options exercised. So to the extent the employee stock options exercised, na sir, we need to cancel. So the balance will be 65. This I will take here, 65. So can you tell me the total? 208. Now asset side, cash and cash equivalents I need to do 5. See, cash and cash equivalents, if you observe, what is the balance given? Balance given 142. So balance 142. Now because of the above activities, what happened? See, 142 less redemption of preference shares. Sir, for preference shares, how much cash we paid? 32. 22. And for buyback, how much we paid? 90. And also we have collected amount from employees for exercising the options. Proceeds from ESOP. Hello, how much amount we collected? 10. That's it, na? Tell me the balance. 40. So this is cash and cash equivalents, 40. So therefore the answer is 208. That's it, sir. 208, balance sheet tallied. So this is a very good question, sir. Please kindly solve this question, because this question involves so many good points. So definitely these type of questions you can get in examination, sir. Okay. So everything in detail I have explained. Balance sheet also see sir. Shareholders fund, share capital, reserves and surplus, non-current liabilities, long-term borrowings, other current liabilities, property, plant, equipment, non-current investments, cash and cash equivalents. So equity shares, cancelled shares issued as ESOP. See here, you need to understand how we got this 7,50,000. Originally how many shares? 10 lakhs. In this, How many cancelled? 3 lakhs. How many issued? ESOP 50. So total 7 lakh 50. This is what we got. Okay. See, in the question, this is given as what? Trade payables. So I also consider the same. Cash and cash equivalents opening balance, payment to preference shareholders, payment to equity shareholders. Equity shareholders means buyback. And this is the price received against ESOP. Correct? You understand this question? That's it, sir. This is one question, very, very important question in buyback we have completed. Okay, good afternoon to everyone. In relation to buyback of securities, we have completed the concept discussion theory. Now let us solve questions relating to buyback of securities, sir. First, see illustration number 1. M Limited furnishes the following balance sheet as at 31st March 2011. Rupees in thousands given, sir. Look at the balance sheet. Equity and liabilities, shareholders funds, share capital. Note number 1. In share capital, this company had, look at notes to accounts, authorized, issued, subscribed capital. 3 lakhs equity shares of 10 each fully paid is there. 20,000 9% preference shares of 100 each is there. Next, reserves and surplus. Look at notes to accounts. In reserves and surplus, capital reserve, revenue reserve, securities premium, P&L account. Next, non-current liabilities, long-term borrowings, note number 3. So in note number 3, we have what? Debentures. Next, current liabilities, trade payables is there. Now look at assets, non-current assets, PPE, non-current investments at cost. Current assets, inventories, trade receivables, cash and cash equivalents. So look at the breakup of PPE, sir. PPE at cost, provision for depreciation separately given. Now what happened? See here, the company passed a resolution to buy back 20% of its equity capital at 15 per share. Sir, this company wants to buy back 20%, sir. See this, 20% of its equity capital at 15 per share. For this purpose, it sold its investments of 30 lakhs for 25 lakhs. They sold investments. 30 lakhs is the sale value, cost to 25 lakhs. Correct? That means profit on sale of investments 5 lakhs. You are required to pass necessary journal entries. Sir, in this question they are just asking what? Journal entries. They are not asking whether the buyback is within the limits or not. No need to test. Test 1, test 2, test 3. I told na, maximum permissible number of equity shares to be bought back. Least of the following 3 tests. That we are not required to do. Here they are asking if the buyback is 20% of its equity capital, then what are the entries you are going to pass? Now, first thing, we sold investments, right? What is the entry you will write? Bank account debit 30 lakhs, investments 25 lakhs, to P&L 5 lakhs. So investments cost 25 lakhs. Hello? 25 lakhs cost. We sold it for 30 lakhs. Profit is 5 lakhs. This is the first entry we will write. Next, buyback entries. Can you tell me buyback entries? First, when company made buyback, it sold investments of 30 lakhs for 25 lakhs. Correct. Wrongly interpreted. I wrongly interpreted. So 30 lakhs investment sold for 25 lakhs. So there is a profit, there is a loss of 5 lakhs. So therefore bank account debit, P&L account debit to investment account. Correct. Next, can you tell me buyback entries? First, when bought back happened, what is the entry? Equity share buyback account debit to bank account. We bought back how much worth of shares? 20% of equity share capital. That means your equity share capital is how many shares? 3 lakhs. 3 lakhs into 20%? 60,000 into each share 15 rupees. 9 lakhs. Equity share buyback account debit to bank. 9 lakhs, 9 lakhs. Correct? Then equity shares bought back will be cancelled. When you cancel, what is the entry? equity share capital account debit 60,000 shares into 10 rupees face value. Premium on buyback 60,000 into 5 rupees. To equity share buyback 9 lakhs. Hello. Next, premium will be adjusted against securities premium. Securities premium is there? Yes. What is the premium amount, sir? 60,000 into 5 rupees. 3 lakhs. In 1000 it is 300. So we adjust against securities premium. What is the entry? Securities premium to premium on buyback. Next, last entry, CRR entry. What is the nominal value of equity shares we are buying back and cancelling, sir? 6 lakhs. To that extent, you need to transfer from free reserves to CRR. Here our free reserve is revenue reserve. Hello. Revenue reserve is there. How much is there? 4,000. But how much we want? Total 6 lakhs, na sir. In 1000 it is 600. So 600 we will transfer from revenue reserve to CRR account. So the entry is revenue reserve to CRR. So that's it. These are the entries we are going to pass. So first, sale of investments entry, sir. Bank account debit. See this. Journal entries in the books of M Limited. Rupees in thousands. First entry you see. Bank account debit 2,500. P&L account debit 500. To investments 3,000. Being investment sold for the purpose of buyback. So here loss came. Correct? Next to buyback entry. What is the entry for buyback? Equity share buyback to bank. Third entry. Actually this entry should come first. Equity share buyback to bank. Being payment made for the purpose of buyback of equity shares. Once bought back happened, bought back shares will be cancelled. What is the entry for cancellation? Equity share capital account debit. How many shares we are buying back, sir? 60,000. Into each share face value 10 rupees. Hello. 6 lakhs. In 1000 it is 600. Premium on buyback 60,000 into 5 rupees. 3 lakhs. That means 300. To equity share buyback account. Now this premium is adjusted against securities premium. Securities premium to premium. And finally, from revenue reserve, I will transfer the amount to CRR to the extent of the nominal value of shares so bought back. What is the nominal value of shares so bought back, sir? 6 lakhs. That I transferred from revenue reserve to capital redemption reserve. Sir, very simple question, sir. Nothing is there in this question. Just 5 entries. You understand? This is the first question. Okay. Illustration number 2, sir. Anu Limited, a non-listed company, furnishes you with the following balance sheet as at 31st March 2011. Rupees in crores at this time. Equity and liabilities, shareholders fund, share capital, note 1. So in note 1, what is there? Look at note 1. Authorized, issued and subscribed share capital, 12% redeemable preference shares of 100 each fully paid. So this company is having preference shares. Equity shares of 10 each fully paid up. This is the share capital. Next, reserves and surplus. Note number 2. In note number 2, capital reserve, securities premium, revenue reserve. 3 reserves are there. Next, sir, current liabilities, they have trade payables. Asset side you see non-current assets, property, plant, equipment, non-current investments. Property, plant, see this property, plant, equipment, PP at cost 100, provision for depreciation also 100, so nil is the value. Investments, sir, non-current investments at cost given. But the market value of the investment is how much? 400 crores, but the cost is 100. Sir, in balance sheet, investments are valued at cost, not market value generally. So that's why cost, whichever is lower basically. So here, non-current investments are generally valued at cost as per AS 13. So we are valuing at cost. Current assets, if you see, they have trade receivables, cash and cash equivalents. Total. Now see what they have given in the additional information. The company redeemed preference shares on 1st April 2011. Sir, important sir. The company redeemed preference shares. They have redeemed preference shares on 1st April 2011. That means immediately after balance sheet date. Balance sheet date is 31st March 2011, right? Immediately after balance sheet date, the company redeemed preference shares. What is the preference share capital of the company? 75 crores. They have repaid the amount to preference shareholders. Redemption of preference shares. Next, it also bought back 50 lakh equity shares of 10 each at 50 per share. See this. It also bought back 50 lakh equity shares of 10 each at 50 per share. So the company is going for buyback also. The payment for the above were made out of the huge bank balance, which appeared as a part of current assets. So the payment for buyback is made from the huge bank balances. This bank balance is included in current assets. Now, what they are asking, you are required to pass journal entries to record the above and prepare the balance sheet as at 1/4/2011. So they are asking to pass the entries as well as balance sheet after these three. After these things are happened, what will be the balance sheet position they are asking? Now come on sir, tell me in this question what are the major things happening? Redemption of preference shares, buyback. Redemption of preference shares, first thing. Redemption of preference shares means repaying the amount back to preference shareholders. So what is the entries we will write? Preference share capital account debit to preference shareholders account. Correct? Preference share capital to preference shareholders. Preference shareholders to bank. Khatam. Everybody. But one important thing which is common for both redemption of preference shares and buyback is creation of CRR. Sir, whenever buyback happened, sir, to the extent of the nominal value of the shares so bought back, we transferred from free reserves to CRR, sir. When company depend upon the free reserves or securities premium. Same point is applicable for redemption of preference shares also. Whenever a company is going for redemption of preference shares, because of the redemption of preference shares, your preference share capital reduces. There is a scale down of capital, just like in case of buyback of securities. So therefore, CRR will be created in case of redemption of preference shares also. To the extent the nominal value of preference share capital so redeemed, we need to transfer the amount from free reserves to CRR, provided you are not depending upon the fresh issue. If you are depending on the fresh issue, I told you no need to create CRR. So therefore understand sir, as far as CRR is concerned, it is applicable for both buyback as well as redemption of preference shares. If you look at the Companies Act, this point is there, section 55, which talks about redemption of preference shares. If you read that section, in that section they clearly mention that whenever a company redeemed its preference shares by its own profits, free reserves, then to the extent of the nominal value of shares so redeemed must be transferred from free reserves to CRR. Therefore, we need to transfer the amount to CRR. What is the face value of the preference share capital we are redeeming, sir? 75. So to this extent, we need to transfer from free reserves to CRR. So 3 entries will come in case of redemption of preference shares. So illustration number 2, sir. We'll pass the entries. Anu Limited. In the books of Anu Limited journal entries. So first write entries relating to redemption of preference shares, sir. First entry, due entry, 12% redeemable preference share capital account debit 75, 12% redeemable preference share capital account debit to preference shareholders account, right? 75. Sir, rupees in crores, sir. Rupees in crores. Being amount due to preference shareholders, correct? I am not writing the narration, sir. You can write the narration. Narration is nothing but brief summary of what transaction is. So first amount due to preference shareholders. Then you pay the amount to them. Preference shareholders account debit to bank account. How much, sir? 75, 75. Being amount paid to preference shareholders. Next, sir, the most important entry is what is the nominal value of preference share capital reduced, sir? 75. So to that extent, we need to create CRR because here company depends on its free reserves. It is not going for any fresh issue. So what are the free reserves this company had, sir? Revenue reserve is there. Check it. Revenue reserve. So revenue reserve account debit to CRR account. How much? 75, 75. 75, 75. So therefore first 3 entries is done. See, most of the students write first 2 entries, but they will not write entry number 3 because they don't know section 55. See, this is as per Companies Act, sir. This is as per Companies Act 2013. Whenever a company is redeeming its preference shares to the extent of the nominal value of preference shares so redeemed, in case you are depending upon its existing free reserves, then you need to transfer the amount to CRR. Logic is same as buyback. Capital intact to protect the interest of creditors. Now buyback happens, sir. Next what happens, sir? Buyback. What are the entries we will write for buyback, sir? Company bought back how many equity shares? 50 lakhs equity shares of 10 each at 50 per share. So what is the entry? Equity share buyback account debit to bank account. First, when bought back happened. Equity share buyback account debit to bank. 50 lakhs equity shares into each share is bought back at how much, sir? 50 rupees. So 50 lakhs into 50. So it will be 2,500 lakhs. But we are writing everything in crores. Hello. So therefore 25 crores. Equity share buyback to bank. Sir, please understand. 50 lakhs they have given. Some students 50 lakh shares into rupees 50 per share. Now once you buy back, next entry, sir, bought back shares will be cancelled. When cancelled, what is the entry? Equity share capital account will be debit. Premium on buyback. Premium on buyback account debit. Premium on buyback account debit to equity share buyback account. Correct? Buyback account. How many shares we are buying and cancelling, sir? 50 lakhs. Into each share face value 10. Correct? Sir, face value 10 rupees, sir. So 0.5 into 0.5 crores into 10. How much, sir? 0.5 into 10. 5. 5 crores. And 0.5 crores shares into each share is bought back at what value, sir? 50. Correct? That means 40 rupees is the premium we are paying. Because one share is bought back at 50 rupees, na, sir? 10 rupees face value. 0.5 into 40. How much, sir? 20. 25. So equity share capital account debit 0.5 crores into 10. Premium on buyback 0.5 into 40 rupees to equity share buyback. So therefore what is the net entry here? Equity share capital account debit, premium on buyback account debit to bank account. Next, sir, this premium will be adjusted against securities premium. Hello? Our securities premium is how much, sir? 25. 25. And we need to adjust 20. So let us adjust it. Securities premium account will be debit. Premium on buyback account will be credit. How much, sir? 20, 20. 20, 20. Next, sir, transfer to CRR. What is the nominal value of equity shares bought back and cancelled? 5. To this extent, we need to transfer the amount from free reserves to CRR. Here in this question, what is the free reserve? Revenue reserve. Hello? Revenue reserve, how much is there? 260. In that already, for redemption of preference shares, how much we transfer to CRR? 75. So 260 minus 75 means still 185 is there. I want only how much? Nominal value of shares so redeemed, 5. I will transfer. That's it. 5. So transfer to CRR happened in 2 times. One is redemption of preference shares, another one is buyback. In both the cases. So therefore, how much is transferred to CRR? This is 75, this is 5. Total 80. 80 was transferred to CRR. Okay. So you can check, sir, whether the entries we have done correctly or not. So first entry, see, due entry, preference share capital to preference shareholders, then paid preference shareholders to bank. And CRR entry they have written last, combined entry they have written, revenue reserve to CRR, 80 they have written. 80 means for redemption of preference share 75, for buyback 5 total. We have written 2 entries here separately. 75, 5. They have written 1 entry, combined entry, for a total 80 lakhs to be transferred to CRR. Now when equity shares are bought back, what is the entry? Shares buyback to bank. And shares bought back will be cancelled. What is the entry? Share capital account debit, securities premium account debit to shares buyback account. That's it, pa. So tell me, any difficulty here? Hello? You understood? Now they are asking balance sheet also. They are asking balance sheet after these adjustments. They are asking balance sheet also, right? Balance sheet as on 1/4/2011. That means after redemption of preference shares and buyback, what will be the balance sheet position? So, we have already learned how to prepare the balance sheet of a company. Let us apply it. So, balance sheet of Anu Limited as on 1/4/2011. Yes, 1/4/2011. Particulars, note number, amount rupees. And I already taught you how to prepare balance sheet of a company. First we need to write the format. Then we need to try to fill the each notes to accounts. Tell me what is the balance sheet first part, sir? Equity and liabilities, correct? In equity and liabilities, shareholders funds. In shareholders funds, the first one share capital, second one reserves and surplus. Share capital note 1, reserves and surplus note 2. Next, any money received against share warrants? No. Share application money pending allotment? No. Next, non-current liabilities. Any long-term borrowings? Yes, long-term borrowings there are? No. No, not there. Next, current liabilities. Yes. Hello. So we have current liabilities. In current liabilities we have what? Trade payables. Trade payables is there. What is the trade payables amount, sir? 40. So directly take 40. Okay. Next, this is the total of equity and liabilities. Now the second part, sir, assets. In the asset side, what is the first one, sir? Non-current assets. There are? Yes. Non-current assets. In non-current assets, we have property, plant, equipment. PP, how much, sir? Nil. Hello. Actually, nil. Because they have given the cost as well as WDV, accumulated depreciation. So present here, note number 3. Here I will take nil. Okay. Next, non-current investments. But in this question, sir, investments were sold. Oh no, sorry, that was the last problem. Investments are there, correct? So non-current investments. What is the non-current investment, sir? How much? 100. 100 is there. So take it 100. Non-current investments we are not selling. Okay. Next, current assets. So current assets. In current assets, the first one is trade receivables. So trade receivables, how much? 140. Hello. Next, cash and cash equivalents. Cash and cash equivalents. Sir, you need to think like this. What is the balance sheet position before redemption and buyback? Now after redemption and buyback, what is the effect in the balance sheet? Because of redemption of preference shares, buyback, what happens, sir? Share capital reduces, equity share capital, preference share capital reduces, free reserves transferred to CRR, amount paid. So cash and bank balance will change. Okay. So cash and cash equivalents, I will prepare note number 4, sir. I will prepare note number 4. Directly I cannot take cash and bank balance. Why? Because of buyback, because of redemption of preference shares, some cash balance was adjusted. Some payments were made. Then total. Now prepare notes to accounts, sir. Notes to accounts. Notes to accounts, if I prepare, na sir, first share capital, right? In share capital, look at share capital of this company, authorized, issued, subscribed share capital, 12% redeemable preference shares of 100 each. Sir, preference shares was redeemed, so they will not be there in existence. And equity shares total 25 crores, correct? Hello? Of rupees 100 each. That means 25 lakh shares. In that 25 lakh shares, how many shares are bought back and cancelled? Sorry, total how many shares, sir? 2.5 crore shares, correct? 25 is the total equity share capital, 25 crores divided by face value 10. So that means 2.5 crores. In that 0.5 crores was bought back and cancelled. That means the remaining 2 crores. That will be the remaining capital of the company after buyback and redemption. So share capital, what we need to write is issued, subscribe and paid up share capital. Issued, subscribed and paid up share capital. We need to write 2 crores equity shares of rupees 10 each. 10 each fully paid up. 2 crores equity shares of rupees 10 each fully paid. How much, sir? 2 crores into 10, 20 crores. Everybody, very simple, yaar. Before preference share capital you redeemed means it is not there. Equity share capital total 25 crores. Each share 10 rupees, 2.5 crores shares. In that 50 lakhs bought back and cancelled. So 2 crore shares will be there after buyback. So that's why 2 crores equity shares of 10 each fully paid 20. So therefore what is the total share capital? 20 crores. So take this in balance sheet 20. Now come to reserves and surplus, note number 2. Now as far as the reserves and surplus is concerned, tell me what are the reserves and surplus? First capital reserve, will it change? No. How much? 15. And CRR will be created. How much created? 80. And then securities premium. Securities premium, how much is there? 25. Out of this 25, how much we used? See this, 20 already used for premium on buyback, minus it. Used for buyback. How much we used for buyback? 20. Then what is the balance remaining? 5 after the effect. Next reserve, revenue reserve. Hello? What is the revenue reserve balance? 260. In this 260, sir, how much we transferred to CRR? 80. 80 was transferred. So what is the balance remaining? 180. That's it. You look at these entries, sir, where reserves are got affected. 75 and then 5 to 80. 80 and also 20 this one adjusted. So what is the balance? 280. Reserves and surplus 280. So take this in balance sheet. So what will be the total? 340. Come to asset side. Non-current investments, trade receivables, cash and cash equivalents we'll see. Note 3. Sir, note 3 PP. PP directly take what is given in the question. Cost given. How much? 100. Provision for depreciation, that is also 100. So therefore balance is nil. Okay, just presentation is required, whether even though it is a nil. And what is the fourth one, sir? Cash and cash equivalents. Cash and cash equivalents. Cash and cash equivalents. Now cash and cash equivalents, already how much is the cash balance available? 200. Balance 200. Tell me, less proceeds used for redemption of preference shares. Tell me how much proceeds we used for redemption of preference shares. How much proceeds? Check the entries we have written, sir. Bank. See this, preference shareholders to bank. 75. 75. And also, sir, how much you used for buyback? Proceeds used for buyback. How much? 25. Any other amount utilized? Nothing, right? So tell me what is the balance? 100. This is the cash and cash equivalents balance after redemption and buyback. 100. So minus the add 100 here, you take it. Total 340. Tallied? Yes, tallied. Okay. So this is question number 2, sir. Illustration 2. In this illustration, there is a redemption of preference shares and also buyback. Sir, what is the important point you learned? In case of redemption of preference shares, also there is a creation of CRR, just like buyback. What is the common point in buyback and redemption of preference shares? In both the cases, capital is reducing. In buyback, capital is reducing. In redemption of preference shares also, capital reducing. Once there is a scale down of capital, what we need to do? We need to fill the gap. Whatever the capital reduced, that capital we need to fill. How we are going to fill it up? Either by fresh issue or by using your existing profits. Your existing profit means first you need to transfer the amount from free reserves to CRR. Then utilize this amount to issue fully paid bonus shares. Sir, this CRR we created as 75. 5. Total CRR is how much? 80. What we need to do this CRR? Fully paid bonus shares. That means this 80 will become share capital in future. So because of buyback and redemption of preference shares, capital reduced now. Now the capital is filled up because of the buyback, because of this CRR. You understand this? That's it, sir. This is illustration 2. Next is, sir, illustration number 3 in buyback. There is one good point in this question, sir. Except that point, remaining everything is same, as already we have solved these type of questions. See this question. There is a company D Limited. The balance sheet of that company as on 31st March 2011 given, sir. Rupees in 1000, sir. Carefully observe equity and liability, shareholders fund, share capital is there, note 1. Reserves and surplus, note 2 is there. Share capital, reserves and surplus, note 1 and 2. Current liabilities, they have trade payables. Asset side, you see, non-current assets, property, plant, equipment, non-current investments is there. Current assets, inventories, trade receivables, cash and cash equivalents. Now I want every one of you to see the notes to accounts carefully. Notes to accounts, you see. Share capital. Authorized, issued, subscribed. 2,50,000 equity shares of 10 each fully paid. 2,500. Sir, rupees in thousands. Hello. Number of equity shares how many? 2,50,000 equity shares. Now look at this. I am putting a star mark also. Look at this. 2,000 10% preference shares of 100 each issued 2 months back for the purpose of buyback. Say this. Sir, that means in this question, this company is depending upon fresh issue. What are the sources for buyback? 3 sources I have told. Free reserves, securities premium, proceeds from fresh issue. Now when in this case, you see here, the company passed a resolution to buy back 20% of its equity capital at 50 per share. That means they want to buy back 20% of their equity shares. Hello? That means 2,50,000 equity shares, sir. Everybody. 2,50,000 equity shares into 20%. 50,000 equity shares, correct? What is the face value of each equity share? 10 rupees. That means 5 lakhs. Everybody. In thousands, 500. So see this. So because of buyback, how much is the equity share capital is reducing? This is the nominal value of share capital reduces. I told you whatever the nominal value of share capital reduced because of buyback, we need to fill. How? Either by fresh issue or from existing free reserves or securities premium. In this case, you see, 2 months back, company issued preference shares. Now through preference share capital, how much capital gathered? That means in this 500, already we filled 200 by fresh issue. That means what is remaining? 300. We are depending upon free reserve securities premium. Therefore, how much amount you transfer to CRR? 300. That is the only twisting point in this question. How much amount you transfer to CRR? 300. You understood the logic? Because here you need to understand company is buying back 20% of its equity capital. That means 50,000 shares of 10 each. Face value see 5 lakhs. In thousands it is 500. 500,000 face value of equity shares reduced. Whatever the face value of shares reduced, we need to fill. How? By fresh issue or free reserve securities premium. In this case, clearly said 2 months back we went for issue of preference shares. Because of preference shares, how much capital we got? 200. That means 2 lakhs, nothing but. That means how much is the gap? 300. That is filled by fresh issue. That's why we need to transfer from free reserves to CRR how much? 300. See this. This is the important entry in this question. 300, 300. Okay. Now what they are asking in the reserves and surplus, capital reserve, revenue reserve, securities premium, P&L they are asking. They are given. For this purpose it sold all its investments for 22 lakhs. Investments actually 3,000. 30 lakhs. Investment 30 lakhs in rupees. We sold it for, so there is a loss 8 lakhs. So what they are asking, you are required to pass necessary entries and prepare balance sheet. So we need to pass the entries and prepare the balance sheet. So necessary entries means first sale of investments entry, then buyback entry, shares bought back cancellation entry, premium adjustment entry, transfer to CRR entry. 5 entries will come. First sale of investments, what is the entry? Bank account debit, P&L account debit, 2 investments. Bank account 22 lakhs, P&L account 8 lakhs, 2 investments 30 lakhs. Next equity share buyback to bank account. How many shares we are buying back? 50,000. Each share is bought back at 50. 50,000 into 50. 25 lakhs. In thousands it is 2,500. Equity share buyback to bank. Then cancel the shares bought back. Equity share capital account debit, premium on buyback to equity share buyback account. Then premium is adjusted against securities premium. Already there. Then transfer to CRR, just now I told you, 300, 300. So see this, everybody. Journal entries in the books of D Limited. First sale of investments, bank to P&L to investments. Bank account debit, 22 lakhs. In thousands they are taking. P&L account, this is loss, sir, loss on sale. Investment account, being investment sold at a loss for the purpose of buyback. Next, equity share buyback to bank account. How many shares we are buying back? 50,000. Each share is bought back at 50. So 50,000 into 50, 25 lakhs. If you convert into 1000, it is 2,500, 2,500. Being payment made for buyback. Next, bought back shares were cancelled. If you cancel, what is the entry? Equity share capital account debit. How many shares you are cancelling? 50,000. Each share face value you need to take. 50,000 into 10, 5 lakhs. In 1000, it is 500. Hello? No, 50,000 into 10, 5 lakh. Correct only. Next, premium on buyback. 50,000 into each share you are buying at 50 rupees, face value 10. 40 rupees extra you are paying. 20 lakhs, right? 2,000 in rupees. Equity share buyback account. You understand this? Now this premium on buyback, how much, sir? 20 lakhs. It is adjusted against securities premium. What is the securities premium amount? 22 lakhs is there. Adjust securities premium to premium. And the most important entry, this one, you understand this or not, tell me? Yeah, being the amount equal to nominal value of equity shares bought back out of free reserves transferred to CRR. Actually, when you are reading the question, this is the twisting point. You should read this carefully. 2 months back, company already issued preference shares for the purpose of buyback. So therefore, by issue of preference shares, how much capital already created? 200. Therefore, because of buyback, 5 lakhs capital reduced, but 2 lakhs capital already filled by fresh issue. Only 3 lakhs we need to fill it by transferring from free reserves to CRR. This is the concept I told. Hello? That's it. Now, once you write the entries, they are asking balance sheet. If I start preparing balance sheet, first I will consider equity and liabilities, shareholders funds, share capital. In share capital, see this. Preference share capital, okay, equity share capital first you take 2,50,000. In this 50,000 you are buying back and cancelling. That means how many shares? 2 lakh shares. After buyback, 2 lakh shares will be there. 2 lakhs equity shares of 10 each fully paid. 2,000 in thousands. See this. Authorized, issued, subscribed. 2,50,000 equity shares of 10 each. 2,000. Hey, wrong here. Please change it. Not 2,50,000. 2 lakhs this is. Wrongly given. Please make it 0. Because total 2,50,000 shares, in that 50,000 were purchased and cancelled. So 2 lakh shares will be there. Preference shares, there is no change, right? What is the preference share capital? Yes, 2,000, 10% preference shares of 100 each, 200. That will be same. See this. Issued 2 months back for the purpose of buyback. So total capital 2,200. That means 22 lakhs. See here, you need to provide a note. They forgot the note. What is that note? Out of the above, 50,000 shares were bought back and cancelled. 50,000 equity shares were bought back and cancelled. That note, they have missed it. We need to take it, sir. So capital done. Next, reserves and surplus, sir. So come to reserves and surplus. Capital reserve, same 1,000. Revenue reserve. See, from revenue reserve, how much we transfer to CRR? 300. So it will be 2,700. Securities premium, we adjust premium, right? How much premium we adjust? 2,000. So balance 200. P&L account, it will be P&L account, and there is a loss on sale of investment 800. Adjust it. So 3500 minus 800. 2000. This is. So simple. What are the reserves will be adjusted? You need to see. So first capital reserve 1000. CRR created 300. Securities premium 2200. We adjusted for premium on buyback of shares 2000. Revenue reserve 3000. How much we transferred to CRR? 300. P&L account 3500. Loss on sale of investment adjusted. So therefore 6900 is the reserves and surplus. Hello? 6900. Next remaining and all I think same, right? Like for example, current liabilities, trade payables, same only 1400, no change. Total 10,500. Now come to asset side. Asset side you see first one PP 9,300. I think no change, right? PP also same. See this 9,300. Because of buyback it is not affected. Current assets, inventory same 500. Trade receivables 200 same. See this 500 200. Non-current investments, actually investments were sold. So therefore investments will not come. Hello? All investments are sold. Next to inventory is this one. Cash and cash equivalents you see 800, right? And for buyback how much you are using? Buyback equity share. See, important sir. See this. Your cash and bank balance is 800, right? Because of sale of investment you are getting 2200. So 800 plus 2200. For buyback how much you are spending? 2500 minus. So 500 is the closing cash balance. Hello? Closing cash balance 500. How you got this closing cash balance? Tell me. Opening cash balance how much given here? 800 plus from sale of investments we got 2200 minus for premium, I mean we paid for buyback how much? 2500. I think this is the balance left, correct? If you want you can prepare cash and bank account also. Nothing? Great. So this is one question. Mark it as important because this point. Here the main testing point is this. How much amount to be transferred to CRR? This is the highlight point. I explained it. Hello? Okay sir. Next scenario based question 9 sir. Sir, in buyback chapter sir, always they will mix buyback with some other concepts sir. We have seen, in illustrations, buyback is mixed with redemption of preference shares, one problem. In another problem, buyback is mixed with ESOP, investment in own debentures, like that. Now in this problem sir, buyback mixed with the bonus issue. You know the logic why bonus issue is mixed with buyback? Can anybody tell me the logic? Yeah, very good. We created CRR, right? The CRR is utilized only for fully paid bonus shares. The continuation act after the buyback, the next act is bonus issue only. Because of the buyback, we create CRR, right? When we depend upon the free sources. So to complete that cycle, company next announce the bonus. Because CRR again will convert it into share capital only. Our main object is what? Because of buyback, because of redemption of preference shares, both these cases our capital is reducing. Whatever the capital reduce, we need to fill it up. Hello? If you go for fresh issue, no need to create CRR. You created CRR means you are not went a fresh issue. You are using your own free resources, own reserves. So you transferred amount to CRR. Next CRR will be converted into equity share capital. How? By way of bonus. So in this problem sir, they mixed with bonus sir. See this. Simple question only. See this question. KG Limited. This company balance sheet is given sir on 31st March 2011. Equity and liability, shareholders funds, share capital, reserves and surplus, note 2. Non-current liabilities, long-term borrowings. Sir, this is note 3. Okay, 750. Current liabilities, trade payables sir, 745. Other current liabilities also there, 195. Hello? Asset side you see non-current assets, property, plant, equipment, non-current investments. Current assets, inventories, trade receivables, cash and cash equivalents. If you see the share capital, authorized, issued, subscribed, equity share capital, fully paid shares of 10 each is there. Reserves and surplus, you see, securities premium, general reserve, capital redemption reserve. Already CRR is there. See this. In this question, CRR is there. Already in any company balance sheet, CRR there means already in previously company might done buyback or my company done redemption of preference shares. That's why CRR is already created in the books. Hello. And then P&L account. Long-term borrowings, debentures is there. Property, plant, equipment, land and building, plant and machinery, net carrying value is there. Next to what happened? See, this is the balance sheet of KG Limited on 31st March 2011. Hello. Next to what happened, sir? See this. On 1st April 2011, the company announced buyback of 25% of its equity shares at 15 per share. For this purpose, it sold all of its investments for 75 lakhs. On 5th April 2011, the company achieved the target of buyback. On 30th April 2011, the company issued one fully paid equity share of 10 by way of bonus for every 4 equity shares held by the equity shareholders. See this. That means after the buyback, company announced bonus. How bonus they are giving? One fully paid bonus shares. Fully paid up equity share of 10 by way of bonus for every 4 equity shares. So that means CRR to bonus, bonus to share capital. 2 entries will come. When company declared bonus, CRR account debit to bonus to shareholders. Bonus to shareholders to share capital account. That's it. Because here company, doing buyback, right? At the time of buyback, if they are not depending upon fresh issue, there is no fresh issue here. That means we create CRR to the extent of the nominal value of shares bought back. Now that CRR amount already in the question CRR is there. How much is there? 200. Hello. Already in the reserves and surplus CRR is there. Now again CRR will be created here. That will be utilized for issue of fully paid bonus shares. Now what they are asking? Past necessary entries and also balance sheet after the bonus issue of shares. Come on, tell me what entries you will write. First investment sold, correct? They sold all the investments for 75 lakhs. What is the investment value? 74. They sold it for 75. So this is a profit. So bank account debit to investments to P&L. Next equity share buyback to bank account. How many equity shares they are buying, sir? 25% of equity shares. How many equity shares are there? 1200. 1200. 10. 120. 120 into 25. 30 into 15. 450. Correct? Equity share buyback account debit to bank account. 450. 450. Next bought back shares will be cancelled. Equity share capital account debit. Premium on buyback account debit to equity share capital buyback. Equity share buyback account. Then premium on buyback is adjusted with the securities premium. Securities premium is there. Then transferred to CRR. Hello. So these are the entries, common entries. Now apart from that, bonus entry will be written. Bonus entry will be written. That is the important entry. See the first one in the books of KG Limited. What are the entries we will write? First April 1st. Sale of investment. Bank account debit investments to profit on sale of investment. Correct? Okay. Rupees in lakhs, sir. Here in the question I think they have not given. Please update here. Rupees in lakhs. You add. Rupees in lakhs. Rupees in lakhs. Okay. Next, April 5th buyback. First buyback entry. Equity share buyback to bank. Sir, how many shares we are buying back, sir? 25%. Correct? Total equity share capital 1200 lakhs. Everybody. That means 120 lakh shares. In that 120, 30%. How much? No. In that 120, 20%. 20%. 25. How much? 30. So 30 into one share bought back at what price? 15. So equity share buyback to bank 450. Correct? Now bought back shares were cancelled. When you cancel equity share capital, 30 into face value 10, 300. 30 into premium 5 rupees, 150. So bought back cancelled. Then This premium, sir, premium they have directly adjusted to securities premium, see. Directly adjusted. But we will write separate entry, sir. Here you write premium on buyback, later on premium on buyback adjust with securities premium, like we are doing in other problems. But here they directly adjusted to securities premium. This is also right, sir. If you want to write like this, it is also right. Nothing wrong. Premium on buyback directly adjusted to securities premium. Or else, if you write this entry here, you write premium on buyback. Later on, you adjust separately. Like other problems we are solving now. Solved now. Now transfer to CRR, you see. What is the nominal value of shares we bought back and cancelled? 300. So to this extent, I need to transfer from free reserves to CRR. In my free reserves, I have general reserve. How much is there? 265. So therefore, still how much I want? 35. So therefore, see, general reserve I am using 265. P&L account I am using 35. I transfer to CRR. And the most important entry is, the most important entry is this one, bonus. I told you, sir, here already in your books CRR how much is there? Now you created 300, total 500. Now this CRR does not have any purpose, only one purpose is fully paid bonus shares. So CRR to bonus shares to share capital. This is the entry. CRR account will be debited, bonus to shareholders account will be created, bonus to share capital will be transferred. Now here, how much is the bonus shares we are giving, sir? 1:4, what is the ratio? For every 4, we are issuing 1. So therefore, actually, in the company, total 120 lakhs is there, correct? 120 lakh shares. In that, how many shares we are buying and cancelling? 30. That means 90. Everybody, 90. Divided by 4 into 1, 22.5. So we are issuing 22.5 lakh shares as bonus shares. Into each share 10 rupees, 225. We need to multiply with face value. That means the face value of the shares we are issuing is 225. 225. I think they have done working note 1. Okay. Working note 1. Where? Yeah, this one. See this. Amount of bonus shares, 25% of this. Already 1200 is there, in that 300 cancelled. So that means remaining balance on the 25%, that is 225 lakhs. Hello? So you understand this entry? Bonus entry, can you tell me here? CRR to bonus to shareholders. You understand that circle? Buyback, because of buyback CRR created, CRR issued bonus converted as share capital. Now the concept is this. Because of buyback, your capital reduced by 300. See this, your capital reduced by 300. 300 reduced. In this 300, how much now you are issuing as bonus? 225. That means to the extent capital filled up, 225. Remaining you will issue in the future. Hello? Now, after this, you need to prepare the balance sheet. Balance sheet is also easy. Share capital first you take. Now, share capital, tell me how much it will become. Original, it is 120, right? Hello? Original, it is 120 lakhs. In that 30 lakhs cancelled. Now, 22.5 lakhs issued. Bonus. So, 120 minus 30 plus 22.5. How much, sir? 1112.5 into 10. So 1125 is the capital. Here they have not given detail, plus you write down equity share capital, you write down here 1112.5 lakh equity shares of rupees 10 each, fully paid up. Fully paid. Hello? And you provide a note also. Note. Out of the above, 30 lakh shares were bought back and cancelled. 22.5 lakh shares are issued as fully paid bonus shares. Because Schedule 3 says whenever shares are bought back, issued for consideration of fully paid bonus shares, they need to mention the aggregate number, class of shares. Hello? Next, reserves and surplus, you see. General reserve, totally utilized. CRR created now. CRR, how much created? 200. I think they have not properly given here. So reserves and surplus, If I do, tell me in this question what are the reserves and surplus status. Securities premium first you take. How much is there? 175. Correct? In this 175, how much you used for adjustment of premium on buyback? 150. So 150 reduce. So what is the balance left? 25. Correct? 25. Next reserve, general reserve, 26. General reserve 265. Total 265 used. So it will be nil. Hello? Next, CRR. CRR already how much is there? 200. How much is added during the year? 300. How much you added, sir? 300 we added, na? How much is for bonus? 225. So it will be balance 275. This is CRR balance. Correct? And then P&L account. P&L account opening balance 170, right? And you sold investments. Because of the investments you got a profit 1. Add 1. And also you used for CRR creation 35 minus 35. Okay? Any other item? That's it. So tell me. 136. You add all these things. 25 plus 275. 300. 300 plus 136. 436 is the total reserves and surplus. Correct? You see, 436 is the reserves and surplus. I think they have not given properly. Please check it properly here. 436 total correct only, but whether they have given proper adjustments or not, you check once. Okay? Next, non-current liabilities, I think same only, long-term borrowings. Current liabilities, trade payables, other current liabilities, same. Non-current assets, property, plant, equipment, same. Investment sold. Current assets, inventory, trade receivables, cash and cash equivalents, you check. Cash and cash equivalents is actually 740 given, and how much we used for here, investment we sold, add 75 minus 450. How much we got? 360. That's it, 365. Given a note also, see this. Cash balance 740, sir. Sale of investment 75. Payment for buyback 450. So 365. Hello? I think that's it. Okay? So this is SBQ 9. The speciality of this question is what? Bonus issue. Buyback is mixed with bonus. Check it once. Okay? So next SBQ 11, sir. This scenario based question 11, they have given balance sheet of Jet Limited, sir. In this question, if you observe, they are redeeming preference shares at a premium of 10% and also buying back 10% shares. Selling investments. I think this question is exactly same as illustration 2. Illustration 2, sir. You solve illustration 2, automatically this question will be taken care. Nothing great, sir. Same in that question, I think we solved balance sheet also we have drafted. Same manner, sir. Nothing great. You can easily solve this question because it's a repetition. Okay, sir. Now questions from MTPs, RTPs and past exam papers from Buyback chapter, sir. So see these questions, sir. First question number 1, which is MTP May 22 question, sir. See this question. There is a company Complicated Limited, sir. Their balance sheet given on 31st March 2016. Equity shares of 10 each fully paid up. Bonus shares of 10 each fully paid up. Share option outstanding account. Sir, share option outstanding account, where it will come? Reserves and surplus. In financial statement chapter, I have told you. Revenue reserve, securities premium, P&L, capital reserve, unpaid dividend, where it will come? Other current liabilities. 12% debentures, advance from related parties, current maturities of long term borrowings. Current maturities of long term borrowings, where it will come? Short term borrowings. Next, application money received for allotment due for refund. Application money due for refund, where it will come? Other current liabilities. Financial statements of company chapter. Any application money pending allotment. Pending allotment? No. Shareholders funds, after that separate head. Share application money pending allotment. Already allotment done, some of the applications were rejected, so application money due for refund. That will come in other current liabilities. So this is OCL. So these are the equity and liability side, sir. Liability side. Now asset side, property, plant, equipment, current assets. So this is the balance sheet position of Complicated Limited on 31st March, sir. Next, what happened, you see? The company wants to buy back 25,000 equity shares of 10 each on 1st April 2016 at a 20 per share. Sir, this company wants to buy back 25,000 shares, sir, at 20 rupees per share. Buyback is duly authorized by the articles. Necessary resolution has been passed by the company towards this. The buyback of shares by the company is also within the provisions of Companies Act. The payment for buyback of shares will be made by the company out of sufficient bank balance shown as a part of current assets. You are required to prepare necessary journal entries towards the buyback of shares and prepare the balance sheet after buyback of shares. Tell me, sir, here what are the entries you are going to write for this buyback entries? First, equity share buyback. When buyback happened, what is the entry? Equity share buyback account debit to bank account. Correct? Equity share buyback account debit to bank account. How many shares we are buying, sir? 25,000. Each share at 20 rupees. So 25,000 into 20. 5 lakhs is what we spend. 5 lakhs, 5 lakhs. Now second, sir, once the shares are bought back, the bought back shares were cancelled. When we cancel, what is the entry? Equity share capital account will be debited. How many equity shares? 25,000 into face value 10. 2,50,000. Remaining 2,50,000 will go to premium on buyback. Correct? Premium on buyback account. 2,50,000 to equity share buyback account. Already we have written so many times in so many problems we done similar manner. Next, sir, entry number 3, this premium is adjusted against securities premium. Securities premium available? Yes, securities premium 2,50,000 is there. So adjust against this securities premium. Securities premium account debit to premium on buyback. Premium on buyback account. How much, sir? 2,50,000, 2,50,000. Right? 2,50,000, 2,50,000. Next, sir, most important entry, CRR entry. Here company is not going for fresh issue. That means they are depending upon the existing free reserves and securities premium. So to the extent of the nominal value of shares so bought back must be transferred from free reserves to CRR. Here the nominal value of shares bought back is 2,50,000. So for 2,50,000 we need to transfer from free reserves to CRR. Here free reserve is what, sir? Revenue reserve is there, 15 lakhs. Of course P&L account is also there, but I will use revenue reserve. So the entry is revenue reserve account debit to CRR account. How much? 2,50,000. That is nominal value of shares so bought back. That's it, pa. Entries is done. So you can check the answer also. See, first buyback entry, equity share buyback to bank, then bought back shares were cancelled. Now here the premium on buyback directly they have debited to securities premium and then transferred to CRR. Sir, here premium on buyback we have written separately and we adjusted with securities premium. Sometimes what you can do, you can directly debit securities premium account. And now they are asking balance sheet also, sir. After buyback, what will be the balance sheet position? What changes will happen in the balance sheet, sir, because of buyback? Share capital will reduce, bank balance will reduce, CRR will be created, correct? And revenue reserve will be deducted, securities premium will be adjusted, correct? Now you see, if I start preparing the balance sheet, first equity and liabilities, shareholders funds, share capital, then reserves and surplus. Money received against share warrants, not there. Share application money pending allotment, not there. Next, non-current liabilities. Any non-current liabilities? Yes. Debentures is there. Hello? And then advance from related parties unsecured. I can take it as long-term borrowings or short-term, whatever. Advances from related parties. Long-term loans and advances or short-term loans and advances I can take. So long-term borrowings. Next, current liabilities. I have short-term borrowings, current maturities of long-term borrowings, trade payables. Trade payables is there? Not there. Next, short-term loans and advances. These advance from related parties, I can consider them as short-term loans and advances or long-term loans and advances, wherever. Assumption. And then other current liabilities also I had two things: unpaid dividend, application money received for allotment due for refund. Asset side, property, plant, equipment, and current assets. Everybody. Now here, if I start preparing balance sheet, sir, the most important thing is reserves and surplus. I will do rough calculations, sir, reserves and surplus. I will show you in the solution. So if I calculate reserves and surplus, tell me what items will come. Share option outstanding account will come. Share option outstanding account is part of reserves and surplus. Share option outstanding account. How much? 4 lakhs, sir. This is one reserves and surplus item. Next, revenue reserve 15 lakhs is there, right? In this 15 lakhs, how much we transfer to CRR? So to transfer to CRR 2 lakh 50. So 12 lakhs 50,000 will be the balance in revenue reserve, right? Next is securities premium 2 lakh 50. Entire 2 lakh 50,000 is used for premium on buyback, right? How much we used for premium on buyback? 2 lakh 50. So the securities premium balance after buyback is nil. Next, so this one, then capital reserve is there. Capital reserve, how much is there? Capital reserve, sir, 2 lakhs. That won't change, that will come. And also CRR. How much CRR we created? 2 lakh 50,000. And then P&L account. P&L account balance, how much is there, sir? 1 lakh 25,000. Any changes in P&L account? No. 1 lakh 25,000. So can you tell me the total? 22 lakhs 25,000 is the reserves and surplus. So in the balance sheet we prepare, see the reserves and surplus 22 lakh 50,000. We got it correctly. So in shareholders funds, reserves and surplus 22 lakh 50. You see here, P&L account to revenue reserve, transfer to CRR adjust, securities premium utilized for buyback, share option outstanding account, capital reserve CRR. Okay. And long term borrowing, sir, only one item. What is that, sir? Debentures they have taken. I think long term borrowings they have included these advances also, right? This one, unsecured loans, advance from related parties, right? So add here advances from related parties. Sir, here the assumption, sir, advance from related parties, they consider it as a long term borrowings. Hello. Alternatively, we can take in long term loans and advances or short term loans and advances also we can take. Okay. Anyways, they consider it as a part of borrowings, long term borrowings, accordingly we consider. Next, other current liabilities also important things, sir. OCL. Sir, what items will come in OCL? Other current liabilities, you know, unpaid dividend is there, one item, 1 lakh, unpaid dividend 1 lakh, sir. And also application money, share application money pending refund, correct? How much? Share application money pending refund 2 lakhs. So total 3 lakhs. So other current liabilities 3 lakhs, sir. See this. A. Current maturities of long-term borrowings he has considered as a part of other current liabilities, which is wrong. I think this is the May 2022 old sum. So please change the solution. Strike this here. Current maturities of long-term borrowings, take it as what? Short-term borrowings. Actually, in current liabilities, add one item called short-term borrowings. In short-term borrowings, take this 10 lakhs. Correct? Current maturity 16 lakhs, 50,000. Take 16 lakh 50 here. Remaining other current liabilities will be 3 lakhs. Take here 3 lakhs. Please change here, because previously current maturities of long term borrowings was part of OCL, other current liabilities, but there was an amendment. So it has to be considered as a part of short term borrowings. But this question they have solved as per the old. So that's why mistakes are there. And this one also, advances from related parties unsecured. Either you can consider them as short term or long term loans and advances. Next, I think share capital, sir. Share capital. Share capital original how much, sir? 12 lakh 50. Correct. Bonus shares 1 lakh. Total 13 lakh 50. Now in the name of buyback, how many shares? 25,000 into 10. 2 lakh 50. So 13 lakh 50 minus 2 lakh 50. 11 lakhs is the share capital. Say this. 11 lakhs. 1 lakh 10,000 equity shares of 10 each. Correct only, sir? Next, asset side, I think there is no property, plant, equipment is same, sir. 46 lakhs 50,000. Current assets, important, sir. Current assets given 40. Because of buyback, how much cash went out, sir? 5 lakhs. So 40 minus 5, 35 lakhs. So this is one question, sir. MTP question. This is old question. MTP May 2022. Nothing great in this question, sir. Very simple question. Old question. Sir, next question number 2, sir. In question bank, MTP, RTP previous exam. This question is given in MTP, and this question tested in November 22 attempt also. Same type of question. I think this type of question we have already solved, sir. See this, they have Alpha Limited gives the following information, rupees in lakhs, sir. And this company announced buyback 25% of its equity shares at 15 per share. For this purpose, it sold all investments at 150 lakhs. 10th April, the company achieved the target of buyback. And 30th April, the company issued one fully paid equity share of 10 each by way of bonus for every 4 equity shares held by the equity shareholders by capitalization of CRR. So bonus issue also involved, sir, along with the buyback. Premium paid on buyback should be adjusted against securities premium. Even if he has not mentioned, we will do the same thing. Na? Any premium on buyback will adjust against securities premium. You are required to pass necessary journal entries and prepare balance sheet of Alpha Limited after bonus issue. I think what is the same question? I think we solved SBQ 9. Correct? Scenario based question 9, sir. Same question. Yeah, this question, sir. Same SBQ question I solved. Same question. KG Limited question is there, na, sir? This question only. In this question also, you see company announced buyback, sold investments, and issued fully paid bonus shares. For every 4, 1 bonus share, like that given, sir. Same question they have tested again here. So please solve SBQ 9. After that you solve this question, sir. Exactly same, nothing changes. So entries also same, sir. And here also bonus issue also same. See this, one bonus share for every 4, same. Numbers only changed, sir. Remaining and all it is exactly similar to SBQ 9. So just practice. After solving SBQ 9, please come and solve this question as a practice. Next, come to question number 3, sir. I think question number 3, sir. In this question, they're asking you comment with your calculation whether the buyback of shares by the company is within the provisions of Companies Act. Buyback is within the limits or not? They're asking, sir. MTP October 22 question. I think same type of question we solved, sir. Illustration 5. Same in that question also they will ask you comment with your calculation whether the buyback is within the limits or not. See, in this case the company wants to buy back 35,000 equity shares. Now you need to find out whether within the limits or not. 3 tests we need to apply: shares outstanding test, debt equity ratio test, resource test. I think same type of question we solved, just amounts changed. That's it. Illustration 5. Yeah, see this illustration 5, same. But see, illustration 5 they tested, they are asking only debt equity ratio test. Hello? But in this question, they not only debt equity ratio, sir. They are asking all right. They are asking only debt equity ratio test. All 3, right? I think for all 3 we solved one illustration 6, where loan funds are 1200 crores, 1500 crores, and also SBQ 2 questions we solved 8, 10. SBQ 8 SM some SM limited some question. So this question is similar to SBQ 8, I think. One question SBQ 8, sir. Yeah, SBQ 8. This question. See this. SBQ 8 question. And also like SBQ 10 also same type. Illustration 6, SBQ 10 also. See this is SBQ 10 also. This company wants to buy back 25,000 shares. They are asking whether it is within the permissible limits or not. You please practice this question exactly same, sir. So you come and solve after SBQ 8, 10 and illustration 6. Same questions. I think 3 questions we solved. Nothing, no difference, sir. Same questions, sir. You just practice this. Or even if you can avoid also, not a problem, because already SBQ 8, 10, 6, 3 questions solved. No need to time waste again. Next, come to question number 4, sir. See, question number 4 also same, sir. Here loan funds are 2,520 crores, 1,680 crores, 2,100 crores. This question asked in May 2022, exactly similar to illustration 6. In illustration 6, the loan funds are 1,200, 1,500, 1,800, sir. Same question, sir. Just numbers changed. Everything is same. You solve this question after SBQ, illustration number 6. All the 3 tests. We need to find out the number of shares to be bought back. So this is about question number 2, 3, 4. Okay. Okay. Next question number 5, sir. In RTP, MTP previous exam question. This question RTP September 24 attempt question, sir. There is a company Purpose Limited, sir, which resolves to buy back 4 lakh of its fully paid equity shares of 10 each at 22 per share. The buyback is in compliance with provisions of Companies Act and does not exceed 25% of the company's paid up capital in the financial year. Okay. For the purpose it issued, see important, for the purpose it issued 1,11% preference shares of 10 each at par. So company here buying back 4 lakh shares, sir. And for this purpose company issued what, sir? Preference shares. 1,11% preference shares of 10 each. That means 1 lakh into 10 means 10 lakhs. Hello? Everybody? The entire amount being payable along with the application. That means, tell me, sir, here in this case, company is depending upon what? Fresh issue. For buyback, the company is depending upon fresh issue. The company uses 16 lakhs of its balance in securities premium account apart from its adequate balance in general reserve to fulfill the legal requirements regarding buyback. Give necessary entries to record the above transactions. So they are asking necessary entries. First of all, company is going for what? Issue of preference shares. Hello? Tell me, when preference shares are issued, what is the entry? Bank to preference share capital. Here two entries we can write. Bank to preference share application money, preference share application money to preference share capital. 1 lakh into 10 rupees, 10 lakhs, 10 lakhs. So the first entry is, see this, bank account debit to 11% preference share application and allotment account. And this application and allotment account will be transferred to preference share capital. This is the first entry, correct? Next buyback happening, sir. What is the entry for buyback, sir? Equity share buyback account debit to bank account. How many shares we are buying back? 4 lakhs. At what price? 22. So 4 lakhs into 22. How much, sir? 88 lakhs. So the entry is equity share buyback account debit to bank account. See this, equity share buyback account debit to bank, 88 lakhs, 88 lakhs. I will give you the order, sir. This is entry number 1. This is entry number 2, sir. Please make this as entry number 3. Equity share buyback entry. We will follow our way. Whenever shares are bought back, the entry is equity share buyback account debit to bank account. Next, bought back shares will be cancelled. When we cancel, what is the entry? Share capital account debit, premium on buyback account debit to equity share buyback account. So see this, 4th entry this is. Equity share capital account debit. How many shares? 4 lakhs into 10 rupees. Share capital will be cancelled by face value, 40 lakhs. 4 lakhs into, we are buying each share at 22 rupees. That means extra we are paying 12 rupees. So 4 lakhs into 12, 20, 40, 8 lakhs is the premium. To equity share buyback account. That is entry number 4. Entry number 5, premium is adjusted against securities premium. Correct? Say this. Entry number 5, premium was adjusted. This premium on buyback, 48 lakhs, sir. It was adjusted against securities premium. How much balance in securities premium, sir? 16 lakhs only there, given. So remaining we use from the general reserve. They said adequate balance in general reserve is there. So therefore securities premium first we use 16 lakhs. Then general reserve 32 lakhs. Premium 48 lakhs. Sir, this 32 lakhs you should write this side. By mistake it came to the credit side. Please strike it off debit. Okay. And the last entry is transferred to CRR entry. Everybody. Last entry transferred to CRR entry. Entry number 6. This entry, you see. How much amount you transfer to CRR, sir? What is the nominal value of shares so bought back? 40. How much we created by fresh issue? 10 lakhs. That means still how much required? 30 lakhs. That 30 lakhs I created from general reserve, because in the question clearly said general reserve we have adequate balance. So general reserve to CRR 30 lakhs. Yesterday we solved one question, you remember? I think illustration 3. In that question also, 2 months back company issued preference shares. So out of the total nominal value we reduced the gap which is filled by fresh issue. Remaining only we created CRR na. Same logic will be applied here. You need to understand here, because of the buyback how much gap is created, how much my equity share capital reduced? 40 lakhs. By fresh issue how much capital filled up? 10 lakhs. See this, equity preference share capital created 10 lakhs, equity share capital debited 40 lakhs. That means remaining shortage 30 lakhs I need to fill. How? By transferring from free reserves to CRR. What is the free reserve available here? General reserve. So general reserve account debit to capital redemption reserve. Very simple question. Hello. Simple question only. Next. They are given working note also. If you want you can check. Total amount we spend is 88 lakhs. Proceeds from fresh issue 10. Securities premium 16. balance from general reserve 62 lakhs. And also how much amount to be transferred to CRR. What is the nominal value of shares bought back? 40. How much nominal value of preference shares issued? 10. What is the balance? 30. That we need to transfer to CRR from free reserves. Everybody. Okay, illustration 6, sir. Sir, this question number 6, sir. This question is given in model test paper September 25 attempt, sir. I was quite surprised by seeing this question, sir, because it's a pure theory question they have asked. That means indirectly they are giving a hint that in examination also it may come. Generally these kind of theory related questions they will test in law paper, not in accounts. Of course they won't give, sir, but we never know. The person who is setting the paper, if he feels this question is quite interesting, then he will give this question only. Same model test paper question only he will copy paste in the examination. Of course you by the time you may study law. In law also these provisions will come. So I think you can manage them quite easily. See this question. First of all, what is this question they are asking? Let us check it. See, there is a company, Alpha Chemicals Limited, sir, which is a listed company, which proposes to buy back 12% of its equity share capital from its free reserves under Section 68 of the Companies Act. Okay. On scrutiny of its records, the following details are observed. What are the details observed? The company intends to route the buyback through its wholly owned subsidiary. Sir, buyback means what, sir? Company purchasing its own shares from existing shareholders and cancelling them. Can a company through its subsidiary purchase its shares? For example, I am a parent company, I have a subsidiary. Now parent company through subsidiary company wants to purchase the shares of this company. Not allowed as per the act. You see, actually section 70, here I have told you, a company cannot buy back their own shares or specified securities through subsidiary companies or investment companies. A company is not allowed to purchase its own shares through subsidiaries. It is section 70, it is clearly mentioned. So therefore, the company intends to route through buyback of its wholly owned subsidiaries prohibited, it is not allowed. What they are asking, you are required to examine the compliance of Alpha Chemical Limited with the requirements of section 70. See this section 70 of the Companies Act and state whether the company is eligible to proceed with the proposed buyback. First, can a company eligible to buy back shares through its wholly owned subsidiary? No, not allowed, prohibited. That is what answer given. Say this. Buyback through subsidiary prohibited. As per section 70, a company shall not buy back shares through any subsidiary, including wholly owned subsidiaries. Next, second point you see. The company had defaulted an repayment of term loan to public sector bank which was fully repaid 27 months ago. Sir, there was a, see, important point, sir, this is. The company had defaulted on repayment of what? Loan from public sector bank which was fully repaid 27 months ago. See, this company has taken one loan, sir, from bank. That loan was repaid 27 months ago. Now, whether this company is eligible to go for buyback. See, in section 71, one point is there. If it has any outstanding defaults, then it will not go for buyback. Even after clearing defaults also, buyback is allowed only after 3 years. Cooling off period is 3 years. That means already you have taken a loan. That loan was repaid. Only 27 months over. That means 3 years not expired. Na? So you are not eligible to go for buyback. It is there in section 70. So therefore here you see, as per section 70, a company that has defaulted in payment of term loan can buy shares only after 3 years from the cessation of the default. Alpha repaid the loan only 27 months ago, still short of the period of 36 months period, because 3 years, 36 months, hence not eligible. So this is also small points. If you know section 70, all these answers you can write. Next one you see, a company has not filed its annual return and financial statements for the preceding financial year. This is also point is there, sir. If a company has made any default in, say this, not filing annual return and financial statements, section 70 says a buyback is prohibited if the company has not complied with section 92 and 129. Alpha has failed to file both, which disqualifies it from buyback. Important, sir. So this point will come in law also for you. When a company makes any default in filing annual return as per section 92, and also file financial statements as per section 129, not filed annual return financial statements, then that company is also not eligible to go for buyback. Last one, the company had declared a dividend in the last year, but the amount remains unpaid for 35 days from the date of declaration. This point is also there. See this, unpaid dividend for more than 30 days. Section 127 read with section 70 subsection 2. Non-distribution of declared dividend within 30 days is a punishable offence. Dividend unpaid for 35 days, this is a default. Okay, within 30 days you have to distribute after declaration of dividend. Alpha Limited is not eligible to proceed with buyback under section 70 due to multiple violations. See this. As per section 70, buyback through own subsidiary prohibited. If there is a default in payment of any loans, 3 years not expired, then you cannot go for buyback. The company has not filed annual returns, so financial statements also not eligible to buyback. And also the company has not paid any declared dividend for within 30 days, that is also default. So multiple violations are there, therefore company is not eligible to go for buyback. And please guys, this is purely law, section 70, nothing to do with accounting. If you don't know section, that's it, forget about the answer. Section 70, what it says you have to remember. Section 70, what it says, when there is a default, this one at least you should remember, these 2 points. Okay, remaining and all theory points, anyway you are going to cover it in the law. Today only covered, all these points came, yes, then very good, super, that's it pa. This is all MTPs, RTPs questions also we have done in buyback. So buyback, every type of adjustment, every type of question we have discussed. Now buyback is yours, you need to protect it. Okay sir, test your knowledge relating to buyback. Carefully think and tell, don't say fluke answers, don't use your common sense please, because these are all provisions as per Companies Act. Okay, not the place to use common sense. Sir, in problems you said these are all common sense. Now in MCQs you test your knowledge, you are saying don't use common sense. What is this? Because in problems, small calculations, common sense, mathematical basic calculations, but these are all MCQs relating to Companies Act. Okay, that's why. See, as per section 68 of the Companies Act, buyback of own shares by the company shall not exceed first 25% of the total paid up capital and free reserves, 20% of the total paid up capital and free reserves, 15% of the paid up capital and free reserves, 10% of the total paid up capital and free reserves. Tell me, the Companies Act says buyback cannot exceed, amount for buyback cannot exceed 25% of paid up capital plus free reserves. The answer is A. Here, see in examination, the doubts, the students will get a doubt, 25 or 20, 25 or 20, gut feeling says 25. But he won't trust his gut feeling. He says 25. My mind says 25 means it is wrong. Okay, 20. Let's take. Because he does not have confidence on himself. That's why he says, his mind, see, whatever answer first comes to your mind, that most probably that is right. But what happens, we will think, no, 25, not that much easy. Maybe take 20, round off. Why they will put 25? 20 is a round figure. I will take 20. 25. Next, the companies are permitted to buy back their own shares out of free reserve securities premium, proceeds of issue of any shares, both A and B, neither A or B. Tell me sir, free resources, I mean, what are the sources for buyback? Sources tell me sir. Free reserves, securities premium, proceeds from fresh issue. That means either A or B. That means the answer is A and B. Correct? Hello? Both A and B I can use. Everybody. C is the correct answer. You check. Next, when a company purchases its own shares out of free reserves, a sum equal to nominal value of shares so purchased shall be transferred to which account? CRR account. CRR account we need to transfer. Some students now they will write buyback reserve account. Buyback reserve account they will write. Because they see that is a variety thing. Buyback reserve. Maybe I have not studied it. So that could be the correct answer. Buyback reserve. Let's transfer. Because company purchase its own shares. Buyback. Company purchasing its own shares means buyback. So transfer to buyback reserve. That's what their feeling is. Next. Which of the following statement is true? True statement you have to identify. Buyback is for more than 25% of the total paid up capital and free reserves of the company. Buyback, can it allowed more than 25? No. Not true statement. Partly paid shares cannot be bought back by the company. True. Shares cannot be partly paid. Hello. Buyback of equity shares in any financial year shall exceed 25% of total paid up equity capital. No. These dramas and all won't work with me. Because I know where he will test. Tell me, resource test. Resource test says 25% of paid up share capital. They use the word paid up share capital means equity plus preference. But when it comes to shares outstanding test, he talks about paid up equity share capital. Equity word he used. That means shares outstanding test, they are talking about only equity shares. Resource test, they are talking about total paid up share capital. You observe the difference? I stressed also when I am discussing. All these material. Previously, one material I think in the CA material itself, I think that's wrongly given. That 25% of the paid up share capital, shares outstanding test also 25% of the paid up share capital they have given. That is not paid up share capital, that is paid up equity share capital. Okay. So partly paid up shares can be bought back. No, I think the answer is B, sir. Fourth B, correct? Yes. Now see the fifth one. Premium. Excess of buyback price over par value paid on buyback should be adjusted against. Any premium will be adjusted against either securities premium or free reserves. I think C is the correct answer, right? Last one. Advantages of buyback of shares include encourage others to make hostile bid to take over the company. Sir, buyback we are encouraging our enemies to take over our company. I told you we will not encourage to stop the hostile bid to take over the company. Some new students now, if they don't know concept, they'll see hostile bid, new word, select it. A select it. Hostile bid, enmity. Encouraging others. Sir, why we will encourage? Buyback is to protect the company. Next, decrease promoters holding. No, I told you. We need to increase the promoters holding. Hello? This is also wrong. Discourage others to make hostile bid to take over the company as the buyback will increase the promoters holding, right? We will discourage others through buyback. All of the above, no. So the answer is C. So I think these are the MCQs, sir. Very simple.